and still with us, David Kirkpatrick, CEO of Techonomy. So, Mandeep, Symantec has gone through almost a complete makeover just in the last year. They also sold the Veritas storage business. Where does this new acquisition take them?
So, Emily, right now, Symantec is really addressing the problems it has with its flagship Norton product, which has been bleeding sales. Growth has been hard to come by. And what they're trying to fix is really acquire a steady revenue stream from a company, LifeLock. And it kind of partly addresses the problem they have in the consumer segment. The Blue Coat acquisition was really targeted at the enterprise segment.
So let's talk about the challenges they face with the consumer. Symantec has struggled because its security software was loaded onto PCs, then the world went mobile. You know, how well positioned is Symantec to compete in a world where there are a lot of mobile threats?
So you're absolutely right. The security landscape has changed completely. And right now you have seen the rise of a lot of smaller point solution vendors who have done well, who have scaled themselves up to, $400, $500 million, who address a specific portion of the threat. They are not integrated platforms except for a Palo Alto Networks or a Fortinet. So I think what you're going to see is a lot of these point solution vendors being acquired because their growth is slowing and they can't address the overall problem. For a company like Symantec, they are putting the pieces together, but you don't know if the product synergies are there, and that's where the execution comes in.
David, it's interesting to see these first M&A deals take shape, now that we know that it's Donald Trump who will be in office in January. This deal may have been in the works for a long time, preceding the election. But what do you expect from M&A under Donald Trump?
Well, I think there's a lot of reasons to expect tech M&A to grow and not to shrink in coming months and years. One is if the repatriation of overseas profits is allowed, which almost certainly is going to happen in some form, that gives these companies a lot more money to spend domestically. They're already buying companies overseas using that money, and I think it makes a lot of sense to see that as a factor that will increase M&A. I also think, like I've said twice already on the show, we're entering into a very uncertain environment. And the more uncertainty there is, I think business leaders generally like to be big. They just think that makes them feel a little safer. So that might be another force militating towards more M&A. I also think the pace of change just continues to accelerate, and these big companies can't invent everything themselves. So they have yet another reason. They've just got to keep buying new tech. Like, for example, I think Symantec buying an identity management company is very smart. Identity management is one of the big challenges. They didn't develop them themselves. They got it from somebody else.
Mandeep, what do you make of that? I mean, LifeLock has had some interesting run-ins with the FTC over false advertisings. They've made very bold claims about protecting customers' identity. They've had to actually pay money back to consumers. Do you think Symantec simply decided that bigger is safer and we're willing to deal with some of these issues?
Absolutely, and I think the fact that they already have a $4 million customer base, it just goes to prove that the revenue stream they're getting from LifeLock is steady. It helps them fix the consumer segment problems that they have been trying to address for the last 2 years. So it's a very good idea for them to pursue this acquisition. The only problem for Symantec is they don't have the bandwidth to pursue more deals like this because S&P today said that their debt could be downgraded to junk. So it doesn't leave them with much room to pursue more deals like this.
All right. Mandeep Singh of Bloomberg Intelligence, thanks so much for stopping by. Techonomy CEO David Kirkpatrick, you're sticking with me. Up next, Instagram joins the live video game and adds yet another feature that looks like Snapchat. But are the copycat features smart? We'll discuss next. This is Bloomberg. A story we are watching. The selfie touch-up app Meitu started testing demand for a proposed Hong Kong initiation offering. The IPO could be as big as $750 million, which would be the city's biggest tech IPO since 2007. The company will gauge interest from potential investors from Monday through December 2nd. Meitu hasn't set a target listing date or decided when it will begin taking orders for a share sale. Instagram has launched a new live video and messaging feature, furthering competition with Snapchat. The new feature allows users to broadcast videos in real time and lets viewers watch only while it's streaming without the option of a replay. For more on the launch, Bloomberg's Sarah Friar joins me in studio and is still with me, our guest host for the hour, David Kirkpatrick of Techonomy. So talk to us about how this impacts competition between Instagram and Snapchat.
Well, when Instagram added stories, that was basically a blatant copying of Snapchat stories, and everyone kind of like said, well, Instagram, are you going to admit you copied Snapchat? And Instagram did. They said, of course, Snapchat had a great idea, and now we're going to do it too. This is taking it a step beyond. Now Instagram has something that Snapchat doesn't, and Snapchat is...
So Snapchat now has no choice but to either not do this or do it in copy.
Now they have to decide if they want to do live video.
David, what's your take on this?
Well, it is interesting how many young people, basically Snapchat and Instagram are the two things they use the most. So to see the two dueling it out is kind of an interesting new development. Wouldn't it all surprise me to see Snapchat copy this?
Why doesn't Snapchat have live video, Sarah?
Based on people I have spoken with inside the company, it's not something that they think. They prefer to have sort of a curated experience. It's live enough for their live stories. They bring out sort of it's not like a mess of video like you get on Periscope. It's more curated, and it still feels live. So they haven't felt the need. Honestly, I feel like that would be a huge infrastructure expense. And Facebook has the kind of infrastructure that can support live streaming of video that Instagram can tap into.
Now, David, you've got some interesting thoughts on a potential Snapchat IPO. Of course, we now know that they have filed to go public. They have filed to go public earlier in their life cycle than, for example, Facebook. But you think there are a lot of unknowns here.
Well, I don't think they've really proven they are a growing, profitable company. So, the earlier in your life cycle you go public, the more risk effectively investors are taking on when they buy your shares. Now, I think there is a massive appetite on Wall Street to identify the next fast growth big tech company. That's one reason why Uber is getting these huge valuations on the private markets. People think they're getting in sort of the back door by buying the private shares. Snapchat, is probably as good of a guess as you can make about what the next company might be that could really grow a lot and be a massive global success. On the other hand, it is by no means proven. So I think it has great management. I think they're doing some really smart things, but there's no way that you can really know what Snapchat's future next couple years are going to look like, in my opinion.
I think the big question around the IPO is going to be, is this more of a Twitter or more of a Facebook? Of course, Wall Street is going to hope for it to be more of a Facebook, but there are definitely the same kind of risks. Is this a niche product that's going to hit a ceiling of user growth like Twitter has, and are they going to be able to continue to make money?
David, somehow Snapchat has managed to avoid all of the criticism that has befallen Twitter and Facebook over the last week or two over potentially swaying the election, potentially changing our social patterns and increasing building out the walls of our social bubbles. What do you make of that?
Well, I guess they should just hold their hats until they start getting that kind of criticism, because if they became the kind of company that investors are necessarily going to want them to become, they will, by definition, have to get into serving all kinds of other information, including political news, etc., one way or another in a very Snapchattian fashion. So, I think that's interesting. But I confess, it's a little hard for me to know. I'm just not being a Snapchat user. But I just want to quickly say, I thought Sarah's point before was really smart, that Facebook has the infrastructure to be able to do this at a lot lower cost than Snapchat, or certainly they've already spent the money. So it may be that if Instagram and Snapchat are really going head-to-head, the Facebook kind of big brother ownership and infrastructure advantages could really begin to be a major competitive advantage.
All right. David Kirkpatrick, CEO of Techonomy, our Bloomberg contributing editor, and my guest host for the hour. Thank you so much, David, for stopping by. Sarah Friar, as always, wonderful to have you. Now, a story that is trending. UPS is the latest company to tap into artificial intelligence. It's developing apps to help customers with simple requests and may someday enable them to track packages using voice commands. UPS started offering a chatbot interactive feature on the Facebook Messenger app, Skype, and Amazon's Alexa virtual assistant system earlier this month. And that does it for this edition of Bloomberg Technology. Remember, all episodes of Bloomberg Tech are live streaming on Twitter. Check it out. That's all for today from San Francisco.
Pushing policy. U.S. President-elect Donald Trump says he'll ditch the Trans-Pacific Partnership Agreement on his first day in office, while Japan says its stance over TPP won't change. Fiscal focus. ECB President Mario Draghi says governments need to step up reforms while he commits to maintaining monetary stimulus. Plus, Corbyn warns against a hard Brexit. The UK Labour Party leader tells Bloomberg pulling out of the EU single market would be very damaging. We bring you that interview this hour. A very warm welcome to Bloomberg Daybreak Europe, our flagship morning show here in London. I'm Anna Edwards alongside Yusuf Gamal Eldin. Yusuf, let's talk about the stock markets because it seems we're all partying like it's 1999.
Yeah, it's like 1999. Again, it's a record high for 4 of these benchmark indices. And 1999, that was the year when oil was trading at $26 a barrel. It was the year when we were freaking out about Y2K. It was the year when the S&P 500 returned 19.5%. But this year, look at where we've come from.
Hashtag BTV3302 is the way to find that chart if you want to find it on the Bloomberg. As you say, Yusuf, all of these 4 US stock benchmarks increasing to record highs, hence the 99 comparison. That's the Dow, the S&P, the Nasdaq, the Russell 2000. And if we throw up the risk radar, you'll see that the Asian stock market picking up on this global rally, whether it's optimism around oil or whether it's Trumponomics, certainly something, or corporate profits in the United States, certainly something has got under the skin of US equity markets for certain. And we're seeing that being picked up in the Asian session, particularly the energy themes there, and the futures suggest they will be stronger over in the US session once again.
Absolutely. Also some interesting moves in dollar yen rebounding from that quake-induced move at 110.79, just below the flat line there. As investors focus again on the widening in US-Japan yields. Brent, currently we are at $49.53. Now, this is up at the moment 1.3%. Don't be mistaken by that move, because we saw some huge moves overnight in excess of 4% on optimism from OPEC members that they will reach a deal on November 30th.
Yeah, so Wednesday next week, that's going to be busy in Vienna, isn't it, with this OPEC meeting, and Iran and Iraq all giving comments in the run-up to that. Let's get the Bloomberg First Word news for you now, though. Here's Heidi Lun.
Thanks, Anna. Well, President-elect Donald Trump has released a video to update the American people on his transition to the White House and policy changes. Trump says he will withdraw from the Trans-Pacific Partnership, cancel restrictions on American energy, and get rid of old regulations.
On regulation, I will formulate a rule which says that for every 1 new regulation, 2 old regulations must be eliminated. So important.
UK Labour Party leader Jeremy Corbyn says business leaders and trade unions have expressed concern that Britain is heading for a, quote, hard Brexit. Speaking to Bloomberg, Corbyn warned over the impact of such a move.
The idea of what I suppose would be called a hard Brexit, where you end up with a tariff war between Britain and Europe, where much more than half our trade is with Europe, would be very, very damaging indeed.
European Central Bank President Mario Draghi said more urgent action from governments is needed to address the structural weaknesses of the euro area. Draghi also pledged to maintain the ECB's current monetary stimulus. He spoke to the European Parliament in Strasbourg. Japan has lifted all tsunami alerts after magnitude 7.4 earthquake off the coast of Fukushima. Warnings were issued widely, urging residents to flee to higher ground. 5 people have been reported injured and some bullet train services were suspended, but Toyota plants in the region were operating as normal. The US men's national football team has fired its coach Jurgen Klinsmann. He came under pressure after 2 painful losses in the opening qualifying matches for the 2018 World Cup. In a statement, US Soccer said, quote, the form and growth of the team up to this point left us convinced that we need to go in a different direction. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. You can find more stories on the Bloomberg at Top Go. I'm Heidi Lun. This is Bloomberg. Anna, Yusuf.
Thanks, Heidi. All right, so Trump then saying he's going to shred up the TPP, his policy priority. Let's see how that's affecting sentiment in markets in Asia. Juliet Sally has the details.
Yusuf, well, it's been a pretty good session here in Asia, mainly, though, on the back of that rally we saw on Wall Street. Of course, all 4 major indices moving higher to record territory in the US, and really have seen that lead and run with it here in Asia, particularly in the energy resource-laden markets of Hong Kong and Australia. Australia closed higher by 1.2%, a very good rally coming through from the ASX 200. And in late trade, the Hang Seng is at 1.3%. You can see those energy players leading the gains there, as we see, of course, crude at that 3-week high on expectations there will be a supply cut deal at the from the OPEC members. We're also seeing the Shanghai Composite well supported. It is back at those 10-month highs in late trade, up by 0.6%. And the Nikkei has closed higher once again. We have had the topics now firmer for the past 9 consecutive sessions. So that rally really continuing into that equity market. Of course, both the topics and the Nikkei are in bull market territory. Just having a look at currencies, you're seeing the Korean won the best performer out of the EM currencies today, up by 1% against the dollar. And then talking about the TPP, we did actually see a little bit of strength coming through in the yen earlier today. This was after the earthquake in Fukushima, and also we did see a little bit of weakness coming through from the dollar yen, but that has really pared back in late trade, so we're seeing it fairly unchanged there. The yen holding at 110.81. Anna and Yusuf.
Juliet, thank you very much. Juliet Sali in Hong Kong. Let's talk about trade. US President-elect Donald Trump says he intends to withdraw from the Trans-Pacific Partnership Agreement on his first day in office. The statement was included in a video outlining his transition team's list of executive actions that his administration, quote, can take on day one. Trump regularly criticized the trade deal whilst on the campaign trail. Prime Minister of Japan, Shinzo Abe, says TPP has no meaning without the involvement of the United States.
On trade, I am going to issue our notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country. Instead, we will negotiate fair bilateral trade deals that bring jobs and industry back onto American shores.
Let's welcome into the conversation now Vincent Chéniaud, who's Global Head of Rates and FX Strategy at Societe Generale. Vincent, great to have you on the programme. I pulled up the ECTR function on the Bloomberg, shows the flow of trade between the United States and other countries. No surprise that the biggest trading partner there is China. How significant is this comment on TPP for itself and what it tells us about the president-elect?
Well, I guess it's not too surprising. I know that was one of the big. We know that was one of the big themes on the campaign. You know, going forward, that raised the questions about global trade. Global trade has been a very strong engine for growth and low inflation over the past 15 years. And there are concerns that that trend could be reversed. The long-term implications on global growth are negative. Near term, I think the market will be worried about the inflationary impact that we'll see, especially in the U.S. at a time when inflation already is picking up.
The fact that Donald Trump goes out there and says, you know, we are going to submit a notification for annulment. No two doubts about where he's going to go with that policy. Anybody who had doubts that President-elect Trump is going to be different, or candidate Trump during the campaign is going to be different from President Trump, would be mistaken on that front. Does this go on to show that we are going to see more of this anti-trade, anti-globalization with Donald Trump?
Well, we know that international trade is one area in particular where the president has a lot of power in the U.S. In other areas like fiscal policy, for example, support from Congress will be absolutely essential. On trade, less so, and he's making quite clear where his priorities are going to be. Again, for me, it's quite a strong signal about medium-term growth, but even more importantly now, especially with oil prices picking up now, that theme is becoming more prominent. The impact on inflation, I think, is significant.
So we have oil prices picking up, we have talk of trade deals falling apart and the inflationary pressures that could bring. No surprise there then that perhaps markets are factoring in a 100% chance now of a Fed hike in December. And of course, this has implications out into next year as well as to how far the Fed moves. I've got another chart. This is 3036, BTV 3036. Death taxes and a Fed hike now seem to be three certainties.
Since when are taxes a certainty? It depends on what
we can get. Well, yes, a little less certain perhaps in the United States than they once were. But certainly Fed hike, bond traders now factoring in a 100% chance of a move in December.
Yeah. The risk, I think, is that we continue to see an upward repricing of the Fed path. There is only a bit more than 2 hikes priced between now and November next year, including now almost for sure a hike in December this year. that's not a lot priced in for next year. I think if we see a fiscal stimulus, if we see a pickup in inflation in the US, there is quite a good chance that the Fed pulse will be repriced higher. What we are seeing finally is that the implied rate in the market is moving up towards the dots, and it's a big reversal of a trend that we've seen for a long time. The risk at some point next year is that even the dots will move higher, and I don't think this is something the bond market will take very kindly.
The OIS forward curve is showing that there could be a move higher for the second quarter of 2017, and then again for the fourth quarter of 2017, which implies 2 rate hikes in terms of that probability. What happens with the stronger US dollar? I mean, we've seen the rally. Could that offset the entire picture going into 2017?
Well, I think that is going to continue. The question is whether at some point dollar strength stops the Fed. I don't think so. At that point, yes, we've had a tightening of financial condition with the stronger dollar, the higher bond yields, but the equity market is doing quite well, financials in particular, so that's an offsetting factor. Right now, what we hear from the Fed is that clearly that tightening of financial condition is not going to stop them. And again, if inflation picks up, I think the stance from the Fed could become more hawkish indeed.
How much further does the bond route have to go then from what you've said about inflationary pressures building, about how the dots might have to go higher in the US? That's the estimates of where rates go by Fed policymakers, of course. From everything you've said, that sounds like you think the bond route has further to run. We talked to a couple of guests yesterday who said, I'm looking at the 10-year yield right now, it's at 2.32%. They talked about if it gets to the high 2% mark, or just below 3, that's when the bond market starts to pause. What's your line in the sand?
That's also our forecast, that in the coming year, 10-year bond yields will rise towards 3%. Could it go higher? Yes, definitely, depending on the growth performance, on the inflation performance. People talk about the spread between treasuries and Bund JGBs. I don't think that's really coming in the way too much. I think people are a little bit mistaken by those spreads. When you look at them on an outright basis, they look very wide, but actually when you correct them for the cost of FX hedging, those spreads, actually typically treasury bonds, are quite tight. So I don't think...
On that note, we've actually brought up the chart that really shows you that spread as it's widened. So those are your 10-year U.S. treasuries and the 10-year bond yield spread, and you can see there that it's the widest it's been in... Well, yeah, since 1989 there. You're saying it doesn't have further to go, and it doesn't really mean anything substantially, right? It doesn't mean that we might see a lot of appetite for U.S. treasuries because of that spread. So that would put an effective ceiling on that 3% mark that you're putting out there.
Potentially, but again, you know, some European players, for example, can go out there to the US and buy treasuries and stomach the FX risks. Total return funds, for example, can do that. But a lot of investors, insurers, bank, benchmark funds cannot do that. They have to hedge the currency risk. And when you do that, it's quite costly. Over 1 year, typically, from Europe to the US, it would cost you 1.8%. And that would eat a good chunk of that pickup that you get here. So when you look at the spread on that corrected measure, it's actually much less spectacular. And that's where I'm saying I don't think that spread will stop the sell-off.
How much do the EMFX lose out if we see the comment around TPP extended into other trade arrangements by the United States? Are we too concerned or not concerned enough about the impact that this has on EMFX, on the Chinese currency?
It has a substantial impact. I mean, not only we have question marks about international trade, potentially a big negative for EM, but also rising US rates, which historically has not been very good for EM assets, EM currencies in particular. So you have that double pressure, which I think in the near term stays somewhat negative EM. What we had seen over the past few months is that EM markets had become slightly less sensitive to US rates. So I'm not too alarmed, but yes, I would say that those themes are negative overall.
Vincent, thank you very much. Vincent Chagnot, Global Head of Rates and FX Strategy at Societe Generale, stays with us on the programme.
We've got a jam-packed day ahead. Let's get you some highlights. At 9:30 London time, we get UK public finances. Then at 1 p.m., there's a rate decision from Hungary. Just 2 hours later, don't go anywhere, it's Eurozone consumer confidence. And existing home sales numbers are out of the U.S. Should give us a better indicator about the health of that economy. A policy announcement from Nigeria's central bank is also scheduled for today.
Coming up on the programme, we'll hear what ECB President Mario Draghi had to say about the challenges Brexit and a President Trump pose to European stability. Then at 6:30 UK time, Jeremy Corbyn tells Bloomberg about the Brexit concerns he's hearing from businesses and trade unions. And at 7:20 UK time, we'll bring you an exclusive interview with the CEO of Compass Group as the catering giant releases results. This is Bloomberg. Very warm welcome back to Bloomberg Daybreak Europe. It is 2:19 in the afternoon in Hong Kong, where the Hang Seng is up by 1.3%. Here in London, it's 6:19. Let's get the Bloomberg Business Flash. Here's Juliet Sally.
Anna, thank you. Lufthansa's pilots are set to strike tomorrow in their long-running dispute over pay. The walkout will affect short and long-haul services from Germany operated by the airline's namesake brand. It will come after today's action by flight attendants at the group's Eurowings division. Rio Tinto has confirmed that there will be job reductions across its iron ore business in Western Australia. A spokesman for the company also said the outlook remains challenging for the division, but wouldn't say how many positions will be cut. The comments came after the ABC reported that 500 jobs would go. Abigail Johnson is to succeed her father Edward as chairman of Fidelity Investments early next month. She has been CEO since 2014 and will maintain that role. Edward Johnson is retiring and will become chairman emeritus. The move comes as the money management giant faces intense competition for assets and clients from rivals including Vanguard and BlackRock. Daimler has removed an executive of its China Trucks and Buses unit from his position after a car park dispute with a resident in Beijing. The company apologised after the spat aroused anger among social media users and prompted critical commentaries in Chinese state media. And that's your Bloomberg Business Flash. Anna Youssef.
Thanks, Juliet. That's Juliet Sally joining us live from Hong Kong. Now, ECB President Mario Draghi says both Brexit and Donald Trump's U.S. election win will have a long-term impact. Presenting the central bank's annual report at the European Parliament in Strasbourg, Draghi said Europe's challenges had increased. He also stuck to his argument that fiscal policies should support the economic recovery.
Our monetary policy support has to be accompanied by decisive action from other policy areas. In fact, we continue to face a number of structural challenges that are holding back a more dynamic expansion of the euro area economy.
Vincent Chanio, Global Head of Rates and FX Strategy at Societe Generale, is still with us. What do you make of Mario Draghi's comments? And as we race towards the December 8th meeting, what can we expect in terms of the asset purchase program? Is it going to stay at 80 billion euros? How do they protect the little inflation they were able to put alight?
Yeah. Well, I think we know the program stays at 80 billion until March. The question is what happens before that. I think Draghi will tell us in December that the program will be extended for at least 6 months. And then is he going to discuss about the size? I'm not sure. I don't think he wants to rock the bond market too much. We have had already quite a large bond sell-off. It's actually been even worse in non-core markets like Italy than in Germany. And I don't think he wants to rock that market too much. Overall, I don't think the ECB isn't happy. You've had a weaker euro. You've had a rally in financial stocks, which eventually should be good for lending. The only negative really is that increase in bond yields. And therefore, I don't think Draghi wants to come with another shock and say, listen, we're going to taper, we're going to reduce the purchases. I think eventually that comes in March, but I see no hurry for the ECB to announce that in December.
So we've got euro-dollar currently at 106.27. The dollar halting its longest ever advance against the euro. That's certainly been the story since the Trump election. I mean, how weak, you say that the ECB might not be too unhappy with the weakness there. How weak then does the euro get if you see the dollar strength continuing?
Eventually, we think that that goes to parity. Much below that, we don't think so.
When's eventually, Vincent?
We plan that to happen over the next 3 to 6 months. But then when the ECB starts to taper next year, that will be seen as the first step towards a removal of the accommodation. And then the euro gets some support. So, yeah, parity in the next 3 to 6 months, not much below that.
What about sterling? Do you have any specific views on how sterling's going to hold up in light of the euro weakness that we've seen?
Well, the sterling actually has been quite resilient in this large dollar rally that we've had since the U.S. election. I see that as based to a large extent on positioning. You have massive shorts out there. And then, of course, there's been discussion around the High Court and what the Supreme Court is going to say. And there's been concern about potentially a delay of the triggering of Article 50. That has supported, I think, that short covering, especially, again, the euro. Going forward, I think there is room for sterling to strengthen a little bit, again, the euro, maybe down to 0.83. but I don't think it goes very far. Eventually, Brexit will have a negative impact on the economy. All the uncertainty that we'll get around the Brexit developments, I think, will cap sterling gains.
And as we look around Europe to look for the next domino to fall, if indeed there is one, and if we look at the populist sentiment that we see rising in Europe, where does your concern lie, Vincent? Is it around the euro, or is it around spreads widening in Italy, in other parts of the eurozone?
That's a fair point. Euro weakness was based on US factors, Fed expectations in particular, but also on concerns that the rise of populism could have a larger impact in Europe, because effectively in a country like Italy, like France, that potentially could disrupt the euro process. So the implication, the consequences would be far more serious than in the US. We're going to watch the Italian referendum, but I think quite a lot of bad news is priced in there. Then we'll be looking at the French elections. I'm not too worried, to be honest. I know that
Le Pen's still a tail risk, is it?
It is a tail risk. It's not the central scenario. Yeah. Let's see this weekend whether we get Mr. Juppé or Mr. Fillon.
And what's your base case for the Italian referendum?
I think the market is priced for a no victory. So if you get a no, obviously near term you have a negative market reaction. But then when the market realizes that we probably won't have early elections in Italy, I'm not sure that you'll see a long-lasting impact from that referendum.
Vincent, thank you very much. Vincent Chéniaud, Global Head of Rates and FX Strategy at Societe Generale, stays with us here on Daybreak Europe. Up next on the programme, the hard Brexit threat. UK Labour leader Jeremy Corbyn tells Bloomberg about concerns he's hearing from British businesses and trade unions. We'll bring you that conversation. He spoke yesterday to our colleague Nera Chehit. She had a conversation with him around Brexit, around regulation, putting workers on boards or not. That UK conversation coming up next. This is Bloomberg.
It's 6:30 here in London. I'm just doing the time conversions for you, and it is 3:30 in the afternoon over there in Tokyo. You're looking at the Imperial Palace. Dollar yen currently holding relatively steady, 110.84. Again, rebounding from that initial quake-induced move that we saw. So that is the picture there. But let's take a look and see what's happening with the new edition of Daybreak, which is now available on your Bloomberg and on your mobile. It's the function Daybe Go. Let's take a look and see what are some of the top stories that are making this edition. The cover story is commodities on a tear. A Bloomberg gauge of materials headed for the biggest two-day gain in more than 6 months. That's as confidence in the global economy grows, and the likes of Goldman Sachs and CRU Group predict higher prices. Copper has led metals higher and continues to do so as we speak.
Goldman Sachs also got some comments out about oil prices, talking about those being strong in the short term at least. And let's go there next, because the next story is optimism surrounding an OPEC output deal. Traders are gaining confidence that an agreement is possible after Iran said that such an outcome is, quote, highly probable. And Iraq also made constructive noises. Russian President Vladimir Putin said he sees no obstacles to a deal, and Russia is willing to freeze output at current levels.
And finally, Daybreak focuses on ECB President Mario Draghi. He's pledged to leave monetary stimulus unchanged ahead of the meeting next month, where the decision about the future of the central bank's QE program will be made. Draghi also said more urgent action is needed to address the structural weaknesses that are plaguing the Eurozone.
So what's happening in the Asian equity session? Let's get all the detail on the markets. Guy Johnson has details for us, and optimism around Trumponomics outweighing any concerns about global trade, it seems, Guy.
Yeah, absolutely. Let's talk about where the equity markets are right now. The FTSE can give us a steer on where we think the equity markets are going to go. FTSE 100 on my WEI. Remember, click the futures box. Gives you the fair value, tells us we're going to be up by around 0.5% this morning. So we are looking at a fairly positive picture when it comes to the equity markets at the get-go. We know it's a positive picture about the equity markets right now, don't we? Let's walk you through some of the other charts. You're going to see a lot of this chart today. I promise you that, folks. This is US stocks. Remember, you've got 3 indices and 1 average. Remember, the Dow is an average. Trading higher, hitting records. The Russell, the Nasdaq, the Dow Jones Industrial Average, and the S&P Index all coming through on their highs yesterday. And let's talk a little bit about where we think the WIRP's going to go as well, because I prefer, as does some of the team here, the swaps market, i.e. the OIS drop down here. But if we go for Fed funds futures, a little less liquid, but we've got 100% probability of a deck hike now coming through from the Federal Reserve. We've been listening to Janet Yellen. The market has been pricing that in. The OIS swaps market a little less convinced, but nevertheless still in the 90s. And the other thing to mention is Brent. You were talking about it just a moment ago, continuing to rally. Equity markets generally looking fairly good when it comes to the big mining stocks and the oil stocks, and that's being led by what's happening, as you say, with things like copper and oil. This ahead of the OPEC meeting. We are now trading on Brent. This is the front month contract at 49.44. Still shy of 50, but nevertheless looking fairly positive. Back to you.
Yes, that rising oil tide lifting all kinds of ships, isn't it, Guy? Thank you very much. Let's turn to UK politics now. The leader of the UK's opposition Labour Party says business and trade union leaders are very concerned about the prospects of a so-called hard Brexit. He spoke to Bloomberg's Nera Chehich at the CBI conference in London. She began by asking if he thought state intervention is beneficial for business.
I will meet the President-elect, and I will make it very clear that I absolutely and totally deplore the comments he made during his presidential campaign in respect of women, in respect of minorities, and the way in which he sought to blame very hard-working Mexicans throughout the whole country, very hard-working Muslims throughout the whole country, for any economic ills anybody suffers. And also the idea that you can run an economy on the basis of a race to the bottom in taxation and the grotesque levels of inequality that will bring about is simply not a way forward. But I want to live in a world where we don't all go to war. I want to live in a world where we're dedicated to sustaining our environment and, above all, sustaining our economies, so that we don't have these appalling left-behind communities, as you find over the Great Lakes region of the United States, as you find in many parts of Europe, and indeed as you find in parts of their own country.
But yet a lot of these ills, which some say have been caused by free market capitalism, voters are thinking that the solution is still right-wing politicians. Why do you think that is? What message is the left not getting across, or are people not understanding?
Because they got involved in third-way economics, which was saying that you could abandon your basic principles of full employment, of properly funded public services, and of a generational growth in wealth rather than impoverishment of the next generation, and it became a very unclear message. Our own problem as a Labour Party in the 2010 and 15 elections was we had some fantastic stuff in our manifesto, but the problem was we were also still offering to make cuts in public services. I think we've got to do differently and better than that, and that is what our Labour Party now represents, something very different, which is about investment in housing, which creates good housing, saves a lot of public money because you create good jobs where people pay taxes, and ends up with young people contributing to society in a good way because they've got a good education and do well, rather than, unfortunately, being underemployed or unemployed. So my message is the Labour Party offers a different economic approach. We will end zero-hours contracts. We will chase down employers that grotesquely exploit people by paying them minimum wage, in some cases try and dodge around it to pay even less than that. We want to see a prosperity that is shared by all in all regions of the country.
But you will also raise corporation tax. Yes. How will you convince business that that's a good thing?
Well, a business to do well needs its employees to be healthy, needs the society to be at peace, but above all needs a workforce that is educated and well trained. So if we raise corporation tax in order to get better quality training for young people in good quality apprenticeships, or getting working class youngsters through university, the number going to university is now falling, then actually the whole society benefits. If you fund a proper social care system, if you fund proper nurseries, if you fund good quality health care, then we have a healthier population that is therefore able to contribute to the economy by working.
That was UK Labour leader Jeremy Corbyn speaking to Bloomberg. And stay with us, we'll have another great Brexit conversation coming up. Former UK Business Secretary Vince Cable joins us at 8:30 UK time.
That'll be on the European Market Open show, of course. We're getting some breaking news coming through from the Italian energy sector. Just bring those lines to you. Enel, the Italian energy giant, presenting its 2017 to 19 strategic plan in a statement, saying they're targeting savings of €1 billion in 2019 versus 2016. They're talking about their share buyback options. The share buyback option for up to €2 billion will be submitted to the AGM. The dividend payout is going to be increased to 65% on 2017 net ordinary income, and the minimum dividend of 21 euro cents a share on 2017 results, they are telling us today. So streamlining their structure, planning to dispose of €3 billion of assets. Lots coming out of Enel. We'll leave Enel there for the moment and get back to our conversation around the UK. Vincent Chéniaud, who's Global Head of Rates and FX Strategy at Societe Generale, is still with us. Also joining us around the Daybreak desk this morning, Luis Garcia, who's an international trade lawyer at Matrix Chambers in London, has previously negotiated trade deals on behalf of Mexico. Luis, thank you very much for joining us. Great to have your thoughts. We'll talk about TPP and the US in a moment, but picking up on our conversation on the UK, we had some comments there from Jeremy Corbyn. I was there yesterday at the CBI event in London, and I heard Theresa May talking about how she wants Britain to be able to go out into the world and do these trade deals to the benefit of Britain. That doesn't sound like a country that stays within a European customs union, does it, or can it?
True. If the UK wants to be a global leader in trade, in world trade, and wants to have the flexibility in the negotiation of free trade agreements, then that means that the UK will have to leave the customs union.
So that's absolutely definitive, is it? There's no way you can forge another way where you stay in a customs union and also get the freedom to do other deals yourself?
The freedom of negotiating free trade agreements? No, you would need to be outside the customs union.
And how realistic is that they will be able to negotiate an FTA in this short amount of time, 2 to 3 years? Is that even realistic?
It is highly unlikely that the UK and the EU will be able to negotiate a comprehensive trade agreement within these 2 years of that you have under Article 50. It is likely that what we will probably have is an interim arrangement. And then within this interim period, they will continue negotiating this comprehensive free trade agreement between the two sides. And yes, it is likely that it's going to take around 3 to 4 years, the negotiation of a trade agreement between the UK and the EU.
That would be the full deal, takes that long?
The full deal, yes.
What's your latest expectation around what that looks like? Last time we spoke, Luis, you were talking about a free trade agreement, an FTA plus, so plus the financial services, plus all kinds of other things that aren't normally included.
Yes, I think it will be an agreement that will be somewhere between almost complete free trade area and an imperfect single market in different sectors. So you would have sectors that will look pretty much like a single market for specific sectors, and in other sectors are going to be hit a bit more. So there's going to be a hard Brexit for some sectors and soft Brexit.
And which sectors do you have in mind?
I think there's going to be a soft Brexit for the automotive industry, for example, some other manufacturing industries, and perhaps pharmaceutical industry as well. I'm not sure about the fisheries sector. That might be hurt. So it really depends.
Okay.
Most people that we've spoken to differentiate and put it all into baskets. You've got your EEA, you've got your single market, and you've got your FTA. You're saying that there could be an entirely new model here, an entirely new hybrid that applies to the UK as it manages its way through Brexit.
Absolutely. There's no one single model under the free trade agreement model. So you have FTA plus, but you also have free trade agreements that are very limited, and there are some free trade agreements that actually look more like a common market. So this will be unique because the situation and the trade flows between the EU and the UK are unique.
And Vincent, how does that sound from a sterling perspective if we end up with a situation that is, I mean, the CBI was asking for something that's not hard or soft but smooth. Luis was just talking there about something that looks hard for some sectors and soft for others. What on earth does that do to financial markets? What is the expectation at the moment?
Well, as you say, before we get there, it will take some time. I think you have a lot of uncertainty in that process, and probably that doesn't do any favor to the UK economy, and that doesn't help sterling. I think the markets will be worried that it's hard to go around key principles. One, the UK wants to control its immigration, and two, Europe probably doesn't want to give the UK a very nice deal that could be a template for others. I think the markets will be concerned about what that implies, and we don't get clarity on the matter. So longer term, over the coming year, I think that remains a drag on sterling.
Just to build on Luis's thoughts as well, what model do you expect to take shape in the next 2 to 3 years? What's your base case for how this is going to look?
No, I agree. I think that's perfectly sensible that we get to deal that would be very specific to the UK, different to what we have already out there. It will be sector specific, but again, before we get clarity on which sector gets what, it takes time and it creates uncertainty.
Vincent Chaniot, Global Head of Rates and FX Strategy at Societe Generale, stays with us. Thank you, of course, Luis Garcia, International Trade Lawyer
who also stays
at
with us.
Matrix Chambers. I'd like to thank in advance, and that's how it works. Donald Trump, our next story and our top story, says he'll issue notification of intent to withdraw from the Trans-Pacific Partnership Agreement on his first day in office. The U.S. President-elect made the comment in a video outlining a list of executive actions his administration can take on day one.
On trade, I am going to issue a notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country. Instead, we will negotiate fair bilateral trade deals that bring jobs and industry back onto American shores.
The announcement came just days after Japan's Prime Minister Shinzo Abe became the first world leader to meet Trump since his election. Let's get more on this story and speak to Daniel Kincaid, Bloomberg's head of East Asia government. Daniel, What would a U.S. withdrawal from the TPP mean? I mean, this must be a real shock, given that he was just there, Shinzo Abe, at Trump Tower.
Yeah, I mean, well, basically, since Trump's election, a lot of Asian governments have seen this coming, given Trump's rhetoric during the campaign. So I think, you know, Abe's trip, we saw at APEC in Peru over the weekend, a lot of countries, you know, trying to almost pleading with the U.S. to keep the TPP alive and to keep a commitment to free trade in this region. So yes, it is a shock in the sense that Trump's election victory is a shock, but it looks like today, you know, they've got what everyone kind of thought would happen when Trump won.
And how will China react to this then, Dan? Because there's been, you know, China wasn't part of TPP. Does this open up a space for an alternative trans-Pacific partnership that brings in a different set of countries?
Yeah, well, there's been you know, kind of a parallel deal going on at the same time, led by Southeast Asian countries that did include China. That's a 16-nation regional agreement. A lot of people saw this in competition to the TPP. You know, the TPP really went much further than this and had a geopolitical aspect to it. The China-led deals more, you know, just taking down goods and tariffs, but avoiding more sensitive areas like labor laws and environment, where the TPP went into. But we are seeing China move right into that. I mean, they're welcoming this. Obviously, I think the TPP's collapse by itself is good for China.
Thank you, Daniel, for joining us. Bloomberg's head of East Asia Government, Daniel Tenkate, joining us there. Now, let's get back to our panel around the desk here. Vincent Chéniaud, Global Head of Rates and FX Strategy at Societe Generale. Luis Garcia, International Trade Lawyer at Matrix Chambers here in London. Luis, is this a shock? I mean, it's something he talked about in the campaign a lot, obviously. It took a lot of the headlines, and many people looking for clues as to just how much he's going to stick to the rhetoric from the campaign. On this issue, he seems to be sticking.
Yes, and in a way we expected this announcement. It's still shocking because it is an unprecedented political move by any U.S. president in trade relations. So it is a shock. It was expected, but we thought that it might be he would give more of a message of let's look at it again. These are strong words, and obviously I think it undermines the U.S. credibility in the world, especially in the Asia and Pacific area.
Give us a sense of how disruptive this announcement is going to be to global trade flows, and specifically perhaps to the work that's gone into TPP as well.
Yes, many countries spend a lot of time, a lot of resources in the negotiation of the TPP, many years in the negotiation, expecting to have access to the U.S. market. This has all gone, it's dead, TPP is dead, and now countries are going to look into what sort of agreement they can have among themselves. And we already see signs of some countries, like-minded countries in the TPP region, where they have announced that they are likely to have their own agreement.
Yes. Well, picking up on that theme, I mean, this chart, this is BTV 2394. Anyone with a Bloomberg wants to get hold of this chart, they can. U.S. exports to 11 TPP countries have actually been falling. This is falling since 2014. This perhaps going to underline also that there could be alternatives then for TPP. Obviously, TPP without the United States would raise big questions, but an alternative that China leads, would that be something that you would see as likely, or is it too early to say?
It is likely. It is likely that we're going to see China taking a bigger role, a leading role in the region. I'm a bit skeptical about getting many countries involved in an agreement with China, considering that many countries have open markets, transparent markets, and they will seek the same from China. So it would be very interesting how negotiations evolve and the final agreement. But I think this is really bad news for Asian and Pacific countries that negotiated the TPP. because they wanted access to the U.S. market.
Yeah, we'll have to leave it there, of course. Plenty to talk about, Vincent Chagnot, Global Head of Rates and FX Strategy at Societe Generale, and Louis Garcia, International Trade Lawyer at Matrix Chamber.
It is 6:49 here in London. Coming up on the programme, oil is rising as indications grow that OPEC members are closer to a deal on output cuts. We'll drill deeper. That's next. And at 7:20 UK time, we'll bring you an exclusive interview with the CEO of Compass Group as the catering giant releases results.
And at 8:30 UK time, we'll talk Brexit with former UK Business Secretary Vince Cable. Stay with us for that and a lot more. This is Bloomberg. It's 6:53 here in London, 1:53 in the morning in New York. You can't help but wonder what kind of meetings are happening between Donald Trump and all the potential candidates for some of the most powerful positions in the country. All right, futures then, they're currently called higher. Well, that's generic. I'm not sure which future that is, so we'll leave that as it is. And move to oil, which is on the rise again. Brent close to $50 a barrel on signs that OPEC members have made progress towards finalizing a deal to cut output. Now, I know you've heard this before. Goldman Sachs says it's now tactically bullish on the likelihood of an agreement. I'm just looking here at a note from UBS. They're saying that you could be looking at $50 to $55 a barrel if there is a deal. Now, we've put this beautiful chart for you. You can pull it up, GBTV 5068 Go. So what you're looking at here, your blue line, that's your OPEC production. Those are Bloomberg estimates. Your white line, that's your WTI oil reference price. And that shaded blue line, that is the range that they're aiming towards. So 32.5 towards 33 million barrels per day. Yeah, that is what we're looking at. Yeah, and you can see as well that, again, expectations have moved for an agreement. Let's get more perspective, see what other people think about that. Vasilios Giannakis, Global Head of FX Strategy at UniCredit Bank, joins us now on the set. It's as simple as that, deal or no deal. It's as binary as that.
That's right. I think what's currently driving oil and commodity prices in general is, on one hand, these expectations about the potential OPEC deal, as well as the reflation trade that's been going on for the past couple of weeks or so. I think the market may be getting a bit ahead of itself in terms of expectations about such a firm pickup in inflation, but nonetheless, I think it's a trend that it's likely to continue. There's going to be some swings as we go along, but I think commodity prices will remain somewhat supported.
Yeah, and what does that do to your world, to the FX world then, Vasilios? I've got a chart here that shows what we've seen so far this year for the Canadian dollar, the Russian ruble, Norwegian krona, Brazilian real. They've bounced a bit, and there's other factors in there, of course, as well, Trumponomics being one of them, but they haven't all surged on the back of the oil price.
No, they haven't surged, and that's largely on the back of the strong dollar. We've coming out of a theme for the past, if you can call it a theme, for the past couple of weeks or so. The reflation trade in the US, that is going to be supportive of the dollar. Personally, I think that's the wrong way to look at it. I think the dollar is heavily overvalued at this current juncture. I think commodity currencies, you mentioned the Canadian dollar is heavily undervalued, and this rally in oil prices is definitely going to be quite supportive as we go further down the line. I'm not entirely sure we're going to see a massive dollar sell-off as we head into year-end, largely because the momentum is there. But if I was to take a 3 to 6 month view, I'd definitely see the dollar lower.
Okay, lots more to pick up in our next conversation then. Vasilios Giannakis, Global Head of FX Strategy at UniCredit Bank, stays with us into the next part of the programme. Thank you very much to him. Now, up next, we'll get earnings from Compass Group, the caterer, and also Kingfisher. Stay tuned. Lots of breaking news. This is Bloomberg.
Fiscal focus. ECB President Mario Draghi says governments need to step up reforms while he commits to maintaining monetary stimulus. Plus, Corbyn warns against a hard Brexit. The UK Labour Party leader tells Bloomberg pulling out of the EU single market would be very damaging. We bring you that interview this hour. Welcome to Bloomberg Daybreak Europe, our flagship morning show here in London. I'm Yusuf Gamelidine, joined by Anna Edwards.
We've got lots of breaking news to get through. Also, we need to talk about what we've heard overnight from US President-elect Donald Trump, of course, saying that he'll ditch the Trans-Pacific Partnership Agreement in his first day in office. That's having an impact on markets, and indeed Trumponomics more generally having an impact on markets. Stocks rallying like it's 1999. We see the four big indices in the United States going to record highs for the first time since that period. Breaking news coming through.
Yes, let's get you to Kingfisher then. Third quarter sales coming at £3 billion. Third quarter total sales at £2.96 billion. The estimate here was for £2.94 billion, so it is a miss on the total sales. Solid third quarter performance, adding as well that the UK B&Q comp sales up 3.5%. The estimate here was for 3%, so a beat on that front. Remember, this is a stock that has risen 12.2% so far this year, really outperformed the Stock 600 retail index. Out of the 23 analysts, quite a few who are following the stock, 5 have a buy, 11 hold, and 7 a sell. Now, Kingfisher remains confident in the ability to deliver a plan, or deliver the plan. Bear in mind that a lot of the analysts have voiced their concerns about pressure coming through from France in terms of sales there. But again, Kingfisher underscoring that they are confident that they will be able to deliver the plan, and that third quarter trading conditions followed a similar trend. This is key, a similar trend to the first half.
That is interesting when you're talking about a retailer, although I guess the retail environment in the UK has been pretty resilient, hasn't it? Very resilient, despite the Brexit vote. 7:02 here in London, more breaking news, this time from Compass. This, of course, the big contract catering business. They're saying that their numbers, well, many of their numbers coming in above estimates. So full-year organic sales up 5%, underlying operating margin 7.2%. And here's the numbers that are above estimates. So the full-year sales, that's an adjusted number at £19.9 billion. That is above the estimate of 19.5. Reported full-year pre-tax profit at £1.32 billion. That's above the £1.31 billion, or just a shade above at least. Adjusted operating profit, also just a shade above estimates, £1.45 billion, better than the £1.42 that had been estimated. And the outlook, crucial here for these UK corporates. Compass view for 2017 is positive and sees growth weighted to the second half of the year. We spoke recently to Richard Cousins, who is the CEO of Compass Group, and he was saying that he wasn't that worried about the Brexit vote. And indeed, we're going to speak to him again. He's going to be joining us in just 15 minutes or so here on the programme on Daybreak Europe. Richard Cousins, the CEO of Compass Group.
Let's see what's happening with the futures. That's what's on my mind, and this is what we're looking at. So it's a broadly positive open as it stands currently. There, the Euro Stoxx 50 called 0.9% higher. Similar picture across the FTSE 100 and the CAC 40, and also the U.S. futures set to extend those record highs there, up 3 to 4 tenths of 1%.
It seems that excitement, if that's the right word, around Trumponomics certainly lifting global equities throughout the risk radar. You can see what this has done in the Asian session. Over in the US, we talked about rallying like it's 1999, with all of those major indices moving higher. And on the risk radar, you see the Asian stock markets rallying as well. The global rally around oil optimism, around Trumponomics, and around what we've seen from US corporates in this earnings season as well. And as you say, Yusuf, looks as if we'll be stronger at the start of the US trading day as well, with the futures there up by 3/4%.
Meanwhile, dollar yen at 111, currently up 1/5%. Again, rebounding from that earlier quake-induced move as investors focus again on the widening in U.S.-Japan yields. Meanwhile, currently oil trading at $49.38, up 1%. Again, this really doesn't tell the story that we saw over the last few hours. We had moves in excess of 4%. Also, Goldman Sachs saying that the scope for an OPEC deal makes oil a short-term buy. UBS sees $50 to $55 if an agreement is reached.
Let's get the Bloomberg First Word News then for you this hour. President-elect Donald Trump has released a video to update the American people on his transition to the White House and policy changes. Trump says he will cancel restrictions on American energy and will withdraw from the Trans-Pacific Partnership.
On trade, I am going to issue our notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country. Instead, we will negotiate fair bilateral trade deals that bring jobs and industry back onto American shores.
UK Labour Party leader Jeremy Corbyn says business leaders and trade unions have expressed concern that Britain is heading for a, quote, hard Brexit. Speaking to Bloomberg, Corbyn warned over the impact of such a move.
The idea of what I suppose would be called a hard Brexit, where you end up with a tariff war between Britain and Europe, where much more than half our trade is with Europe, would be very, very damaging indeed.
European Central Bank President Mario Draghi said more urgent action from governments is needed to address the structural weaknesses of the euro area. Draghi also pledged to maintain the ECB's current monetary stimulus. He spoke to the European Parliament in Strasbourg.
And, of course, the story in Japan where the country has lifted all tsunami alerts after a magnitude 7.4 earthquake off the coast of Fukushima. Warnings were issued widely, urging residents to flee to higher ground. 5 people have been reported injured and some bullet train services were suspended, but Toyota plants in the region were operating as normal.
The U.S. men's national football team has fired its coach, Jurgen Klinsmann. He came under pressure after 2 painful losses in the opening qualifying matches for the 2018 World Cup. In a statement, U.S. Soccer said, quote, "The form and growth of the team up to this point left us convinced that we need to go in a different direction."
Global News 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. A reminder, you can find more stories on the Bloomberg at Top Go. That's your destination. This is Bloomberg.
Let's check out the live market action then. Juliet Sally has the details. Juliet.
And a pretty good session here in Asia. We have seen a lot of markets close higher. The Shanghai market just closing out the session for the day, up 0.9% back at those 10-month highs. A very good rally coming through here in Hong Kong in late trade, up 1.6%. You're seeing those energy players really lead the gains. Of course, we've got crude oil at that 3-week high. A lot of expectation and speculation that there will be a supply cut deal arranged by OPEC members. So we've seen energy players rally really strongly in the region. Similarly, in Australia, which closed higher by 1.2%, and we are seeing most other markets in the region higher as well. The standout once again has been this rally we've seen in Japanese equities, particularly on the Topix, which has been higher for 9 consecutive sessions. Both the Nikkei and the Topix are both in bull market territory. The Nikkei had a bit of a fluctuating day's trade, but it has closed higher as well, up by 1/3%, and that is really as we started to see the yen weaken late in trade. As Yusuf was mentioning, there hasn't really been any fallout from this earthquake in Fukushima, so we have seen a little bit of that worry flow through and back into the dollar. The yen weakening there, down by 0.2%, 111 against the dollar. The other major currency story of the day has been the PBOC actually lifting the yuan fix, so strengthening the fix for the first time in 13 sessions. You are seeing a little bit of weakness, I should say, in the offshore renminbi, down 0.2%, 6.9147. The renminbi itself fairly unchanged against the dollar, 6.8909 there on the close. Anna and Yusuf.
Thanks, Juliet, with the latest from the market action in Asia. Now, U.S. Federal Reserve Vice Chair Stanley Fischer has urged President-elect Donald Trump to use the power of the public purse to make American workers more productive. Speaking yesterday, Fischer reiterated Fed Chair Janet Yellen's advice that fiscal stimulus should be used to give the economy a short-term boost and address longer-term trends of sluggish growth.
Meanwhile, European Central Bank President Mario Draghi has pledged to maintain the ECB's current monetary stimulus and again called for more urgent action from governments to address the structural weaknesses in the euro area. He spoke to the European Parliament in Strasbourg.
The return of inflation towards our objective still relies on the continuation of the current unprecedented level of monetary support, in spite of the gradual closing of the output gap.
Vasilios Ioannakis, Global Head of FX Strategy at UniCredit Bank, is still with us. Vasilios, just before we finished our conversation in the last hour, you were talking about the dollar. Remind us then of what your expectations are around the dollar. You think it's overvalued.
Sure.
Where does it fall to then?
Right, okay, let me first make it clear from the outset that our view on the dollar does not rely on us being dovish on the Fed. Our view on the dollar relies on the fact that we've seen a surge, especially during the first half of 2015, the dollar, which has brought it way ahead, way above what real rate differentials would suggest. So on a purely valuation basis, I think the dollar is probably on a trade-weighted basis about 10% overvalued. Euro-dollar fair valuation is between 115 to 120. I think there are reasons that are likely to keep euro-dollar a bit undervalued over the next 6 to 9 months, largely because of the political risk premium that will still be priced in. But I think from a trend perspective, the dollar weakness that we've seen, and it is the reality that we've actually seen it for the first 7-8 months of this year, I think is going to resume.
This has gone contrary to what you were predicting, because you were on the set and you said Hillary Clinton is going to win. You said that is if Trump wins, it's going to lead to a weaker dollar. Now, it went completely 180 into the other direction.
It was weaker for a moment.
Yeah, briefly. Yeah, it lasted for what, 6-7 hours before it went through the roof. How has your outlook now changed, and how do you approach the markets to begin with? I mean, for you, this must be a real shock.
Well, it's not just for me. I think it's pretty much for everyone a real shock, right? Over the first 4 or 5 hours, we've had a reasonable market reaction based on the outcome, and then everything completely turned. I think in order to approach this, we first need to understand what is driving it, and I think the market has been entirely focused on the positives that Trump is bringing with him. It's the fiscal boost, it's the deregulation.
But is any of it actually based on policy certainty? I mean, it's all speculative enthusiasm, so maybe if probably, then maybe we could.
Sure, and that brings me to the big risk that the market is actually facing, in the sense that right now the market is being driven by political perception as opposed to economic fundamentals, and as you said, probabilities based on political developments. So I think the risk is that we're going to get a disappointment for the market.
The risk is a disappointment, but maybe not in December. We've got this chart here. This is BTV 3036. For anybody with the Bloomberg wants to pull it up. Death taxes and a Fed hike seem to be the few things you can be certain of. And this in relation to December, where the chances of a hike are now at 100%.
Right.
Although, as Yusuf rightly pointed out,
there are still some tax-free.
Well, taxes are a little less certain under Donald Trump than they were previously. But anyway, on the subject of the Fed hike.
Right. Yeah, I think the market has currently priced in almost with 100% probability a rate hike in December. I think it's going to happen. I think the Fed will do more harm if they don't hike than as opposed to hiking, because if they don't, they will probably signal to the market that they know something over and above what the rest of us know, and it's not good what they know. So I don't think that they're going to go down this road. At the end of the day, the data are not going to show any deterioration. From that respect, I think what's interesting in the chart, I'm not really, I'm not only monitoring what's happening to nominal rates, I'm also monitoring what's happening to break-even inflation and real rates, because to a sharp contrast based on what happened with the taper tantrum back in 2013, when we had a sharp tightening of real rates back then. Right now, real rates have been fairly stable, which tells you that a lot of what's happening into that reflation story is also reflected in break-even inflations. And I think this is something that's going to be very important.
The chart shows the 2-year Treasury yields. The 10-year is currently trading at 2.32%. How much further is this going to go into 2017? Because we had the conversation earlier, and the point was being made, well, it's not really got a lot more to go here.
I think, well...
and then this goes back to, you know, is fiscal stimulus going to happen or not?
Sure. Well, there are so many things you've mentioned. There are so many moving parts here. First of all, let me say the speed of the move that we've seen in U.S. 10-year nominal rates has not been seen even in the taper tantrum. It's been huge, right? We're talking about 50 basis points of tightening in the space of 11 trading days. What levels we're going to see in 2017, I think it's really hard to predict right now, largely because a lot depends on the political decisions that will be taken. Will we get a fiscal boost? We're likely going to get a fiscal boost, but will it be the right fiscal boost, and will it have the amount of and the size that the market currently expects? We really don't know.
And what impact will this have on emerging markets? You mentioned it earlier, Vassilios. You don't think this is quite like tantrums we've seen in the past?
No.
I've got here a chart that shows this is against oil, but you could look for inspiration anywhere. The MSCI Emerging Market Currencies Index in the white, and this, of course, dropping as a result of Trump.
Well, as a matter of fact, if you actually overlaid the performance of industrial and metal prices relative to the rest of commodity prices, you would see that these wedge, that gap there, would actually be much bigger than the one that you're showing right there. I think the elements for a very fundamental weakness in emerging markets are not there based on what's happening in the market right now. Because, as I said, what matters historically, it's real rates. And real rates have not moved by as nearly as much as nominal rates in the US have. Having said all that, again, I go back to the previous point about politics that have taken the driver's seat right now. If Trump goes down the route of protectionism, if goes down the route of sharp restrictions on immigration that are going to have impact on US GDP and therefore on a global scale, then this is not going to bode very well for emerging markets.
And despite his comments last night about TPP, markets still focused on the positives of Trumponomics and not on what this could do to trade flows. So we'll see whether that comes home to roost. Thank you so much for your thoughts this morning. Vassilios Giannakis, Global Head of FX Strategy at UniCredit Bank.
All right, so to come on the program, Compass Group CEO Richard Cousins standing by to talk to us about his company's latest results. Stay tuned for that exclusive interview. This is Bloomberg. You're looking at a live shot of Berlin this morning. It is 7:19 here in London. Euro dollar currently trading lower, down 0.25% at 106.06. What a beautiful number, and that's the Brandenburger Tor as we speak. Here's a story for you, Anna. So the central bank governors of Belgium, Italy, and Germany make more than the ECB's president's annual 386,000 euros, according to data compiled by Bloomberg. Isn't that one hell of a payday?
Nice work. Yeah, indeed. Let's get to Juliet Sally. She's got the business flash for us. Juliet.
Anna, thank you. Lufthansa's pilots are set to strike tomorrow in their long-running dispute over pay. The walkout will affect short and long-haul services from Germany, operated by the airline's namesake brand. It will come after today's action by flight attendants at the group's Eurowings division. Rio Tinto has confirmed that there will be job reductions across its iron ore business in Western Australia. A spokesman for the company also said the outlook remains challenging for the division, but wouldn't say how many positions will be cut. The comments came after the ABC reported that 500 jobs would go. Abigail Johnson is to succeed her father Edward as chairman of Fidelity Investments as early as next month. She has been CEO since 2014 and will maintain that role. Edward Johnson is retiring and will become chairman emeritus. The move comes as the money management giant faces intense competition for assets and clients from rivals including Vanguard and BlackRock. And Daimler has removed an executive of its China Trucks and Buses unit from his position after a car park dispute with a resident in Beijing. The company apologised after the spat aroused anger among social media users and prompted critical commentaries in Chinese state media. And that is your Bloomberg Business Flash. Anna Youssef.
Thanks very much, Juliet Sally. Now, Compass Group, the world's largest contract caterer, reported underlying operating profits for the year that were ahead of estimates. Compass also expects 2017 to be positive. Joining us now for an exclusive interview is the company's CEO, Richard Cousins. Richard, a very warm welcome to the programme, to the set of Daybreak this morning. So you've given a fairly upbeat outlook statement, 2017 expectations positive. Last time you were here, you weren't too worried about Brexit. That continues to be the case then, by the sound of things.
It does. I mean, personally, I wish we were staying in, but from a business point of view, I think Compass is remarkably well placed. Only 10% of our business is in the UK, so that's finite. In addition to which, we're a very low-risk business, and we think we'll do well in most circumstances.
So it doesn't threaten opportunities in continental Europe for you?
We don't believe so. There's no sign that it will.
So just to stay with the Brexit theme, we've got the autumn statement coming up. What are you expecting on that front?
Oh, we're just humble chefs. We don't have an opinion on sophisticated politics like that. We'll do well whatever the circumstances.
But investments in infrastructure, R&D, fiscal spending of any kind, do these kind of initiatives have an impact on your business? You tie to other things?
In the short term, no. I mean, in the long term, who can measure it? But our job is to get into the business of our clients, whether they be in business, healthcare, education, sports and leisure, produce great food, service and all of that. I don't think we're really too concerned about the political environment.
I'm looking through some of your numbers here. 52.5% of fiscal 15 revenue was from North America. So how does Donald Trump fit into your outlook going forward? Does that change anything at all?
We don't believe so. We're a very low-risk business. We are market leaders in the US. We employ now almost 250,000 people there. I think we're about the 9th or 10th biggest employer in the US. So it's a great business for us. Growth is superb. We're not overly concerned.
What's the biggest driver then for your business in the US? When you look at how your business does, maybe revenue or profits, is it all about GDP and just that bare level of growth in the US economy?
GDP is relevant, but in addition to which, the level of outsourcing. And what we're seeing from clients right across the spectrum is that they want our quality, they want our service, and of course they want it at a sensible cost as well. And our scale and our low-cost infrastructure means that we can deliver that for them.
I mean, all the conversations around increased fiscal stimulus, right, so be it in the United States with Donald Trump or even here in continental Europe, that's good news for you, isn't it? That could mean more contracts across the board.
At the margin, yes. I wouldn't want to get carried away because we can't have it both ways. We're a low-risk business that we believe, therefore, the downside risk is finite. Equally, therefore, the upside potential is finite. What drives our business is those outsourcing trends and the ability to drive like-for-like revenue growth by producing better food and service and so on.
And is inflation an increasing concern for you, Richard? Is this something, food price inflation, are you seeing it either now or on the horizon?
Well, if you take a global view, food price inflation is relatively modest at the moment. We Brits are getting a bit obsessed by it because of the weakness of sterling. But once again, only 10% of our business, so we're not overly concerned.
What about mergers and acquisitions, or perhaps more relevant are the acquisitions? Anything on your radar at all?
We continue to do small deals. We're not interested in the big glamorous ones. We think that's not right for our business. We spent just under £200 million in the year just finished, which is slightly above par for us. And we think we'll continue to spend £200 million a year, but nothing big.
What's your strategy for returning cash to shareholders then, Richard? You talk about it being a low-risk business, dividends coming in just ahead of estimates, it seems, this time around. You have had buybacks in the past. What is the strategy?
OK, we're very keen to return any spare cash to shareholders. So firstly, our core dividend, and we increase that roughly in line with earnings every year. Secondly, we do regular share buybacks, and we've been doing that for some years. And thirdly, a couple of years ago, we did a £1 billion special dividend. So our values here are clear. We want an efficient balance sheet, a balanced one. Don't want to overdo it. Anything spare, we'll give back.
OK. Richard, thank you very much for giving us your time this morning. Richard Cousins, the CEO of Compass Group. 7:26 here in London. That will do it for Daybreak Europe. Bloomberg Markets, the European Open is up next. And Yusuf, we've got the futures here in Europe looking positive.
Yeah, it
looks as if we'll be
like
up.
Very much like a green day there. Almost 0.8% for most of these markets.
Yeah, picking up from the Asian session where we saw strength. We saw the MSCI Asia Pacific up by 0.7% towards the close of their trading day. That on the back of the partying like it's 1999 over in US equity markets in yesterday's session. Quick look at US futures suggest we'll be stronger in the US trading day as well. So the European Open show is up next. They'll take you through the start of trading. We'll keep an eye on Compass and all the other corporates who've reported numbers this morning. This is Bloomberg.
Good morning. Welcome to Bloomberg Markets, the European Open. We've got your first trade of the day. I'm Guy Johnson. I'm alongside Matt Miller. He's over in Berlin. This is what we're watching. Trashing the TPP. President-elect Donald Trump lists his executive actions that he will take on day one in office. But will it really make America great again? When doves cry, WIRP hits 100% for December as US equities hit all-time highs. Will Europe keep the party rocking? And Trumpflation, commodities continue to heat up as Goldman Sachs turns positive. With short-term signals screaming overbought, though, what's the right trade right now? We're going to talk about that.
Yeah, we are less than a half hour, Guy, until the open of European trade. Take a look at European futures. Speaking of keeping the party rocking, we're looking at gains of almost 1% here on the FTSE, the CAC, and the DAX. So it does look like those highs that we hit yesterday on all four benchmarks, 3 indexes and 1 average, should continue to carry through Asian markets into Europe this morning.
Yep, Dow's an average. Matt, I think on the call this morning was getting close to calling me a little pedantic on that one, but we'll discuss that later on in the show. Look, equity markets have been rallying and rallying hard. As Matt says, they're likely to rally a little further. The story overnight, positive one. There's the S&P 500, up 0.7%. Currencies continues to be a dollar story as well. Swiss franc down, Japanese yen down. We've got the euro down 0.2%. Metals continuing to rally and rally hard. Iron ore up 6.84%, zinc's rising, lead's rising, aluminium's rising. We've all been talking about copper a great deal over the last few days, and oil also looking fairly positive ahead of OPEC. That's the markets. Let's find out what else is going on. Here's the Bloomberg First Word News. Here's Juliet Sarli.
Guy, thank you. Well, we have seen UK Labour Party leader Jeremy Corbyn say business leaders and trade unions express concern that Britain is heading for a, quote, hard Brexit. Speaking to Bloomberg, Corbyn warned over the impact of such a move.
The idea of what I suppose would be called a hard Brexit, where you end up with a tariff war between Britain and Europe, where much more than half our trade is with Europe, would be very, very damaging indeed.
European Central Bank President Mario Draghi said more urgent action from governments is needed to address the structural weaknesses of the euro area. Draghi also pledged to maintain the ECB's current monetary stimulus. He spoke to the European Parliament in Strasbourg. Japan has lifted all tsunami alerts after a magnitude 7.4 earthquake off the coast of Fukushima. Warnings were issued widely, urging residents to flee to higher ground. 5 people have been reported injured and some bullet train services were suspended, but Toyota plants in the region were operating as normal. The US men's national football team has fired its coach, Jurgen Klinsmann. He came under pressure after 2 painful losses in the opening qualifying matches for the 2018 World Cup. In a statement, US Soccer said, quote, the form and growth of the team up to this point left us convinced that we need to go in a different direction. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. This is Bloomberg. Matt and Guy.
All right, Juliet, thanks very much for that. Now, President-elect Donald Trump has released a video outlining his transition team's list of executive actions on his administration, quote, can take on day one. These include scrapping old regulations, including some on energy, and getting rid of the Trans-Pacific Partnership.
On regulation, I will formulate a rule which says that for every 1 new regulation, 2 old regulations must be eliminated. So important. On energy, I will cancel job-killing restrictions on the production of American energy, including shale energy and clean coal, creating many millions of high-paying jobs. That's what we want. That's what we've been waiting for. On trade, I am going to issue our notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country. Instead, we will negotiate fair bilateral trade deals that bring jobs and industry back onto American shores.
Donald Trump, the president-elect. Market reaction? Let me walk you through a couple of factors that we need to focus on this morning. This chart kind of tidies both of them up. Death taxes and a Fed hike, 100%. That is the probability that we are now pricing in. That is the WIRP here on this right-hand side. You can see 100%, 100%. That is what we're looking at here. The front end of the yield curve obviously reacting to that as well. Again, coming back to me maybe being a pedant, and I have been educated in the idea that actually Fed fund futures are a little less liquid than the OAS swaps market, and maybe that's a slightly better guide. That price is in the 90s, but we're not at 100%. Pay your money, you take choice on that one. I think the Fed probably is going to ignore both of them and make its own mind up. Of course it will. Joining us now to discuss all of this, to get the house view for 2017, UBS is Mark Havelet, the global CIO at UBS Wealth Management. He oversees an investment strategy which basically encapsulates $2 trillion in assets. A man that we want to listen to. Good morning, Mark.
Good morning.
Which should I be listening to the most at the moment? What is going to be the biggest factor for the markets, Donald Trump or Janet Yellen?
I think Janet Yellen is now the focus, right? Because this Fed rate hike, which everybody is pricing in, is the sum total of everything that the Fed sees on the horizon in terms of the U.S. economy. Now we know also the global economy, and then pricing in some of these political divergences that have hit us and that lay ahead.
What are we trying? How are we pricing in the trade story? How do we? Donald Trump is not going to go into this pact in Asia, and you wonder what else he's going to do on the trade front. How much of that kind of positive news that the market seems to be pricing in do I need to discount at the moment in terms of what he's likely to do on day one?
I think the market is looking ahead and hopeful about a lot of things that Donald Trump can do. But as you've pointed out, now some of these other promises are coming through. I don't think the underlying move that we've seen in the equity markets, the reason that the Fed is considering hiking, has that much to do with Donald Trump. I think it has to do with the continued strength of the U.S. economy. So we've got to separate these two a little bit.
One of the things, Mark, that Jim Bullard told me last Friday, St. Louis Fed president, is that tax cuts, fiscal stimulus, and reduced regulations will have a faster effect, a shorter to medium-term effect, whereas the trade issues are going to be a longer-term drag, so not felt immediately. Where do you think investors should go first to take advantage of these short-term gains from tax cuts and fiscal stimulus?
Well, we've been overweight U.S. equities and underweight the high-grade bonds, U.S. bonds like the 10-year, and I think you can stick with that now, not because necessarily that, again, the policies are going to change that much, but because this, in particular, U.S. earnings look like they're going to be improving, if only because the commodity trade is unlikely to fall apart like it did last year. We're starting to see that earnings growth pick up in the United States, and so that's a factor underlying our bullish call on the U.S.
Is that going to help? I mean, look, so many of the companies in the U.S. get earnings from overseas. So many companies on the FTSE get earnings from overseas. Are we going to see European multinationals also start to post better and better earnings as the U.S. economy picks up?
Well, I think that there are some differences. The FTSE's getting about 75% of its earnings from overseas. The U.S. economy is much more insular. But where I think they combine, where if you were going to play European equities, what I would say is focus on those companies that are getting increasing earnings from the emerging market consumer, because we think that the emerging markets are also likely to improve because they've been hit so bad over the past couple of years. And again, they're going to benefit from this commodity turnaround.
I remember talking to Mr. Amosi a little while ago, a couple of maybe 2 or 3 earnings reports ago, and he talked about the fact that clients were sort of paralyzed, that they are nervous, they don't want to commit to any trade. Do you think the game has now changed? Do you think we're now in a new world? Do you think clients are willing to step up and step into these markets? Or are they still so nervous about what they see in front of them in terms of what's happening in Italy, France, Germany, etc.?
I think that, well, first, I'm not going to disagree with our CEO, right?
But the world has moved on, I think, is the point that I'm making.
We've actually spoken recently in our investor forum, and I think he makes a couple of good points about the way that clients see the world. They are still nervous. They've put together many different political and economic events over the course of 2016 and are skeptical that everything is going to work out so well in 2017, and that's kind of why we titled our 2017 outlook the Endgame ? Because so many of our clients are saying, look, we see the high debt to GDP ratios, we see the political unrest. How can this all come together in a way that's potentially positive, or what are the signs that things are going negative? And so what we try to do is work people through our scenario analysis, and you can play along online with our CIO on our CIO website and see how these different forces interact. And I'll just give you one example of that. When everybody thought the world was coming to an end at Donald Trump's initial election, you saw the markets go down, but you also saw that chance of a Fed rate hike getting priced way out, right? Yeah. So you've got so many forces working together in a three-dimensional chess game as we enter 2017. The only thing we know is that different economies are going to take different paths forward.
All right, hang on, Mark. You're going to stay with us. We have a lot more to talk about here on the European Market Open. We'll continue to look into UBS's 2017 outlook. Coming up on the show, Trump's plan to pull out. The president-elect says he'll issue his intent to withdraw from the TPP on his first day in office. We'll discuss what that means for Asia. Also on the program, the ECB president warns that the challenges facing Europe have increased. We'll hear what Mario Draghi had to say about the long-term impact of Brexit. And in the UK, the opposition leader Jeremy Corbyn raises his concerns about the country's decision to leave the EU. Just how damaging could exclusion from the single market be? The UK's former business secretary, Vince Cable, joins us to discuss that and plenty more. This is Bloomberg.
Fifteen minutes of the market opener here in Europe. Let's get you caught up on what you need to know. Here's the Bloomberg Business Flash. Here's Julia Saleh.
Guy, Lufthansa's pilots are set to strike tomorrow in their long-running dispute over pay. The walkout will affect short and long-haul services from Germany operated by the airline's namesake brand. It will come after today's action by flight attendants at the group's Eurowings division. Rio Tinto has confirmed that there will be job reductions across its iron ore business in Western Australia. A spokesman for the company also said the outlook remains challenging for the division, but wouldn't say how many positions will be cut. The comments came after the ABC reported that 500 jobs would go. Abigail Johnson is to succeed her father Edward as chairman of Fidelity Investments early next month. She has been CEO since 2014 and will maintain that role. Edward Johnson is retiring and will become chairman emeritus. The move comes as the money management giant faces intense competition for assets and clients from rivals including Vanguard and BlackRock. And Daimler has removed an executive of its China Trucks and Buses unit from his position after a car park dispute with a resident in Beijing. The company apologised after the spat aroused anger among social media users and prompted critical commentaries in Chinese state media. And that is your Bloomberg Business Flash. Matt and Guy.
Thank you very much indeed, Juliet. Now, we were going to show at this point in time a chart that shows that the three main indices and the average, the Dow Jones average, had all hit 99 highs. Matt Miller thinks that he's got a better chart. So I think, A, we should show that chart, but B, Miller, what is the better chart that you think you've got? I'm not saying it's yours, I'm just saying you found it.
First off, I do have the 4 benchmarks all rising to record highs. And we titled it Party Like It's 1999. Yeah, benchmarks, I think, is the best way to describe them, since you take issue with anyone calling the Dow Jones Industrial Average an index. I get that. That's fair. But what I have, because I heard Mark on the way to break talk about debt to GDP ratios, and I think one of the most interesting points of this new Trump agenda is that he wants to raise spending $1 trillion or spend an extra $1 trillion, and it's going to be difficult. This setup is one of the reasons it's going to be difficult. This is the Reagan era, right? Into Bush, because both Republicans. But right here at debt to GDP, we're about 50%. If you look at the end of Barack Obama, we're at 105% debt to GDP. So we're now fully leveraged and then some. Mark, you know that Rogoff and Reinhart argue with this kind of leverage on our balance sheet here, it's difficult to grow. And I know that UBS expects something like 2.4% GDP growth in the U.S. next year. Are you concerned about this debt to GDP level?
Look, absolutely, the debt to GDP levels create more uncertainty and make the future more volatile because they decrease confidence. But I think what the market has reacted to is, one, that this fiscal spending can increase, and two, that the productivity that we may get out of it, and that was something that the Fed official, Mr. Fisher, was talking about yesterday, could increase. So just, first on this spending, Japan did a lot of fiscal spending to try and stimulate its economy, and it didn't work. And remember, at the beginning of the Obama administration, we were talking about shovel-ready projects. But what I think is there's a belief that this time more projects can be launched because we have a Republican sweep, and both the president and the Congress can try to focus on getting projects through. But also, they've talked a little bit about kind of more public-private partnerships, not just spending programs that are not going to necessarily have a productivity boost in the future. So that's one of the changes we see there, and certainly, what this has really done, and I think the most important thing is, remember, it wasn't that long ago where the central bank claims that this has to shift. We're at the limits of monetary policy, and the governments won't pick it up. Now, this just shifted the narrative, where we have a government that's saying, yes, we may be at the limits of monetary policy. Now we're going to shift the narrative somewhat to fiscal policy, and now markets see a way forward where we do have a different path.
So we're making the transition away from monetary policy. If I listen to Mario Draghi, it doesn't feel like he's ready to shift away from monetary policy. And this is the Bund yield. This is going back to the 1990s, and it's pretty clear the direction of travel, and that has been down. Muscle memory must teach me that is going to continue. What is it that's going to change the narrative when it comes to declining yields? And yes, they popped a little bit in the States, and yes, maybe that's just a short-term story. I just don't know yet whether or not I'm fully ready to commit, and this is a hypothetical, to what has been a very long-term trajectory for the bond market.
I mean, we would see Bund yields more like stabilizing here rather than shooting back up. And I think you're right. I mean, what we've learned from all these different episodes is how interconnected all these bond yields are. So there's a limit to how much, even if things are going well in the United States, there's probably a limit to how much bond yields can rise there when inflation and other factors are keeping yields so low in other parts of the world.
Mark, stick around. We've still got some time to spend with you. Mark Hopefully joining us from UBS. We're minutes away from the market open, 10 minutes away, 9 minutes away to be precise. Up next, we're going to take a look at some of the corporate movers in today's trading, including Rio Tinto. The mining giant is cutting jobs in Australia, citing a challenging outlook. That's interesting considering what is happening. The supply side is still a story in the metals market. We'll talk about that next. This is Bloomberg.
All right, it is just about 7 minutes to go until we see markets open across the continent and in the UK. I want to take a look with just minutes from the open at some of the stocks that may be moving today. Lufthansa is one that you may want to keep your eyes on. Deutsche Lufthansa here in Germany as the pilots prepare to go on a strike tomorrow. So from Wednesday, Lufthansa pilots plan on striking for short and long-haul flights. That is concerning to me because I'm trying to fly to Frankfurt tomorrow. So I guess I'm going to look at Air Berlin or some other option. But the cockpit crew wants raises. The flight attendants have already taken raises. This is the Vereinigung Union. For the cockpit crew, the flight attendants are the Eurowings crew. So look to see delays, even as far, I would guess, as Heathrow tomorrow, Guy.
Yeah, maybe fly Ducati. Maybe that would be the option. Mark's about to jump on a plane to Saudi, so I'm hoping if he's not flying tomorrow that he's not flying Lufthansa. What are you expecting to hear about the oil market?
Well, I think there's two big questions for us as we go to the Gulf now. First, Saudi remains the swing producer, so how do they think short-term about where they want oil prices to be? And then the second question is, with all that oil in the ground, do they see that as an appreciating asset or a depreciating asset? Because that's going to determine.
What do you think the answer to that is?
I think they're starting to hedge their bets on it being an appreciating asset. That's why they've talked about new economic plans, trying to move the economy away from oil. And that's another question, just how far they've gotten.
Great to see you this morning. Thank you very much indeed for sharing so much of your valuable time with us. Mark Haefele joining us. He is the Global CIO at UBS Wealth Management. The market open, the cash open, is coming up next. We expect Europe to continue partying like it's 1999. Stocks set to rise. This is the open. Good morning. Welcome. You're watching Bloomberg Markets, the European Open. I'm Guy Johnson. I'm at Bloomberg's European headquarters. I'm here in London. Matt Miller, of course, in Berlin. We're moments away now from the start of cash trading. And Mr. Matt Miller has your morning brief.
Thank you very much, sir. Trashing the TPP, President-elect Donald Trump lists his executive actions that he will take on day one in office. But will it really make America great again? And when doves cry, WIRP hits 100% for December as U.S. equities hit all-time highs. Will Europe keep the party rocking as markets open? Plus, Trumpflation, commodities continue to heat up as Goldman Sachs turns positive with short-term signals screaming overbought. What's the right trade right now, Guy?
Let's talk about where this market is going. We anticipate that Europe will keep pushing equities higher this morning. That is definitely the trade that seems to be on, judging by the futures. Let's take you to the European Open and to my Bloomberg. As you can see, we did rise a little bit into the auction yesterday, and as you can see, there you go, there's the FTSE 100 opening up. We're up by 0.3%. We're expecting this market to be up by around 0.7%. Keep an eye on the miners today. They're going to be something of a feature, plus some of these oil stocks as well to watch out for. CAC's open. It's rising as well. Not as much. We'll see it go a little bit more positive in a moment. There you go, up 0.7%. Let's break it down. Let's find out what's moving these markets. Here's Nera Chahej.
Thanks, Guy. I'm starting with the gilt markets, which, of course, are opening right now as well. Now, of course, the 10-year Treasury yield pretty much unchanged. We have seen the 2-year yield at a December high, though that, of course, is most sensitive to that Fed policy. Yields have been moving lower in Europe, though, and it looks like 10-year gilt yields going the same way. It looks like we're down some 2 basis points. We're at 1.40% on that 10-year yield here at the open. Moving on to what's happening in the equity space and the sectors, we saw energy stocks and material stocks leading the gains in Asia and leading the gains in Europe yesterday. It is those materials that are outperforming here, up 1.4% almost, of course, with copper hitting its highest since July 2015. Goldman Sachs turning overweight on commodities for the first time in 4 years. Energy stocks, there we go, up 0.9%, with the oil price at a 3-week high as well. But it is green pretty much across the board here, and we're up 0.6% on the benchmark overall. This after yesterday, we actually saw the Stoxx 600 pretty much erase its post-Trump rally. Now, I wanted to show you this chart. It's G#BTV5065. All right, things might not be good if you're looking at European earnings, but they could, of course, be worse. They have been worse because analysts are at their least pessimistic on 2016 European earnings since April. That said, they are still saying that profits are going to drop 2.4% on average this year, but it is an improvement from the 4.5% projection in October. Now, let's move on and see some stocks that we're looking at this morning. I'm starting with Kingfisher. We got some numbers, third quarter total sales beating estimates. Kingfisher also says it remains confident in its ability to deliver its plan. Then I'm looking at Compass Group as well. This is the world's biggest catering company. Now, the Compass CEO has been saying this morning that anything spare will give back to shareholders, and he's not overly concerned about inflation. This, as we had some sales numbers that beat estimates as well for Compass. So these are the two stocks that we're looking at the open. Guy?
Nera, I just want to take everybody just to kind of show you some other stocks that are on the move as well this morning. We mentioned the fact that the miners are likely to be reasonably well bid. As you can see, I've got Anglo up 5%, BHP up 4.5%, FAGS is up 3.8%, Glencore 3.73%, Rio 3.2%. So the miners are definitely on the front foot this morning, man.
Yeah, and so are the indexes and one average from yesterday's close. Check out the chart that I've got here, Guy. Party like it's 1999 is a phrase you're probably going to hear a lot of today. We started using it last night, not really in reference to Prince himself, may he rest in peace, but in reference to all 4 of these U.S. benchmarks hitting a high. For the first time, they've done it together since 1999. Now, the white line here, the purple line here, and the pink line here, those are all indexes. The blue one is the Dow Jones Industrial Average. And if I click out of these here, I can just show you that we're getting closer and closer to 19,000 on the Dow Jones Industrial Average. Right now, well, I guess it was normalized, actually. But right now, we're looking at 18,956. Obviously, the U.S. trade doesn't open for a few hours, but we could hit 19,000 today. Guy?
Yeah, well, let's bring in Manish Singh, Chief Investment Officer at Crossbridge Capital, to get his take. Do you continue bidding this?
Well, I mean, I'm an investor in equity, though I still hold cash, and I'm getting a bit concerned that the rally is going too far, too fast. Now, the reason is very simple, that yes, everyone is putting it down to economics, and I heard you discuss in previous segment about the debt to GDP, but you should also take into account the demographics. So if the debt is going to rise and they're going to do fiscal spending, what sustains that? A working age population. If you compare what it was in 1981, the US working age population was rising at 2% clip. Now it is rising at 0.5% clip. It is expected to rise only by 0.5% 0.1% in 2020. And if you look at what President-elect Trump has promised about unauthorized immigrants, they make up 5% of U.S. labor population. So I think that, maybe, people are pricing is too much of fiscal spending and too much of debt, and that is making the market move too far, too fast.
But it's not going to be that. It's going to be tax change, it's going to be regulation. They're going to get apparently a lot easier, though we'll see how Congress deals with that. That's all going to help. Maybe we're going to get some sort of Homeland Investment Act. That brought back a lot of money. It helped out the big caps. You can see the big caps outperforming the Russell. That's going to help buybacks. There's a whole bunch of factors in here, isn't there? How much cash have you got?
Well, I have almost 30% cash still in the portfolio, right. And this is something that I had raised before the Trump election because I was expecting him to win, but clearly the market rallied rather than fell. Yeah. So even if you get the call right, you may not get the trade correct, and that's the lesson from what is happening now, because you don't have somebody. This is like somebody who's not political, so you're not able to interpret what this person is going to really declare or do something. So for you to think where the dust is going to settle is going to be key. And the market, I think, is running far ahead. And I do see at least one risk event coming up in terms of Italian referendum, which is a big. Now, of course, polls are saying that, there is going to be a no. Now, if you really want a poll surprise, you want a poll surprise on this one for it to go yes. I mean, for market to continue rallying. But if it is no, then it opens a whole can of worms about Euro, stability of Euro and EU, and that is going to cause a lot of consternation.
Manish, what about risks to the upside? I mean, you mentioned that you're holding 30% cash. BlackRock recently did a study showing that the world's investors are holding $50 to $70 trillion in cash. Isn't something going to eventually spur that cash to come back into risk assets?
I think it will. And what I can speak for myself is I'm looking at confirmation, because remember, President-elect Trump does not become president until Jan 20th. And I see a lot of his reforms are going to have big impact more in second half of the year and maybe in 2018 onwards rather than everything happening up front. So I am looking for opportunities to put the cash to play when there is a small sell-off or there is some disappointment, and there's bound to be some, because clearly, people have various interpretations to what his advisors are saying, not exactly what he's saying at this time. So I'm waiting for those opportunities too. So I'm not bearish on the market, but I do see that the risk sentiment, at least in Europe with respect to Italian referendum and the whole election cycle coming up, is negative. So my cash portion is more coming out from, or has come out from emerging market and European allocation, not as much from US allocation.
When you hold that money in cash, what currencies are you putting it in? We just talked to Mark Hefferlit from UBS, who says they expect the euro and the pound to appreciate against the dollar in 2017 because interest rate increases aren't going to keep pace with inflation increases.
See, I mean, for me, fortunately, we are more dollar-based house, dollar-based investment, so I'm holding it in US dollar. But I do see that euro-dollar could appreciate slightly. And yes, the market is pricing it 100%, nearly 100% probability of a rate increase in December. But we also have to see that given how the yields are rising, there is a tightening of financial conditions, if I can put in that way. So some job for the Fed is being done by the market, so which means that you will not really see Fed accelerate and raise rates at the same clip as some are expecting. So you're not going to see a huge rally in dollar. And I think that's one thing to bear in mind, because rally in 1981, dollar rallied by at least 40%, and we are talking about coming on the back of a dollar rally, which is already 19% up, I believe, over the last 4 weeks. So I don't see how much or how further it can continue. So there is definitely room for euro to appreciate.
Okay, I'm just getting this chart ready because I just want to talk a little bit about the VIX. So let's just close that up and get that ready to go. The VIX is trading at 12.42 right now. Market's not pricing in a great deal of volatility at the moment. It's pretty kind of got its direction and it's going to stick with it. The wrong trade? Should I be buying that?
I mean, I would be buyer. I would be buyer of VIX, yes, because I just think that, people are not taking into account what the Italian referendum could really throw. Because if it comes as no, and even 2 weeks ago, Prime Minister Renzi was saying that he's not going to resign, and we saw in Italian press on the weekend that he has expressed doubt if his government can survive. So that opens up a question. Look at the non-performing loans on Italian banks' balance sheet. It's almost 40% of the whole Eurozone number we're talking about. Look at the Italian GDP growth since 1999, since the Euro was formed. It's paltry compared to what you have seen. So there is resentment, and also his reforms are not just about economic reform. It's also about how he wants to change the bicameral legislature to unicameral in a way, because he wants to cut down the power of the Senate.
Yep.
So some people are not voting just because it's about reform. It's about how he wants to govern. So it's very good chances that he might get defeated.
To come even on the programme, how is US President-elect Trump trashing TPP going down in Asia? We're going to go to Hong Kong live to get a view on that. Then, there's a theme here. As Trump touts Nigel Farage as ambassador to the United States, we're going to discuss the future of the so-called special relationship with former UK Business Secretary Vince Cable. And too many doomsayers. We're going to hear why the premium on political risk in Europe could be excessive. All that is still to come. This is Bloomberg. We're 30 minutes into the cash session here in Europe. Let's take a look at where equities are. We are continuing the party started in the United States. We're up by 0.6% on the 600. The London market is outperforming. The reason for that is that the miners are outperforming. And Matt's going to show us that very nicely.
Yeah, I'm taking a look here, Guy, at the individual movers on the Stock 600. I like to use the move screen. I know you like to use MRR, but I feel like this gives you a couple of different views. First off, percentage change. You can see the big gainers are the miners. So Anglo American right there at the top with a 5% gain. But BHP, Billiton, Antofagasta, Glencore, all rising. ArcelorMittal, steelmakers are up as well right now. If you take a look here in this drop box at index points, so who's adding the most to the Stock 600, you can see that Glencore is up at the top, but you also get HSBC in there. So some of the banks are adding some. Royal Dutch Shell as well as BP are also really putting up, because they're such big companies, pushing up the index a little bit. So we do see some oil and gas companies as well as some of the metals and mining companies really making the moves this morning. Now let's go to the Bloomberg First First Word News Desk and hear what's going on around the world with Sebastian Salek. Sebastian?
Thanks, Matt. UK Labour Party leader Jeremy Corbyn says business leaders and trade unions have expressed concern that Britain is heading for a, quote, hard Brexit. Speaking to Bloomberg, Corbyn warned over the impact of such a move.
The idea of what I suppose would be called a hard Brexit, where you end up with a tariff war between Britain and Europe, where much more than half our trade is with Europe, would be very, very damaging indeed.
European Central Bank President Mario Draghi said more urgent action from governments is needed to address the structural weakness of the euro area. Draghi also pledged to maintain the ECB's current monetary stimulus. He was speaking to the European Parliament in Strasbourg. And Japan has lifted all tsunami alerts after a magnitude 7.4 earthquake off the coast of Fukushima. Warnings were issued widely, urging residents to flee to higher ground. 5 people have been reported injured and some bullet train services were suspended, but Toyota plants in the region were operating as normal. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. This is Bloomberg. Guy and Matt.
All right, Seb, thanks very much. Now, Donald Trump, the president-elect, says he intends to withdraw from the Trans-Pacific Partnership Agreement on his first day in office. Trump's comments follow last week's meeting with Japanese Prime Minister Shinzo Abe, who has said there's no point to the TPP without the U.S.
On trade, I am going to issue our notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country. Instead, we will negotiate fair bilateral trade deals that bring jobs and industry back onto American shores.
For more, Bloomberg's chief Asia economics correspondent Enda Curran joins us from Hong Kong. And how significant is this, a failure of the TPP, if it actually happens?
Yeah, well, look, I guess if TPP does fall over, it really is quite a blow to a number of the governments in this region who've put significant political capital into it. You only have to think of Japan's Prime Minister Shinzo Abe, who in fact flew to New York last week to meet President-elect Trump, and no doubt he pleaded a case for TPP along the way. There are other governments who, like Vietnam, who really put a lot of capital into hoping that TPP would bring down tariffs, bring down internal market barriers to sectors that governments here have been trying to get access to in each other's markets. And this was seen as a tonic, the biggest regional deal of its kind in some time. And of course now, politically, all the indications are it's going to be very difficult for that to get finalised, if at all. So it is definitely something of a setback for the US-led efforts in Asia, for sure.
Spheres of influence. Presumably China just sees this as a great opportunity.
Yep, well, I guess that's the flip side of it. Exit stage left the US and entered China. There is this alternative trade pact that's being talked about without getting into an alphabet soup of acronyms. It's called RCEP. It's an ASEAN-led deal, Southeast Asia-led negotiations. It doesn't include America because America doesn't have an FTA with ASEAN. But if that one gets off the ground, it doesn't have all the bells and whistles that TPP has. For example, the tariff reduction is less, and the barriers to internal markets aren't taken down as much as they would have been with TPP. But nonetheless, if that gets off the ground, it just shows you how governments in this region are going to have to increasingly turn to China for leadership. If President-elect Trump goes ahead with his pledges to cut back on trade and to introduce protectionism in favour of bilateral trade deals rather than the big multilateral deals like TPP, for example.
And great stuff as ever. Thank you very much indeed. Enda Curran joining us out of Hong Kong on what is happening with the latest trade story surrounding Donald Trump. And maybe a golf driver doesn't buy you much in Trump Tower these days. It certainly seems that Abe meeting didn't deliver much in terms of the trade story. Manish Singh still with us from Crossbridge Capital. How much do I need to worry as I look at my Asian investments about what is happening with the relationship between the US and Asia, and the fact that China's hegemonic sort of push is going to continue? It will have the ability now maybe to drive its side of the fence and its story at the US's expense.
So in short term, I am not in emerging market at all. So I liquidated my position before the U.S. election, and that was on the back of Trump victory, and that dollar is going to strengthen. So I continue to maintain that. We have seen sell-off in the emerging market debt as well. So I'm not bearish, but I'm not going in at this time because I do expect that the yields are still going to rise, and it is not going to be good for emerging market equities. Only when we see a topping off in the U.S. Treasury yield that you would still start thinking that maybe emerging markets are going to come back. So there will be a level where it falls down to people are going to come and buy the asset class. But to me, as I said, President-elect Trump does not become president until Jan 20th. So there's still some time to think what he's planning to do. And to me, that is the key rather than rush in now and buy emerging market.
Guy, I want to just jump in here because you made a good point about China seeing this as an opportunity. We've got a great function on the Bloomberg ECTR Go, which breaks down world trade here graphically. I've got United States in the drop-down box, and you can see that from the U.S., the biggest trading partner is China, $626 billion in trade with China, then Canada, then Mexico, until you get to Japan. If you plug China into the drop-down box here, you can see that its biggest trading partners after the U.S. are Japan and South Korea. So for China, these Asian relationships are much more important, and they'll be able to take a much stronger advantage of them. Manish, do you think that we're seeing increased isolationism for the U.S.? Is that a definite outcome of the Trump presidency?
Well, I mean, if you look at what Steve Bannon, Trump's chief strategist, is saying, I mean, he's definitely taking a very nationalistic approach where he is saying that, you know, America needs to bring these jobs and these productions back to U.S. Now, I don't know if it is possible to reverse this policy because clearly it's not that the U.S. created the Asian economy. It's also the U.S. relied on cheap labor and funding, especially funding if you see in terms of U.S. Treasury, who owns the U.S. Treasury, and they benefited from that. So I would think that it will be difficult, but it clearly opens an opportunity for China. There's no doubt about that. And I think, as you have seen in Newswire already, that they're trying to drum up support for a local trade deal. And I think also U.S. made a big mistake by not becoming part of AIIB, as you know. I think that was a big foreign policy disaster to me because a U.S.-China cooperative relationship is in the interest of both the parties. But if U.S. tries to play difficult, then China will go ahead and form its own partnership. And you have seen how Philippines and Malaysia and other countries, to the extent even Australia has responded to by talking about doing a trade deal with China. So it is clearly an opportunity for China, but not without pain, because U.S. is a big trade for them.
It is a big trade for them, but Europe's an even bigger trade for them. And I know this, so fantastic function, but what you can do, you just need to do a bit of maths here, Matt, and kind of add a few things together. Germany's only coming in at number 5, but then you've got the Netherlands, the United Kingdom, you've got a whole bunch of countries in there that make up Europe. And if you think about this as blocks, trading blocks rather than individual countries, yes, the US is absolutely massive, Matt, but then you kind of put Europe together with it, and you think about kind of how the relationship with Europe works going forward from here. Europe's not talking about changing any of these deals.
No, that's a very good point, as long as you count Europe as a bloc. Are we going to continue to count Europe as a bloc? I mean,
yeah, I think you should. Well, I think
more people are defecting,
right? But I think you could probably. But I think you probably should put Europe as a bloc. You think about this as sort of trading regions. Then I think Europe becomes a more important factor in this. Anyway, Mario Draghi's probably thinking about this as well, to be honest.
Yeah, absolutely. I was making a little bit of a joke in light of the fact that you are leaving. And, of course, we'll see what happens with the referendum in Italy in just a couple of weeks. And then you have French elections, and who knows how long the EU stays one whole block. Up next, Mario Draghi warns that the Brexit, speaking of, and the U.S. election result will have long-term impacts and calls for fiscal action. Details next. This is Bloomberg.
Welcome back. You're watching the Open European Equities bid this morning. ECB President Mario Draghi says both Brexit and Donald Trump's election will have a long-term impact and that Europe's challenges have increased. Manish Singh still with us. Does that mean more monetary stimulus? Is that what he's signalling there?
Well, I think that he is going to signal monetary stimulus at the December 8 meeting. But clearly, every dose of monetary stimulus will be harder to come by. So I don't expect 12-month extension, but probably expect a 6-month extension to QE.
And you think about how that's going to operate in the markets. How does that, if I'm trading bunds, how do I work that one with treasuries doing what they're doing?
See, I mean, if you look at the inflation numbers, right? So target is 2%, and in Eurozone, you have at 0.5%. So clearly, you know, you're going to see bond yields are going to probably stay where it is because I don't think it's going to change much.
Manish, it's been great to see you as ever. Thank you very much indeed for sharing some time with us. Manish Singh joining us from Crossbridge Capital. Coming up next, Making Britain Great Again, we're going to speak to UK former Government Business Secretary Vince Cable.
Welcome back to Bloomberg Markets, the European Open. I'm Matt Miller here in Berlin. Guy Johnson with me in London. Just about 30 minutes into the trading day here. Take a look at the gains across the board after the U.S. Big benchmarks hit record highs altogether for the first time since 1999, including the Russell 2000 and the Major 3. We see big gains for European stocks as well. Guy, I guess really driven by oil and commodities, right?
Yeah, the miners, like Nara's going to show us what the miners are doing in just a moment, so I'm not going to dwell too much on that. But yeah, Matt, absolutely spot on. Matt, you were bringing this up a little bit earlier on, and that is what is happening with the Dow. So the Dow up here trading at 18,956, and as Matt has been indicated throughout the morning, it is an average, so let's just be aware of how it's calculated, and it's only got a handful of stocks in there. Many of them are industrials. They're doing quite well right now. If you click this box up here, what you get is a fair value calculation in this column here, the percentage misprice. And what that tells us is we are going to be opening up by 0.155 at this point. So we are bid this morning on equities, which should take us up to that 19,000 level, which means that you could see another headline this morning. Today we've been talking about partying like it's 1999, but 19,000 could be the line that we could be seeing a little bit later on. What?
There are no hats made for. There are no hats. No, there are no hats. It's only for the big round numbers. So 20,000. We'll get a hat for 20,000.
Okay, I'm going to hold you to that. If we get to 20,000, Matt, and we're still sitting here talking
I will make
about
a
this
batch.
stuff. Okay, we're going to get
I'll have
hats,
a batch
right?
made here.
Maybe
made in
jackets
Germany,
as
for
well.
sure, yeah.
Made in Germany, okay. So what's going on in terms of driving, as Matt says, is that we are seeing the commodities moving higher. Hats are definitely going to be, we need to be long hats at the moment. What else do we need to be long of? I think the miners, Nara's got the details.
Yeah, Guy, you talk about partying like it's 1999. It's a party in the commodity markets today as well. Goldman turning overweight on commodities for the first time in 4 years. We're seeing copper set for its highest close since July 2015. You can see the miners rallying here. Anglo American up 5.2%, BHP up more than 4%. We're also seeing Glencore rallying, and also in the oil and gas space, we're seeing some outperformance because, of course, we're seeing oil at a 3-week high. London Petroleum up 3.4%. This is the Swedish oil and gas company. Now, this is also after it reported an oil discovery in the Naden prospect in the Barents Sea. But really, it is commodities that you want to be watching in terms of individual stocks and the best performers. Now, I'm also looking at Compass Group today, which is a little bit of a different story, but basically full-year sales were a beat. The company also said it's going to spend 100 million to 200 million pounds a year on acquisitions, and that anything spare is going to be given back to shareholders. Now, earlier we spoke to the Compass Group CEO, Richard Cousins. He told us the company's not overly concerned about inflation and it's positive about the future, adding that he doesn't believe the Trump election will have much of an impact on the business.
And what we're seeing from clients right across the spectrum is that they want our quality, they want our service, and of course they want it at a sensible cost as well. And our scale and our low-cost infrastructure means that we can deliver that for them.
Now, the dividend was a beat as well, but yet we are seeing the stock down 3.4%. Guy, Matt?
Thank you very much indeed. Actually, I'm going to go to let's get a business flash. We haven't had one of those for a while. Let's talk to Sebastian Salek about what we need to know.
Thanks, Guy. Lufthansa's pilots are set to strike tomorrow in their long-running dispute over pay. The walkout will affect short and long-haul services from Germany, operated by the airline's namesake brand. It will come after today's action by flight attendants at the group's Eurowings division. The UK Treasury has sold more shares in Lloyds Banking Group, cutting the government's stake to below 8%. The latest sale raised the total amount recovered to £17 billion of the more than £20 billion that was injected into the bank during the financial crisis. The government says it seeks to cut its remaining stake in Lloyds in an orderly and measured way. US investigators are examining why Credit Suisse failed to tell them about $200 million in undeclared assets owned by a client. That's according to people familiar with the matter. Dan Horsky, a citizen of the US, UK and Israel, pleaded guilty this month to conspiring to defraud the IRS. Credit Suisse could face a new civil or criminal case based on the probe, the people said. The Zurich-based bank and Horsky's lawyers declined to comment. Rio Tinto has confirmed that there will be job reductions across its iron ore business in Western Australia. A spokesman for the company also said the outlook remains challenging for the division, but wouldn't say how many positions will be cut. The comments came after ABC reported that 500 jobs would go. And Abigail Johnson is to succeed her father, Edward, as chairman of Fidelity Investments early next month. She's been the CEO there since 2014 and will maintain that role. Edward Johnson, meanwhile, is retiring and will become chairman emeritus. The move comes as the money management giant faces intense competition for assets and clients from rivals, including Vanguard and BlackRock. And Daimler has removed an executive of its China trucks and buses unit from his position after a car park dispute with a resident in Beijing. The company apologised after the spat aroused anger among social media users and prompted critical commentaries in Chinese state media. And that's your Bloomberg Business Flash. Guy, Matt.
Thanks very much, Seb. Hey, I wanted to just take another look at European equities here. And in light of, the highs that we hit yesterday in the U.S. on the Dow, on the S&P, on the NASDAQ, and the Russell 2000, we're still a ways away from that here in Germany. The DAX is far off of its 12,000 high that it hit back in 2014, 2015. I believe the FTSE high was also around 1999, and we haven't got back to that yet. We're also not looking at volume that we've seen recently. This is a really cool function, SVS Go, and you can use it for any index. Just put your index or your sector up here in the yellow drop-down box, and you can see average volume over the past. Here I have 20 days in green and projected volume, and the Bloomberg is always spot on as far as its volume projections. It's just not going to make it. So we're seeing lower volume, and then you can break it down into sectors and see where that lower volume is from. Less volume in banks, more volume in basic resources and utilities. So it's a very interesting function that helps you break down a lot more than just the price action. Guy?
It's like watching Cousin It. It's kind of what was it with that hand that kind of just comes across?
Just the hand. Is that the Munsters? The Addams Family.
Addams Family, yeah. I think it was the Addams Family. That's what we're watching here. Yeah, Cousin It had the hair. I'm mixing up my Addams Family characters, but the thing, I think, is what Matt is going for here. Yeah. We like to provide a little bit of variety in our programming. Let's talk about a bit more variety. Let me just quickly show you the IMAP. Matt was breaking down the SVS, but let's show you what's happening this morning in terms of the materials, utilities, energy. That's where the real gains are coming through in Europe this morning. Materials, definitely the big gainers. We're seeing the miners doing pretty well this morning. We're seeing some of the oil stocks doing pretty well as well. And this on the back of some big gains. Once again, we're seeing it. Iron ore, copper continues to be well bid. Energy, oil is a trade that you just continue to keep an eye on as we work our way towards November the 30th, and that means I'm going to keep my hand out of this shot. After going with the thing, I think we should probably step away from that. Anyway, up next, could Europe surprise on the stable side? We're going to ask if political risk and the premium is, in terms of where we built that into European assets, is a little overdone. We're going to talk to Mark Cudmore about that from Gadfly. That's coming up next. This is Bloomberg.
Welcome back. I'm Matt Miller in Berlin. Guy Johnson with me in London. In my hand, you'll see a lot throughout the program as well. This is the European Market Open. Is risk in Europe overpriced? Between the Italian referendum, Dutch elections, and the French presidential race, it seems like the road ahead is lined with banana peels. But when examined in isolation, the threat seems less daunting. That's according to Mark Cudmore, Bloomberg Daybreak's macro strategist. Mark joins us now. Thanks so much for your time, Mark. How can traders afford to be complacent, or are they being complacent, I should ask, I guess, with so many risky situations ahead in Europe?
Well, after Brexit and Trump, I guess traders are programmed to look for political risk premium, just like Pavlov's dogs. They now look for it everywhere. And certainly Europe, you know, the one certainty about Europe is that there's always political uncertainty. So it seems like fertile ground to find disasters. But I kind of argue that actually, even though the Italian constitutional referendum in particular, and also the French and Dutch elections provide clear risk, and you can't afford to be completely complacent, most likely the outcome will be actually Europe will get through all these things without major turmoil.
Yeah, there'll be some turmoil, but we'll probably get through it. That seems to be the story of the last few years. The Italian referendum's interesting because, yes, maybe the government does come a little bit unstuck, but maybe what we end up with is some sort of caretaker administration, which in the past has not been a bad story for Italy. So is it possible to put a positive spin on this?
Absolutely. I think, as you say, I think the MPs in the Italian parliament, many of them know that their seats are not safe if there's another election, and therefore they have no incentive to call a general election, which means even if Renzi steps down, most likely there'll be another technocrat government which will kind of continue on and delay a general election by a year. So that's just one of the safety valves. But even if there is a general election and the Five-Star Party are leading the polls, it's unlikely they'll get a majority which will support leaving Europe, as people fear.
What, and we were making light of this earlier, although it's not funny. There could be serious problems in France, in Holland as well, if elections there go wrong. What makes you so confident that they won't?
Well, I mean, certainly Geert Wilders' Freedom Party in the Netherlands are leading the polls there. But again, it's very unlikely he'll form a coalition majority that will support his Eurosceptic ideas. So I think we can be more relaxed about the Dutch one. The French one is a bit more uncertain, but the French political system has inbuilt safety catches to prevent, you know, a protest vote going wrong, as they might phrase it. So while Marine Le Pen is nearly certain to lead the first round of voting, it is most likely that she'll lose in the second round of voting. All the polls indicate that every candidate from the centre-right, which now looks like it'll be Fillon to win that, will beat her in the second round of elections.
All right. Well, those polls have been reliable thus far, so we can, I guess, rest easy. Mark, thanks so much. Bloomberg Daybreak's Mark Cudmore there talking about political risk in Europe. Up next, not down with TPP. President-elect Donald Trump says he is going to scrap the trade partnership on his first day in office. More from his video address next. This is Bloomberg.
46 minutes into the equity session, equities bid this morning, miners in particular well bid this morning. Commodities are rising. Why are commodities rising? Donald Trump. President-elect Donald Trump has overnight released a video to update the American people on his transition to the White House and his policy plans. Mr. Trump says he is going to bring jobs back to America by scrapping the TPP, the Trans-Pacific Partnership.
On trade, I am going to issue a notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country. Instead, we will negotiate fair bilateral trade deals that bring jobs and industry back onto American shores.
Donald Trump speaking overnight, updating everybody on what his plans are. Joining us now on set, Vince Cable, former UK Business Secretary. He will be speaking later today at an event held by the Centre for Progressive Capitalism to discuss what a 21st century industrial strategy can do to rebalance the British economy. Good morning.
Right here.
Global trade seems to be coming unpicked, or at least it's not going to progress from here. Do we need an industrial strategy, therefore, to deal with that? And how does that industrial strategy form itself?
Well, I think the UK desperately needs a kind of stability, structure, long-term thinking. I mean, for many, many years, you know, Britain has operated within very short-term time cycles. That's political, but it's also the way the capital markets work.
Yep.
So you need a long-term perspective for industries like cars and aerospace and pharmaceuticals and even some of the service sectors like universities. And you also need, I think, you know, partnership, public-private sector over innovation, research and development, training, and indeed access to finance. And I think Mrs. May, I mean, we have had our differences with different parties in the coalition. I think she understands that and is keen to get back to the framework of industrial strategy we had during the coalition years.
Wouldn't it be easier to have a long-term industrial strategy if we knew what our membership or non-membership of the EU was going to look like?
Well, we don't. That is indeed the problem, and indeed we have a problem of what has been called radical uncertainty. There's a massive pause.
So you can't have you can't have a long-term industrial strategy with that uncertainty existing.
But if you're in the car industry and you're trying to plan the next generation of engines, or if you're in the aerospace industry and you're trying to build the next generation of you can't just sit around waiting for these issues to be resolved.
So what do you need to know? So what do you think Carlos Ghosn got from Theresa May?
Well, I think what we are getting is a sense from Theresa May that she wants a kind of Brexit light, what some people call soft Brexit, keeping as much as possible of the single market structure, keeping probably the customs union, though that's more controversial. I'm sure that's what the car industry have been promised. And maintaining as much stability and continuity as possible, albeit with the one thing she has to have politically, which is some degree of control over migration, not necessarily the full whammy, but as much as possible.
Mr. Cable, can I ask, I'm confused as to how it would be possible for the UK to expect membership to the single market or entry to the single market without accepting also free movement of people. It seems like it's something that the Europeans will not negotiate on.
Well, that is the central argument of doctrine, and that's what the Europeans say. However, having spent 5 years dealing with the European Union as a minister, I had responsibility for trade. You realise it's actually more complicated. The second pillar of the single market, for example, services trade, doesn't operate on the single market principle. The Germans, for example, largely opted out of most free trade in services, things like professional recognition. So I think the British view would be, OK, they've taken up a tough negotiating position, they're standing on principle, but in practice, we can hope for at least some degree of flexibility, and that's where I would be wanting to start from.
We talk a lot about the car industry, you know, being based so largely in the UK, the European car industry, that is. How much of it is European countries selling into the UK so that the UK can assemble those cars? For example, when Nissan puts together a car that has a turbocharged V6, often the turbochargers are coming over from Germany, right?
Yeah, there is a very high level of integration of the supply chains, and the import content of most British vehicles can be 40–50%, though it has been falling in the last few years. I mean, that is actually why the customs union is so fundamentally important, because if you had to impose a tariff on every widget as it crosses a national frontier and go through all the bureaucratic hassle of identifying rules of origin problems, you know, it would act as a major deterrent to continued investment in the car industry in Europe.
I just want to come back to a function we were using a little bit earlier on. Let me just see if I can get the UK up on this and show you what's going on. So this is UK trade and where it all goes. Now, the bulk of it goes to Germany, then the United States, first and second. There is a view, increasingly it seems within the cabinet, that Donald Trump is going to be great for UK trade. Indeed, we could have Nigel Farage as our chief diplomat. Obviously, having a little joke with you there, because that's certainly not the view, it seems, of the Foreign and Commonwealth Office. Let's talk a little bit about what you think we could be seeing in terms of trade going forward from here. Do you think we could start to maybe mitigate some of the losses that we're going to be seeing maybe with the European Union, with a better relationship with the United States?
Well, I think we need to take it easily in terms of time. There's no way that the British can negotiate bilateral trade deals with anybody until the issues with the European Union have been resolved. So
do you think that's actually going to... Because
well,
there seems to be sort of differing of views on that.
Well, people may be having bilateral conversations on the side, but... I mean, I think the bigger problem is why would Donald Trump, once you put aside the rhetoric, want to set aside considerable political capital in order to have a separate agreement with the UK rather than the European Union, which is many times more important to the US. I think, you know, clearly we're in an immediate post-election phase. Yep. Everybody's very excited. But when you come down to the mundane realities, I mean, the UK is not a major partner for the United States in economic terms. What can they offer us that would make a significant difference to where we are?
But it's politics.
Politics.
The politics is very important to him, it seems, because he made a lot out of Brexit. Yeah. He used the word, and there's a great chart somewhere that shows the kind of the rise in the use of the word Brexit by Donald Trump as we approach the US election. He sees it as being the kind of precursor to what he's just achieved in the United States.
Well, indeed, populism has been a common element in the UK and in the US and indeed in many other Western countries. It's a big jump from having a kind of vague empathy based on this kind of popular sentiment to the nitty-gritty of what you do about particular food standards and what you do about the regulations governing the car industry when you get into trade negotiations. And, you know, all the problems we've had in Europe, for example, in negotiating over many years a trade agreement with Canada, which is a pretty uncontroversial country, I mean, illustrates some of the difficulties when you get into the nitty-gritty.
I wonder, Vince, you know, it's one thing to talk about regulations with the car industry. You have domestic industries in the UK that everyone was promised would pick up again after the Brexit. For example, the fisheries in Cornwall and other coastal areas. Do you think we're going to see those regulations lifted as a result of the Brexit and maybe the domestic economy thrive a little bit more in the UK?
It will take years and years to get a new fisheries arrangement. I mean, it's actually quite a good example, because if you ask, you know, British Brexit voters what are the really awful things about the European Union, fisheries would probably come close to the top of it. However, you know, back in, I think, 2012, a new fisheries agreement was negotiated. It wasn't too bad. Everybody accepts that there have to be restrictions to prevent overfishing in areas like the North Sea. Those problems remain. This is not a frontline issue, and it would be 5, 7, 10 years before a new kind of arrangement came through. And you know, one has to think about new investment over that very long time period.
Just to kind of wrap this conversation up, just to look at it, you talk about your dealings with the European Union. What do you think their perception of us, now that Trump has happened, is? Do you think there's actually a shift? Do you think they're looking at the Anglo-Saxon world as these crazy guys over there? Heaven knows what they're doing. Because we're watching what's happening in Italy, we're watching what's happening in France, or do you think they're watching us incredibly nervously, thinking we're next?
I think there is actually a deep sense of anger and hurt, because the single market, which is the basis of trade relationships with Europe, was a British creation. I mean, the whole idea of free trade in services and goods and free movement of capital and labour, that was a British idea, and yet it's the British who've now walked away from it. And I think that causes massive anger and frustration administration. I think what the Europeans are trying to do is manage their own very, very difficult populist uprisings in Italy, France, to a lesser extent in Germany, while at the same time, having a calibrated, reasonable response to the UK. Because it's not actually in their interests in the long term that we have massive friction with the UK. And I think, 2 or 3 years' time, common sense will prevail.
Vince Cable, great to see you this morning. Thank you very much indeed for joining us. That wraps up the Open. Surveillance is coming up next from Matt Miller and I. Good morning.
Trade-off. Trump vows to shred the Trans-Pacific Partnership deal on his first day in office. Will China move to fill the void? Tax cuts and a Fed hike, two things the markets know with certainty about a Trump presidency. Wall Street hits a high with all four major benchmarks making records. And a plus for Brexit in a world of disrupted trade agreements under Trump. Can Theresa May negotiate a better deal for Britain? We also look ahead to the autumn statement. This is Bloomberg Surveillance. I'm Francine Lacroix right here in London. Good morning to you all. We have a great show coming up. It was said to be the biggest regional trade agreement in regional history, or in history. President-elect Donald Trump now says the United States will withdraw from the Trans-Pacific Partnership. On his first day in office, the statement was included in a video outlining executive actions his administration, quote, can take on day one. We'll break down what it means for America, China, and the rest of the world. Meanwhile, all four major U.S. equity benchmarks stocks climbed to record highs for the first time since 1999 as the market-implied odds of a December rate hike by the Fed hit 100%. We'll bring you the market news that you need to know. Plus, Trump and technology, we focus on what the new White House will mean for investors in the tech space. And as UK Prime Minister Theresa May reaches out to business leaders, we'll also bring you all of the latest on the Brexit debate. But first, let's get straight to the Bloomberg First Word News. Here's Nara Chayich. Hi, Nara.
Hi, Francine. President-elect Donald Trump has released a video to update the American people on his transition to the White House and policy changes. Trump says he will withdraw from the Trans-Pacific Partnership, cancel restrictions on American energy, and get rid of old regulations.
On regulation, I will formulate a rule which says that for every one new regulation, 2 old regulations must be eliminated. So important.
UK Labour Party leader Jeremy Corbyn says business leaders and trade unions have expressed concern that Britain is heading for a, quote, hard Brexit. Speaking to me, Corbyn warned over the impact of such a move.
The idea of what I suppose would be called a hard Brexit, where you end up with a tariff war between Britain and Europe, where much more than half our trade is with Europe, would be very, very damaging indeed.
European Central Bank President Mario Draghi said more urgent action from governments is needed to address the structural weaknesses of the euro area. Draghi also pledged to maintain the ECB's current monetary stimulus. He spoke to the European Parliament in Strasbourg. Japan has lifted all tsunami alerts after a magnitude 7.4 earthquake off the coast of Fukushima. Warnings were issued widely, urging residents to flee to higher ground. 5 people have been reported injured and some bullet train services were suspended, but Toyota plants in the region were operating as normal. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Naira Chehich. This is Bloomberg. Francine?
Naira, thank you so much. Now, this is your data check. This is what overall we're seeing. I want to show you gold out there, and I want to show you some of the equity indices. So we did see a record high for indices in the U.S. You can see the stocks 600 here gaining some 0.5%. I also want to show you dollar-yen, 110.73. We did have a little bit of news on dollar, and this is a picture for crude oil. You can see 48.50. Now, in a video message, President-elect Donald Trump has spelled out 6 areas he intends to act on his first day in office. He started off with trade and his intention to withdraw from the Trans-Pacific Partnership.
On trade, I am going to issue our notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country. Instead, we will negotiate fair bilateral trade deals that bring jobs and industry back onto American shores.
Now, as the U.S. president-elect signals his intention to walk away from the biggest regional trade agreement in history, what will it mean for the rest of the world? Well, let's get a global perspective with Bloomberg's chief Asia economics correspondent, Enda Curran. We're also with our guests, Rob Carnell and Kit Jukes, in just a second. But first, Enda, what does the breakdown of TPP actually mean for the region's economies?
I think it's a negative. I mean, it was already struggling to get across the line anyway. Of course, now we have President-elect Trump's comments are something of nails in the coffin, so to speak. You have to remember that some governments in this region really put a lot of political capital into TPP when it wasn't especially popular at home. You only have to look at Japan. Prime Minister Shinzo Abe, he flew across to New York last week to meet with the President-elect Trump, and I'm sure TPP was part of those conversations. Not just Japan, but countries like Vietnam as well. We're really hoping for this because it would have brought down tariffs, it would have brought down barriers to internal markets, which governments are clamouring for in this part of the world. And now it seems like it's not going to happen. And of course, we know the backdrop is a sweeping tide against globalisation anyway. So it's a real setback for, I think, trade in Asia, and certainly a setback for US influence in this part of the world.
Right, so if the U.S. is actually retrenching from the influence it's had in the past, and what does it mean for China? Can they really step it up?
Yeah, there's an opportunity now. With trade, obviously, it's never as simple as these aren't binary outcomes. It's not just a simple case of China rocking up and filling the gap. But there is an opportunity here. There has been a parallel trade conversation going on around something called RCEP that's led by the Southeast Asian nations, plus China, plus Australia, plus India, plus others, and that does not include the US. Now, all of the focus now is naturally going to shift to that negotiation process, which it's kind of a silver medal to TPP, really. It doesn't offer for the same reduction in tariffs or the same breakdown in barriers to internal markets. But nonetheless, it's a massive regional trade deal. It's probably as good now as these Asia governments can hope for on a multilateral basis. So naturally, the weight of focus shifts to China and China's role in these talks around the RCEP process and what can be delivered on the table there. And of course, if that does get across the line, those talks are ongoing, it will be a massive trade deal that doesn't include America, and that's surely negative for their influence in Asia.
And thank you so much, Enda Curran there, our Chief Asia Economics Correspondent. Now let's bring in our guests for today's show. One is Kit Jukes, Societe Generale's Global Strategist. The other is Rob Carnell, Chief International Economist at ING Bank. Guys, thank you so much for joining us. Kit, to you first. TPP, I know we've had record highs on some of the U.S. indices, but overall, the market is so focused on the fact that it's going to reflate the economy. Are they discounting any damage from trade?
Yeah, I think the immediate reaction to the election was to look at the positives, to assume that some of the things on trade which are negative for growth and as well as being positive for inflation and the sense of pushing it higher would be downplayed. So the first words we've heard don't really sort of help that very much if that's where we're going. I still don't think that's going to outweigh the sense in markets that the Trump program is a boost for growth, higher interest rates, stronger dollar. I don't think it'll derail the equity market, but it's at least a warning to us that there are two sides to this new administration, and in its attempts to get jobs back home, he will be doing a variety of things. I sit rather uncomfortably looking at how much stronger the dollar is than when he first said he wanted all those jobs to come back home. That's not going to help him either.
No, that's certainly not going to help. When you look at yields, that's probably not going to help with some of the funding either. Rob, when you look at how, I guess, this Trump trade war could possibly play out, can it turn ugly very quickly?
Well, it can, but if we can just turn it straight back to the TPP again, it's worth remembering that Hillary Clinton also opposed this. I think during the campaign she said, I oppose it now, I'll oppose it as president, I'll oppose it after the presidency. So the fact that he's now come out and said, yeah, we're going to pull out of this, something that hasn't actually started off yet, it's not in place. Nothing's actually really changed on trade, so perhaps the best market interpretation of this is something that might have happened may not now happen, and we're back to where we were. Yeah. Not really a big deal. Can it turn ugly? Yeah, absolutely it can.
Okay, I mean, the problem, I guess, which is what some commentators are worried about, is that Trump has made threats in saying, look, he will punish China for alleged unfair trade practices, right? The Chinese have so far ignored these.
Yes, and again, this is the rhetoric that we've heard in the campaign trail, and what we're all really struggling to grasp right now is what's he actually going to do? He's said a lot of things. Both candidates, all the candidates said a lot of things in the run-up to this, but what's he actually going to do? So far, we don't really know, because we don't know who's going to be, the important roles, who's going to be Treasury Secretary, we don't know who's going to be Commerce Secretary, and until we get some inkling of that, it's really hard to know whether this really is the sort of soft Trump, the sort of cuddly, warm Trump who'll talk a big game on trade, but not actually really deliver a lot more than words, or whether he's really going to go hard on this.
I mean, has he been cuddly so far, in terms of his appointments, Kit?
Not particularly, no, but, I think... Again, the first thing you get is a herd reaction by markets, and then you need to see something that makes that narrative, if that's the right word nowadays, change. And we'll have to see. I mean, fair enough that TPP hasn't happened yet. It's a bigger story for global trade in the sense that we're past the peak in global trade. Yeah. We're moving to regional trade blocks. There'll be an Asian trade bloc, and the U.S. isn't going to be part of it. But the U.S. will still be the world's biggest importer.
Yeah, and we have more on that, actually. I want to show you a chart, but we'll come back to it in just a second. It shows some of the trade relationships. For example, if I click on China, between the U.S. and China, the U.S.-China relationship in terms of trade, probably, well, second best after Canada and Mexico. Kit Jukes, Societe Generale's Global Strategist, and Rob Carnell, Chief International Economist for ING. Both stay with surveillance. Plenty coming up, including 2 weeks on from presidential election day. And all four major U.S. equity benchmarks are at record highs. We'll assess the market's reaction to the election of Donald Trump, plus trade, Trump and Brexit. As the incoming administration says it plans to quit the TPP trade deal, could it open the way for a post-EU agreement with the UK? And with a policy agenda on regulation, immigration and world trade, we'll also focus on what the new presidency will mean for investors in the technology sector. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua in London. Equities here in Europe higher as that rally from the U.S. ripples through the global markets. Let's get to the terminal for your asset check with Mark Barton. Mark.
Francine, hi. Let's look at the big chart of the day, the chart showing the four major indices hitting record highs yesterday for the first time since 1999. The S&P 500, the white line, the Dow, the blue line, the Nasdaq, the purple line, and the Russell 2000, the red line. Donald Trump's election fueling optimism that he will cut taxes, boost infrastructure spending as well. Oil jumping yesterday on optimism OPEC will cut output. Let's get to the Fed. The meeting is only a matter of minutes away. There's a 100% probability now the Fed will hike rates in December, according to Fed Fund futures. That's a fascinating chart. We had a two-year auction yesterday, drawing the highest yield since 2009 before a sale of five-year debt today. That's the two-year yield versus expectations for a rate hike in December. Talking about oil, surging for a third day today, OPEC members have made progress towards finalizing a deal to cut output. So says the OPEC governor of Libya. This is the price of oil, the white line. The blue channel is the level where OPEC wants to cut production to 32.5 to 33. OPEC production is the blue line. You've got to cut it by at least 1 million barrels a day. Is that achievable? And the dollar rally resuming, Francine, moving towards an almost 6-month high on fading demand for safe assets, which boosted the yen, of course, after that earthquake struck Japan. There you go.
Thank you so much, Mark Barton, there with the very latest on not only these equity moves, but also what a Donald Trump presidency may mean for the future. So Trump is fueling market optimism. Over at Societe Generale, analysts have revised up forecast of U.S. GDP growth and inflation. For more, let's bring in Societe Generale's Kit Jukes and also Rob Carnell of ING. First of all, so we'll get back to the changing of forecasts at Societe Generale in a second. But Kit, it's all to do with equities. Right. At the moment, it's playing out in equities. You play the Donald Trump presidency through equities.
Certainly, we're making highs. He's perceived as being good for some sectors, good for finance, good for the drug companies, for example, but just good overall. More growth, a bit more inflation. What's to worry about? Anybody who hadn't spotted that before the election apparently was missing the scoop.
And this, Rob, is something that you agree with?
Yeah, well, we haven't yet changed our forecast. We're going through that process right now, but the direction is in that direction exactly. It's a bit more growth, a bit more inflation, but not yet. We'll have to wait for it. It's quite a cumbersome process putting together a budget in the US. It takes time. So a lot of promise. The market may run ahead of itself a little bit, and then we may have a slightly testy period through the summer while we're waiting for this stuff to actually come out, and it actually starts to impact on activity. Yeah,
is there a feeling that in certain aspects the markets have just run too fast with it? Because, again, you need to fund this, you need backing from, I know that both houses are Republicans, but you still have fiscal hawks, such as Paul Ryan, and then those yields changing tack is not helping with funding either.
No, and I think, to the first piece, I mean, if he gets everything done he wants to get done, frankly, we'll have significantly higher bond yields, significantly more inflation, and we'll be on a bad path. But you can't overheat an economy, or you wouldn't want to overheat an economy starting from a sub 5% unemployment rate. So there's an assumption that there's some of that. I think we're all right on Treasury yields if they move up more slowly from here towards 3%. A 3% 10-year note yield. Back in 1989, they were a lot higher than that. They were probably short-term rates in 89. I think hit 10% briefly, from memory. But the
good memory.
There you go. So 3% wouldn't be the end of the world. It's the speed of adjustment.
Right.
So I think, but yes, there'll be a move in that.
And this, Kit, is the spread between the German 10-year and the U.S. Treasury 10-year, and you can see that spread actually at the widest since 1989. Again, is this just going to get wider?
No, I think we're near the top. I mean, I think it'll overshoot. I'm not going to turn around and say, oh, look, we're at 2.06. That's the high.
Right.
That would be, we will overspike at some point. But to jump into another market, that's what's driven Eurodollar here. I think as far as the interest rate move, there's a lot priced into that relative move in rates now already, relative growth, and what that drives the currency. That's done the currency move. From here on in, for example, Eurodollar, I think, is all about politics, not about relative rates.
Rob, do you agree?
Yeah, and the politics in Europe, of course, does remain a bit of a break for quite some time. I mean, you were talking about this earlier in the programme. There's a lot of stuff going on there, and for me, it's and I think you mentioned this earlier, the French election is the real one to worry about. What's the two-way race between Fillon and Le Pen going to look like? And is the gap that Fillon presumably will have in any poll, is it big enough when we bear in mind just how unhelpful those polls have been? Got to take into account voter turnout and very differential likely voter turnout in that election.
But okay, when you go back to equities, are equities really supported by stronger earnings? And if you look at some of the TPP or trade, possibly extra tariffs, then it will hurt the supply chain of American companies.
It will eventually. It's a question of how far forwards markets can look. But at the moment, I mean, remember, we're coming into this with earnings picking up again after a period when they were falling. So we've got a tailwind, and we're going to get a growth tailwind for a certain amount of time, and we've got a confidence tailwind, and then we've got some of these sectoral stories that were the first reaction. So you've got a lot of things helping right now. The further you look forwards into the future, the less that gets. So I think we're going to have most of our jam today and less in 6 months, but still enjoy it till Christmas.
Okay, there you go. More marmalade. Kit Jukes of Societe Generale and global strategist there, and Rob Carnell of ING Bank. Both stay with us. Up next, Trump vows to scrap the TPP trade deal. Is this an opportunity or a risk for post-Brexit Britain? This is Bloomberg. is Bloomberg Surveillance. Let's talk more about global trade. What will the incoming U.S. administration and its plans to scrap the TPP trade deal mean for the U.K. as it leaves the European Union? Well, could President-elect Trump's desire to focus on bilateral agreements pave the way for a post-Brexit deal? Let's get more with Kit Jukes from Societe Generale and Rob Carnell from ING Bank. Rob, we've been trying to figure out, actually, whether a Trump presidency means that Theresa May has more bargaining power, either because of security, so maybe the EU needs her more, or because, well, you need a trading partner, and the UK could step in at any moment. Is there any truth in that?
I suspect that Theresa May probably thinks there's more truth in it than Donald Trump really does. I think there's always a sense this side of the Atlantic that the special relationship is really quite an important thing and we can really leverage off that. I think over in the States they go, special relationship, what are you talking about? I don't think they really take it that seriously. So as a hope, but I think I wouldn't want to push this one too far. And let's face it, we don't actually know how long this post-Brexit world is going to be. It could be 10 years after her CBI speech yesterday.
Yeah, what have we learned, actually, from the CBI yesterday, and what are you expecting from the autumn statement tomorrow?
From the CBI yesterday, not a great deal. Theresa May doesn't want to upset the CBI members any more than she's perceived to have done, so she's softened her tone. I think that's just mood. I'm sure that it'd be odd for a Conservative Prime Minister to really be in opposition to the CBI, but yes, she wants to make friends, if you like, and we're not going to get whatever the hardest version of Brexit is. We're trying to lean away from that for a bunch of reasons now. We'll get the numbers on the public sector borrowing numbers in a few minutes here in the UK. They're not going very well. The deficit is, on a sort of year-over-year basis, falling too slowly. So there's very little largesse to give away, and all the noises you're hearing are that there'll be some sort of token moves to try to make some political capital, but there's very little to help the economy.
And we actually don't really need a great deal just now. The data's OK. They might as well save up a bit of this spending power, what little they'll have for next year for the actual budget, when things conceivably could be looking a lot worse.
All right.
We'll need to spend a bit.
Donald Trump's last tweet, late last night. Many people would like to see Nigel Farage represent Great Britain as their ambassador to the United States. He would do a great job. I mean, what do you do with this? Again, you're Theresa May. She's probably on Twitter, or one of her aides is. You look at that and you just ignore. I mean, this is the president of the free world.
Well, she came out and said we've got a perfectly good ambassador already in the United States, which indeed we have.
No vacancies.
No, there isn't a vacancy right now. She'll take it on board that, there's a warmth, there's a willingness for warmth, but that's not much substance behind it, if you like.
Yeah, and also it's very unusual to see a president-elect actually weigh in on who should be ambassador to where.
Donald Trump is not a usual president. I don't think we should expect usual from him.
All right, guys, thank you so much. Very diplomatically put. Kit Jukes, Societe Generale's global strategist, and Rob Carnell, chief international economist for ING Bank. Both stay with us. Up next, with a new policy agenda on regulation, immigration, and world trade, we'll focus on what the Trump White House will mean for investors in the technology sector. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua right here in London. Let's get straight to the Bloomberg First Word News. Here's Nara Chage. Nara.
Francine, President-elect Donald Trump has released a video to update the American people on his transition to the White House and policy changes. Trump says he will withdraw from the Trans-Pacific Partnership and cancel restrictions on American energy. UK Labour Party leader Jeremy Corbyn says business leaders and trade unions have expressed concern that Britain is heading for a, quote, hard Brexit. He also had some choice words for President-elect Donald Trump when I spoke to him at the CBI conference in London.
The idea of what I suppose would be called a hard Brexit, where you end up with a tariff war between Britain and Europe, where much more than half our trade is with Europe, would be very, very damaging indeed. I will make it very clear that I absolutely and totally deplore the comments he made during his presidential campaign in respect of women.
European Central Bank President Mario Draghi said more urgent action from governments is needed to address the structural weaknesses of the euro area. Draghi also pledged to maintain the ECB's current monetary stimulus. He spoke to the European Parliament in Strasbourg. Japan has lifted all tsunami alerts after a magnitude 7.4 earthquake off the coast of Fukushima. Warnings were issued widely, urging residents to flee to higher ground. 5 people have been reported injured and some bullet train services were suspended, but Toyota plants in the region were operating as normal. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Nara Chahich. This is Bloomberg. Francine?
Nara, thank you so much. Now, European equities trading higher this morning. Let's get a picture of the markets now with Mark Bart.
Francine, as Trump talks about undoing TPP and cancelling various energy restrictions, it's worth noting the US balance of trade's worsened since the 1990s. BI says undoing TP would unilaterally impose punitive tariffs on Chinese and Mexican imports and would signal that the US was scrapping its trade obligations, spurring widespread disruption among global supply chains and price hikes for US consumers. Another interesting way of looking at it, according to BI, is failure to pass BP may increase China's influence over US allies. This is an interesting way of looking at it. China, of course, is proactively attempting to grow its influence through its One Belt, One Road initiative. US allies who have worked for several years to pass TPP may be more likely to turn to China for future deals if it fails. This is a chart showing US exports to 11 TTP countries, and as you can see, it's clearly falling. Now, steel and aluminium manufacturers are among US companies that have drawn support from Donald Trump's infrastructure spending plans. He, of course, threatened to penalize China for steel imports, which in 2014 rose to their highest level since the financial crisis. The United Steelworkers Union says imports have contributed to factory job losses. This is the Bloomberg America's Iron Steel Index, which tracks the value of North and South American iron ore and steel producers, jumping 15% the week of Trump's election. Tougher enforcement of trade policies and the $550 billion infrastructure plan are improving the outlook for steel makers. This index is up by 19% since Trump's victory. U.S. Steel, Nucor, AK Steel, Steel Dynamics, some of the companies to watch. And really quickly, as we're talking about steel, as we're talking about Trump rolling back on energy restrictions, he's championed oil, he's championed gas, he's championed coal interests over renewable power from wind and the sun. It's pretty much unclear, though, how Trump is going to make good on his promise to bring back coal mining jobs, which have dwindled amid cheaper natural gas and pollution restrictions in the electric market. As Bloomberg's Tim Lowe said, he can roll back regulations, he can slash government jobs, he can pull out of global treaties, he can strip the tax benefits from renewable energy, but can Donald Trump make coal great again? Probably not, say energy industry leaders and analysts. This is Peabody Energy, one of the largest US coal companies. It rose 49% on December the 9th, the day after the Trump election victory. It's up by 29% since the victory. High hopes for the coal industry, Francine.
Thank you so much, Mark Barton. Mark Barton there with your asset check. Now, in the wake of the U.S. election, tech stocks took a dive on worries about the new White House. My next guest says without immigration, the U.S. tech sector will fall apart. Well, joining us now to talk Trump and technology, Richard Kramer. He's managing director at Arete Research. Still with us, Kit Jukes and Rob Carnell. Thank you so much for joining us. First of all, give us a sense. Are you still worried about the tech sector? And give us the reasoning why. Is it because immigration and visa will make it harder to hire talent, or because the focus will be on hard manufacturing?
Well, I think the number one issue right now for the tech sector is the uncertainty that we have across the entire political spectrum. There are three big issues, I think even more than immigration. One is net neutrality, and there's really only one comment from Mr. Trump about potentially repealing that. Second is privacy and surveillance, because to the extent that the tech industry relies on the internet being seen as a safe space where people can transact and share ideas, certainly the notion that there would be increased government surveillance or limited privacy on the internet would be a big issue. And the third one for the tech sector is obviously offshore cash and the tax policy. And there is now $450 billion sitting in the hands of 5 companies offshore, and about $700 billion overall sitting in the hands of the tech sector broadly. If that money were to be repatriated, that would be a huge impact in the U.S. economy. But clearly that's a big political issue as well, that we don't know how things will lean.
But actually, okay, Richard, if we go back to limited privacy, I mean, would this actually hurt share prices of companies? Your concern is what? And it's very clear, or actually it's not that clear, but in the past he said that he wants, I guess, full power to deal with terrorism, right?
Yes.
So that would, and that could lean towards, I guess, less privacy, but would it actually hurt the companies?
I think there's almost no doubt that Silicon Valley would be united in resisting, as Apple was in the case of the iPhone and the San Bernardino shooter, resisting backdoors or licensed government surveillance that was out in the open. I mean, clearly there's been a number of cases with the NSA about surveillance, but the notion that people can rely on the internet to have some level of privacy, to see whatever content they want to see, transact whatever business they want to transact, I think that's critical to all of the Silicon Valley companies.
But tax repatriation is not necessarily a bad thing.
No, tax repatriation is a separate set of questions, but it has a huge and probably outsized impact on the tech industry because you have companies like Microsoft with $100 billion offshore, right. Apple with $216 billion offshore, Google with $50 billion offshore. If that money were brought back at favorable tax rates, it potentially could be reinvested in the U.S. economy. Yeah. I think one other issue that Mr. Trump has raised and is frankly wildly unrealistic is the notion that you can move all tech manufacturing back to the U.S. The last 20 years have shown that the supply chain sits in Asia. You can't simply, in the space of a couple of years, shift that back to the U.S. And expect that all of those companies would relocate their manufacturing facilities and find the technology talent to drive that industry.
I mean, if you put up tariffs. And I know it would disrupt the supply chain, and it may not be a good thing, but that would be one way of incentivizing or actually forcing companies to go back to America.
That is wildly unrealistic. You can change tariffs at the stroke of a pen. It takes years to build a semiconductor manufacturing facility. It takes years to bring in the talent and train them to work in the leading technology companies. And you look at Facebook, Google, all increasing their hiring not only in the U.S. but also in the UK. These are not done, these decisions are not taken with the idea that something will change tomorrow. They're taken with the need to train people so that in 2, 3, 5, 8, 10 years, they're highly productive for those companies.
We were talking about Theresa May and her speech at the CBI yesterday, and it's very clear that she put innovation technology at the forefront. Are we expecting Donald Trump to actually, I guess, if you look at his to-do list, does he deal with this later? Because he needs to get jobs back, he needs to spend on infrastructure, he's focusing on manufacturing, he's focusing on Asia and possible, ripping up of trade deals, and so technology's way at the bottom.
Technology's part of it, but he's focusing on jobs, and the jobs that, in a sense, the jobs in his heartland are manufacturing jobs. Now, semiconductor manufacturing may be considered a manufacturing job, posh end of manufacturing. We're all going to look at him, in his 4.9% unemployment rate, and yes, you want to create a better standard of living for middle America, but you know, apart from how long it takes to build a semiconductor factory, putting people in it is going to really stress wage growth, and it'll be felt in inflation. Right. At the same time, this is thinking back to last week, but the traffic jams in the Valley in San Francisco would be even worse.
Right. The problem, Rob, is that when you look at, I guess, the voter base of Donald Trump, and when you look at the kind of America that he wants to build, you could also argue that it's people that have felt displaced by technology. Right. So what he's focusing on at the moment, again, to reflate the economy, is far away from Silicon Valley.
Yeah, you're right. I mean, the blame has largely been put on, you know, those pesky foreigners or immigration. But the reality is that, you know, one of the biggest causes of manufacturing job decline in the developed world, not just the US, has been technology. But I don't think he sees it like that. This is much more about trying to get back those jobs that will enable people to fulfill the American dream. And they are typically better paid jobs than anything else they'll get, and there have been a lot of jobs lost in this sector. So you can see why, you know, we're talking about this sort of post-reality or post-truth world that we live in, why you can sell that message. That appeals to the voter. Whether or not it's strictly true is, you know, is neither here nor there in many senses.
Yeah, Richard, is there anyone in the administration or the transition team or anyone that's close to him, a loyalist, that could actually help the tech sector, at least put their points across so that he thinks about it in a different way?
Yeah, I think it's, you know, the one prominent supporter from the tech industry has been Peter Thiel. I think some of his views are, for some parts of America, rather extreme. For other parts of America, welcome. But I think the issue that you're raising is a very basic one, which is, and it's very similar to what we see in the UK with Theresa May talking about the NHS. It would be wonderful to have 100% British NHS. It takes a generation to train those doctors. It would be terrific to take the Rust Belt and turn all of those people who are unemployed into software engineers in hot demand, but that takes maybe not a generation, but it takes years and years of investment and effort. And the question is whether this new administration will have the will to take long-term decisions to make that sort of effort that produces the employees that Google, Facebook, Amazon, and Microsoft are desperate to hire.
Richard, at the same time, he's probably the biggest Twitter user. I mean, he only communicates through YouTube and Twitter. Does that count for anything?
Unfortunately not. I think certainly it hasn't affected Twitter's stock, which I think, as you know, we've talked about on this program. Yeah. We were the only analyst out of 40-some that had a sell rating on the stock. It's gone from 54 down to as low as 13. The company is actually no longer growing. So the fact that Mr. Trump is on Twitter all the time may bring a lot of people to it. The fact of the type of content, the frequently abusive content you see on Twitter, means that it's not a brand-safe platform for advertisers. Now, YouTube is another story altogether. It's a tremendous growth asset. It's very carefully curated compared to Twitter. You don't see the sort of hate speech on YouTube that you do regularly on Twitter. And I think in that sense, it's just a very different asset altogether.
All right, Richard, thank you so much. Richard Kramer, their founder and senior analyst at Arete Research, Kit Jukes from Societe Generale, and Rob Carnell from ING Bank. Stay with us. Stay with surveillance. Plenty coming up, including first, New World Disorder, what a Trump presidency means for foreign policy. Then Trump tears up the script, or at least the deal. Will China fill the vacuum? And in a world of uncertainty post-U.S. election, there is one thing the markets are certain about, and that's a Fed December rate hike. This is Bloomberg. is Bloomberg Surveillance. I'm Francine Lacqua right here in London. Now let's dig deeper into how President Trump might shape U.S. foreign policy. Trump's abandoning of the TPP suggests he will pivot away from President Obama's focus on Asia. In dealing with Russia, President Vladimir Putin has said he and Trump both intend to normalize U.S.-Russia relations. In Europe, questions, of course, have been raised over Trump's commitment to the NATO alliance. So what role exactly will Trump's America play in the world? Well, joining us now is Mark Champion. He's Bloomberg senior reporter for government in Europe and the Middle East. Still with us, Kit Jukes and Rob Carnell. So, Mark, great to have you on the program. What have we learned so far?
Well, I think the first thing we still need to do is a big caveat to say that, you know, we know a lot about what he said in the campaign. We still don't know precisely what he's going to do as a foreign policy. This is a president who has no record. It's a unique situation, so we're going to have to wait and see a little bit. On the other hand, we've started to see some of his team put together. He has a national security advisor now, Mike Flynn, a general, former general. He's looking at a number of other spots. You know, we still need to see who's there, but we can see a lot of generals there. So, you know, from what we can look at with Mike Flynn, we know that he's obsessed with ISIS. That, you know, going after Islamic State is the #1 issue for him. We know that.
Right. So, Mark, does it mean that actually Russia and the U.S. will really come together?
I think that is a very high possibility. It is something that he talked a lot about during the campaign. It was the only thing that he did something concrete about in terms of taking language about Ukraine out of the Republican Party convention. So I think we're going to see him try to do something with Russia. The question is exactly what. If you look at, you know, again, Syria, that fits with a narrative where Trump is going to focus very heavily on Islamic State terrorism. Mike Flynn would fit in with that. So I think, you know, he will try to do something in Syria. For that, he will need to work with Putin.
Rob, I mean, the problem is that if you're the Fed, and I know you don't really care about the relationship with Vladimir Putin until it actually starts affecting you, right?
Yeah.
So we've now priced in a 100% Fed hike in December. How does Janet Yellen see all of this, I guess, turmoil, uncertainty, or foreign policy that she needs to understand the overarching theme on?
Well, I think that with most of these things, these are quite slow burners. So foreign policy is something that will develop over time. We'll figure out exactly what that means. For the US domestic economy right now, I don't think that's going to be first and foremost on her mind. Yes, there's lots of uncertainty, but what they do know is that the US economy is in pretty good shape right now, and it certainly doesn't require rates to be as low as they are right now. They can push another rate hike out, and they can probably squeeze a few more out next year as well. And that's all she has to do right now. She's only got just over a year to go.
What happens after a year? Is she out?
I think so, yeah.
With you?
Well, her term comes to an end, was it
February 2018.
February 2018. I can't really see Trump asking her to stay on. I'm not sure she'd want to stay on, and it's too inconvenient to move anyone mid-term, so I think that's the most likely course of events.
Yeah, you know, I think I've always thought when the Fed talks about international events and uncertainty, I always rather think it correlates very highly with the S&P. You know, when US equities are on a high and the market's priced in a rate hike, the world's fine. You can hike rates safely. And I think that's where we are right now. After that, you know, we wait and see. She might have been more nervous if market pricing for a hike in December was at 50%. That might bother her, or if the S&P was 10% lower, for that matter. But from where we are now, the Fed just carries on as they were, because it all seems fine. At some point, I mean, the only bit that will matter is financial conditions, if you lob the dollar into the mix, are getting tighter quite quickly.
Right, and I guess, Mark, if you look at financial conditions or dollar dynamics, the one really important relationship is U.S.-China. Right? I mean, there's U.S.-Russia, but the one for the world economy that is most important to safeguard would be with China.
Absolutely true. And the interesting thing there is, if you look at countries that have regimes that have defined themselves against the U.S., and that includes Russia with Putin's regime now, and it includes, for example, the hardliners in Iran. They could only see an upside to Trump's election. Hillary was going to be only a reversal for them, something worse than Obama. Trump can only be better for them. And China is in a different situation. China has a very complex relationship with the U.S. It is both, in security terms, a rival. and in economic terms, a trade partner extraordinarily integrated, very dependent. It cannot define itself against the U.S. So they have a much more complex relationship. And if you see what the Chinese have been saying since Trump's election, it has been very consistent. They've been saying, look, this relationship is far too important to you, to us, to screw around with. And I think that, in essence, what they're saying is, if you can do what you need to do with the Russians, you can do what you need to do elsewhere, but with China, you really have to stop and think.
Mark, thank you so much for all of your insight. Bloomberg Smart Champion there, Kit Jukes from Societe Generale, and Rob Carnell from ING. Stay with us. We'll be talking a little bit more about interest rates, but this time from the emerging markets. Up next, as the Trump rally pushes U.S. equity markets to record highs, we look at where the markets might be headed next. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua in London. Let's get some final thoughts with our guests, Kit Jukes from SocGen and Rob Carnell of ING Bank. Rob, if you look at the risks, so we talked about China, we talked about President Trump, we talked about, of course, Russia, but the biggest risk is what? The Trump era means that there's more populism and therefore you worry about Europe?
Yeah, I do still worry about Europe. There's an awful lot of politics on the calendar coming up over the next 12 months, and I think the lesson that we've learned over the last 6 to 7 months is you really can't take anything for granted. And I still get this sense that there's an enormous amount of complacency with people saying, yeah, well, we'll get the politics out of the way and then we'll move on. Well, these are people who said that Brexit wouldn't happen and that Trump would never be elected, and we're dealing with that now, and it turns out that Trump isn't quite such a disaster for markets as people thought beforehand. But In Europe's case, I think there's rather more at stake here, so I do worry quite a lot about that.
What is at stake? That an actual breakup of the Eurozone?
Well, you could, you can create scenarios. I mean, Europe, if Marine Le Pen is president of France, is a very different place from what it is today. A Europe, if you were to have a vote of confidence in the Italian government after the referendum and elections early, would be a very challenging environment. So, yeah, it's another existential threat to the European project. Does it survive it? It's survived lots already, but I won't sleep easily at night. And I don't think markets can sleep easily at night until after the second round of the French election at this point, so on May the 7th. Not sure that the euro can start going up again till then, for example.
All right, I have so many more questions, but we have to leave it there. Come back soon, both of you, Kit Jukes and Rob Carnell. Thank you so much. Kit Jukes from Societe Generale, Rob Carnell from ING Bank. Now, Bloomberg surveillance continues in the next hour. Tom Keene joins me out of New York. Later, we also talk to the former Italian Prime Minister, Mario Monti. We'll be talking about the referendum. He's one of the most prominent figures saying that actually he would vote no to the referendum when it comes on December 4th. So we'll look at the markets. We'll be looking at yields. One thing I know that has also caught my attention is the Fed hike is now certainty for bond traders. Market odds reach 100%. What if they were wrong? What if something happened from now until December? We'll discuss that next. This is Bloomberg. Trade-off. Trump vows to shred the Trans-Pacific Partnership deal in his first day in office. Will China move to fill the void? Tax cuts and a Fed hike, two things the markets know with certainty about a Trump presidency. Wall Street hits a high with all four major benchmarks making records. And a plus for Brexit in a world of disrupted trade agreements under Trump. Can Theresa May negotiate a better deal for Britain? We also look ahead to the autumn statements. This is Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Tom, what an interesting day. Not only because we had a couple of tweets from one Donald Trump, we had a video from Donald Trump, but we also see record highs on a lot of the American indices.
Yeah, I like your certainty idea there, a theme of surveillance this morning, the idea of 100% certitude. It's 100% certitude. You and I got the close memo on blue today. I like that.
There you go. We even match in terms of clothing. What does it mean for our thoughts on the markets? We'll get to that in a second. Yep. Tom, let's get straight to the Bloomberg First Word News. Here's Taylor Riggs. Taylor.
Francine, Tom, Donald Trump has spelled out his policy priorities in a new video. On his first day in office, Trump will take aim at a controversial trade agreement.
On trade, I am going to issue our notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country. Instead, we will negotiate fair bilateral trade deals that bring jobs and industry back onto American shores.
Trump also wants to limit regulation. He says for every new regulation, 2 old ones must be scrapped. Meanwhile, China is calling on Donald Trump to improve relations between the two countries. The Communist Party's newspaper said the U.S.-China relationship is too big to fail, and it said the president-elect shares an obligation to make sure ties between the two improve and not worsen. Japan has withstood a potentially deadly earthquake with relatively little impact. The quake measured 7.4 and struck off the coast of Fukushima. That's the home of the nuclear power plant crippled in a quake and tsunami in 2011. This latest quake briefly knocked offline a cooling system at a separate Fukushima plant. It also caused a small 3-foot tsunami. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg. Francine, Tom.
Taylor, thanks so much. As Francine mentioned, markets up, I guess you could call it. We had Martin Feldstein yesterday really alluding to an asset bubble. His opinion, not ours. Futures continue higher, up 7. They yield 2.29% in the 10-year yield. The euro really doesn't do much. And oil with an advance here, a nice advance on oil back near the $50 level. Let's go on to the next screen. The VIX, 12.31. You even wonder if it's lower. Dow futures closing 956. We had a 19,000 print on Dow futures. 2-year yield higher, 1.10%. That's all you need to know. Yields up, equities up too, Francine.
Yeah, equities up. In fact, stocks rising around the world as crude, but also metals are extending their advance. Again, I wanted to put in actually crude because that's an optimism in the markets that OPEC will agree to cut output. I'll bring it in the next hour, but the Australian dollar also rallying. Again, it's all tied to what the dollar is doing. You can see dollar versus the Japanese yen, 110.75, and it's the dollar, of course, a rally by Trump because of reflating America. That's exactly what the markets are betting on, Tom.
Yeah, let's go to the Bloomberg right now and look at one of the emotions for America, which is buy versus rent and housing. This is new home sales in white and existing home sales in yellow. Down they go from the beginning of the crisis. Whoa, I got to get that in there. Why isn't that doing? There we go. I've got to get my little NFL-like thing here. There we go. Normalized from the beginning of the crisis, and they go down to lows. And they come back, except new home sales have not come back like existing home sales. And that's that wealth divide, Francine, where it's very difficult in America to build affordable, inexpensive, cheap housing. It just doesn't happen. And there's a big gap as we get existing home sales today.
Yeah, I like that. Tom, I did a more plain vanilla chart, but actually it's a very good one. It's the spread between Treasury 10-year and German Bunds 10 years. And you can see it's at the highest since 1989. So we charted it because you see a lot of the indices, the NASDAQ, the S&P in the States were gaining since they were the most record highs for the first time since 1999. If you see the spread, it's really the kind of two divergences that we need to talk about. Now, we're joined by Alberto Gallo, portfolio manager at Algebris Investments, and Sunny Kapoor, managing director at Redefine. Thank you both. When you look at the markets and when you look at indices in the U.S., Alberto, I first just want to, talk about TPP. We'll get to it in a second in terms of the trade, but I don't understand how earnings can go up by so much, boosting a lot of share prices and so equities at a time where actually you don't understand the supply chain or of a lot of companies that will be affected by extra tariffs, possibly.
I think what we're seeing now is animal spirits. People were very concerned about the election uncertainty. They didn't buy stocks, and now they're closing their shorts. The S&P is going up, but then if you look at the earnings, like you said, a lot of these companies in the S&P have 50% international revenues or more. So if you start going on the road of deglobalization, of cutting trade agreements, then that's really bad for large companies. And it should be bad for global growth as well. So you have two angles to what Trump is trying to do. One is reflating America, fiscal spending, and a lot of that we really needed because monetary policy was doing a lot of the legwork. But then you have the protectionism, the populism, the deglobalization, and these things eventually are bad, both for the rest of the world as well as for the U.S.
Fiscal spending was actually claimed for, right, even here in Europe. But how much do we know about what President Trump, when he gets inaugurated January 20th, will be able to spend? How does he fund it? What about the deficit? And actually, if yields go up, it's going to make this job a lot harder to spend into infrastructure.
Absolutely. I mean, one of the central premises behind his infrastructure spending plan was that the U.S. was able to borrow effectively at negative interest rates. And the more that interest rates go up, the more that yields go up, the less attractive it is going to become. But also, just to support Alberto's point, the dissonance between what was expected of an uncertain President Trump, who more or less had the rest of the world, nobody out there, apart from maybe Russia, wanted elected, and the market response, the dissonance between them is just beyond shocking.
And I mean, 51% of Americans wanted him elected.
Exactly. Actually, I mean, if you actually boil down to the percentage of people who voted, it's a much, much smaller percentage, right? And I think the disconnect, and only part of that can be explained by what Alberto said, which was the self-correction that people have been sort of sitting on the sidelines. And the only thing that has got better in fundamental economic terms, in my mind, is that we no longer have a divided government, because Barack Obama was not really able to effectively enact policies for much of his term. And so now you have a united Republican government and a president, and that can actually move things. Now, whether or not these things are moving in the right direction, the longer-term prognosis is definitely bad for global growth, bad for the United States, right, anti-immigration and protectionism. But in the short term, there could be a spike in profitability for American-centric revenues.
All right, Alberto, help me out here with what we're seeing with Mr. Trump and the idea of a one-off move. Just as one example, HSBC suggests we'll see higher rates and that will dampen back to where we were, lower for longer. The mathematics on this, I love doing this with Alberto, the sinusoidal dampening functions. Are we going to dampen back to lower for longer and lower rates, Alberto? Or can we say that Mr. Trump and his enthusiasm is a one-off move in rates, inflation, and currencies?
I think everyone was long rates and duration over the past few months, and the low for longer mantra was so consensus that the market is now, everyone was on the same side of the boat. Now you have someone who wants to inflate an economy, who wants to do fiscal spending in the U.S. You've got Japan also doing the same. You've got the U.K. trying to do the same with with a very undecided Brexit plan, and bond yields have to go up. We have almost reached our targets on treasuries, on German bonds. We still have more way to go on UK gilts. And we've been talking about these bond yields rising for many months. So we're close to our targets. What I'm worried about now is that these fiscal policies may not be sufficient to solve the inequality problem, which has created the global populist wave we are seeing. And so, for example, in Italy or France, where we have votes upcoming over the coming months, you may see a flight from the bond market, right, not because there is inflation, but because there is sovereign risk, right, because there's political uncertainty.
We're going to come back with this in the hour, but Sony Kapoor, let me ask you, and let's bring the bond market analysis and the sinusoidal dampening functions over to your world of international relations. Sony Kapoor, is this a regime change when we see Mr. Trump, the ascent of Le Pen, etc., or is it a one-off move where we return to a more traditional system?
I think in terms of the global trading regime and the global investment regime, this probably does look like at least a sharp discontinuity, if not a sustainable regime change. In terms of the interest rate moves and bond yields, etc., I think that's just too soon to tell. My instinct is that at least some of these big changes are going to reverse depending on when policy unfolds, because the promise of the Trump presidency may not actually be deliverable. And in actual fact, I mean, if you actually look at all the promises that have been made, they are definitely not deliverable. And there is a conflict between congressional Republicans and Trump in terms of stance on fiscal policy. Congressional Republicans are much more hawkish fiscally, and Donald Trump is effectively far looser, I think maybe even than Bernie Sanders would have been.
Right. Francine, I want to keep track of the markets here as well. You see the S&P futures printing 2,200 with the Dow futures printing 19,000 about an hour ago.
Yeah, it's very significant. So we're going to do extra data checks and asset checks throughout the show. Alberto Gallo, Val Debriso, Sonny Kapoor of Redefined both stay with us. Coming up in the next hour of Bloomberg Surveillance, we also speak with former Prime Minister of Italy. He's Mario Monti. That's at 6 a.m. in New York, 11 a.m. in London. We'll be talking to him about the referendum. He's probably one of the most famous politicians asking for a no vote. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keynes in New York. Tom, it was the most interesting day. We heard from Donald Trump via YouTube and then via Twitter, and then we also need to look at the ramifications of the markets. But first, let's get a corporate update. Let's get straight to the Bloomberg Business Flash. Here's Taylor Riggs. Taylor.
Francine, Tom, Credit Suisse is facing the U.S. tax investigation over undeclared accounts. That's according to people familiar with the matter. In 2014, Credit Suisse pleaded guilty to helping Americans cheat on their taxes. At the time, the bank promised to help the U.S. find suspicious accounts. Now investigators want to know why Credit Suisse didn't tell them about $200 million in assets owned by an American client. The bank isn't commenting. Volkswagen will start making electric cars in North America. Production is likely to start in 2021. VW is trying to rebuild its tarnished image following that diesel engine emissions scandal. Last week, the automaker reached a landmark agreement with workers to cut as many as 30,000 jobs and save almost $4 billion. And that's your Bloomberg Business Flash. Tom, Francine.
Thank you so much. Taylor Riggs there. Now, President-elect Trump released a video on YouTube where he spelled out policies for his first 100 days of office.
On trade, I am going to issue our notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country. Instead, we will negotiate fair bilateral trade deals that bring jobs and industry back onto American shores.
That was President-elect Donald Trump. TPP is a trade deal between the U.S. and 11 other nations, including mostly Asian countries. The deal does not include China. So if the U.S. abandons TPP, could China actually step in? Well, Enda Curran is Chief Asia Economics Correspondent for Bloomberg News. Still with us, Alberto Gallo of Algebris, Sonny Kapoor of Redefine. Enda, let's kick it off with you. Thank you for joining us. First of all, I mean, is this, a concern for a lot of Asian economies that were to benefit from TPP? And actually, do you automatically assume that global growth will take a step back if this is removed?
Oh, I think it's very definitely a setback for the Asian economy. And remember, the Asian economy is the biggest growth driver globally right now. You only have to look at the list of losers: Japanese car makers, New Zealand farmers, Australian iron ore producers and pharmaceutical makers, and of course Vietnam's clothing industry. In fact, Vietnam is the star of the Asian economy. It's probably one of the biggest losers out of all of this. So I think the potential death knell for TPP is undoubtedly a setback for trade and regional integration in this part of the world.
Okay, so and as the U.S. retrenches, is this a gift almost to China? Can they just step in and fulfill that vacuum in Asia?
I think it's very definitely an opportunity for China. Now, trade deals are not simple, as we've seen with the TPP now close to falling over, but there is a process going on in the background in parallel almost called the RCEP, which is being run by the Southeast Asian nations, but China has a big say in that, the US does not. So naturally, the Asian governments here now, in despair of what's happened to TPP, are going to swing back to China to look for leadership in getting a multilateral trade deal done in this part of the world. And that's why it's very much a gift to China if they can now get RCEP across the finishing line.
And very quickly here, I want to go to Sonny Kapoor off of this idea. Is Beijing a zero-sum philosophy? Are the leadership in Beijing doing a neo-mercantilism? Do they believe in a zero-sum world, or do they believe in a more modern theory of an expansive trade world?
I think there's somewhere in between. Well, you only have to listen. In transition between these two worldviews, having realized the virtues of having a fair global system from which they have benefited enormously. And one only has to look at the very bizarre Financial Times headline where China actually was chiding the United States to continue to fulfill its obligation under the Paris Climate Change Agreement. I mean, who would have expected that? And the RCEP is actually a much more traditional trade agreement which reduces tariffs significantly, which is something the TPP was not going to do, and includes India. Well, so it has a much bigger potential positive impact for growth. And if the TPP's collapse actually provides a stronger incentive for RCEP to go ahead sooner, this may actually be a net positive for short-term growth in Asia.
And what do you see in Beijing? Are they working under the assumption of a zero-sum world?
Well, just listen to what President Xi Jinping said at the APEC summit at the weekend. He spoke of the need for global coordination in terms of boosting trade around the world, and he promised to bring down their own barriers in China to allow foreign investment into China. Of course, that's what he's preaching. Whether or not they deliver on their words and rhetoric, we'll just have to wait and see, I guess. We've got a big year of political change in China, so there's a lot of onus on them to deliver on the reform front.
And thank you so much, Enda Curran there from our Hong Kong bureau. Alberto, the problem is that China so far has ignored Trump's threats to punish them for this allegedly unfair trade practices. When will that stop? When will they get heated?
I think we need to be very careful about this, because so far China has tried to depreciate its currency very slowly. Now, in the past, when we saw depreciations, these created a shockwave across all emerging markets. It hasn't happened so far. The market has not focused on the risks of this. But it could happen in the future if, for example, the Trump administration imposes tariffs on imported goods, which is part of their plan. So they were pledging a 15% tariffs on Chinese goods. So imagine what happens if they do that, and then, on the other hand, China responds with a 15% depreciation in the yuan, which is then followed by 15 or more % depreciation in all the other emerging market currencies, which have dollar debt, so it becomes harder to repay. So this can create a big tantrum across markets.
Let's come back on this with Alberto Gallo and Sonny Kapoor. In our next hour, Kermit Schoenholtz of NYU Stern School of Business will join us. We should note also the 2-year yield 1.10%. Dow futures right up near 19,000 this morning. Stay with us worldwide. This is Bloomberg.
To make sure there is market access for British companies to have trade with Europe, and that the rights that have been gained through European membership will be defended and continued, and that we intend to work with Europe in the future. The idea of what I suppose would be called a hard Brexit, where you end up with a tariff war between Britain and Europe, where much more than half our trade is with Europe, would be very, very damaging indeed.
UK Labour Party leader Jeremy Corbyn saying a hard Brexit would be damaging. Well, we're back with Alberto Gallo, Al Jabriz and Sonny Kapoor of Redefine. Sonny, so we caught up with Jeremy Corbyn yesterday on the back of that Theresa May speech at the CBI. What have we learned about Brexit? Actually, does the Donald Trump presidency give her more of a bargaining power, either because she can help with security or either because actually she could help with some trade deals?
Not at all, I think, because the UK's obligations in terms of security are under NATO. They are not related to the EU's membership. So unless Theresa May is ready to bargain the UK's NATO membership in order to extract leverage with the EU, security is completely irrelevant for the discussion. In terms of what Trump's presidency means, is there was a liberal case for Brexit, one that didn't add up, but there was a case that said that the UK would be freer to trade. But what Donald Trump has done is the regime change is that the world has become far less friendly to open trading, open investment regimes. The global rules are no longer, can be taken for granted. So in fact, if anything, the UK has a stronger economic and political case to be closer to the EU than actually go out into the big, bad, increasingly uncertain world by itself.
I mean, talk about new global rules. We have this tweet, Alberto Gallo. Donald Trump, actually his last tweet of the night yesterday, saying many people would like to see Nigel Farage represent Great Britain as their ambassador to the United States. He would do a great job. I've never seen a tweet like that before. Does it go to the special relationship between the US and the UK, or is this just completely different? Maybe bromance?
Well, it's a good idea. He would probably be very good at that job, and he may do less damage there than here. Because the problem is that we still don't have an economic plan for the UK under Brexit. There is no plan. There was also a BBC article about that. So I think that's the key. And we are in a much more uncertain environment because now Russia has more of a free hand thanks to the inward focus policy of the Trump administration.
And Tom, I have to say, the spokesperson for Theresa May was very quick to react, saying we don't have vacancies for the moment for any ambassadorial role.
Well, it is a new era, to say the least. Soni Kapoor, thank you so much. She is with Redefined. Coming up here in a moment, Sri Kumar of Sri Kumar Global Strategies. Kamal Sri Kumar on Donald Trump's 4% economy. From London, from New York, this is Bloomberg. thrilled you're with us. Bloomberg surveillance. There is Mr. Trump's New York. I was down Fifth Avenue briefly yesterday, and there's almost a celebratory feel to it. Lots of tourists, international tourists, gazing upon the Trump Tower, a big sign above the front doors saying open from 10 till 6 or whatever. Maybe no, it's not. Yesterday, media executives and anchors greeting Mr. Trump as well in what was a sporting meeting. We continue on the president-elect with our Bloomberg First Word News. Here's Taylor Riggs.
Tom, Francine, Donald Trump plans to move quickly once he takes office. In a new video, Trump says that on his first day in the White House, he'll start the process to get the U.S. out of the Trans-Pacific Trade Agreement. He'll also take aim at regulation.
On regulation, I will formulate a rule which says that for every one new regulation, 2 old regulations must be eliminated. So important.
The president-elect says he'll also cancel what he calls job-killing restrictions on coal and shale energy. Canada's Prime Minister Justin Trudeau will speed up the planned elimination of coal-fired power plants. The government now says Canada will phase out traditional coal power by 2030. That comes as U.S. President-elect Donald Trump says he wants to back out of climate deals and boost coal production. And a new report warns that Britain's National Health Service is facing potentially crippling problems because of the biggest deficit ever. The health service's deficits more than tripled to $2.3 billion in the most recent fiscal year. The British government spending watchdog warned that money needed to improve buildings and software will have to be reallocated, and that may affect care. Japan has withstood a potentially deadly earthquake with relatively little impact. The quake measured 7.4 and struck off the coast of Fukushima. That's the home of the nuclear power plant crippled in a quake and tsunami in 2011. This latest quake briefly knocked offline a cooling system in a separate Fukushima plant. It also caused a small 3-foot tsunami. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg. Francine, Tom?
Taylor, thanks so much. Alberto Gallo was at RBS, now at Algebris. And we want to dive into the market view right now with Alberto. Bring up the chart, Anthony, if you would. This is a chart we showed 4 or 5 years ago about 3 times a day. This is the Spanish German spread, the difference in yield between Spain and Germany, and all you need to know is Alberto Gallo loaded the boat right there and did better than good in trying to game how rates would come down for Spain, Italy, Greece, and the rest of them. And the major question, Alberto, is we're down here now, and what does that symbolize for the old and the new levels of Spain? Is it a new regime for Spain? Is it all clear for Spain?
It's a low, and you're supposed to be cautious. Spain, fortunately, has a stable political situation. But generally, what we're going to see in Europe is the emergence of the same populist wave that we have seen in the UK and the US. I think the next weak points, the next vulnerable countries are Italy and France. So that's the areas where we're more worried about the rising yields and in spreads. Now, Italy goes to vote a referendum on the 4th of December. About simplifying the constitution and simplifying the government, but this vote has been painted by the opposition as a way to kick out the current government, a little bit like Brexit was painted as a way to kick out the former UK government. And then you have in France the risk of Le Pen rising, while the current leading centre-right candidate is very harsh on economic policy.
Is a general statement. And Marty Feldstein was on yesterday talking about asset bubbles. Professor Feldstein with real concern about elevated markets. Do you agree with that? Are markets frothy, or is there value there in the Gallo bond space, or for that matter, the non-Gallo equity space?
We have been cautious on bonds. We've been calling for this bubble to deflate for many months, and particularly, we're worried about Italian bonds, we're worried about French bonds, and about UK bonds. Here in the UK, inflation expectations are 3.5%. You're getting 1.4% on gilt 10-year yields. So there is no value in bonds. You've got to be in a type of investment which is positioned for a rising inflationary environment and a rising bond yield environment. And currently, bond funds are not set for that environment because they were all long, they were all in a lot of ETFs, were all passive strategies, and as an investor in those funds, you're a sitting duck.
Right, but Alberto, we need risk back on the markets, right? What the ECB has done, and rightly so, is to give time for fiscal spending so you don't price risk when you look at bond yields anymore. This has to come back if we're going to keep in check some kind of populist measures which are counterproductive.
Yeah, but risk. Buying bonds is not really a risk trade. It's when you think growth is low.
Well, certainly not at the moment.
Yeah, if you think growth is low and central banks are going to keep the world from falling apart, you buy bonds. If you actually think that there is some growth in fiscal spending, then you start buying. Either you buy high yield bonds, or you buy stocks, or you position for a steeper yield curve. You buy banks and insurance companies. You buy all those things that people were not looking at because they were linked to growth. Remember, even in equities, people were buying utilities and telecoms, which was a dividend trade. It wasn't a growth trade. So we're seeing a huge rotation now.
Right, but you remember probably as much as I do, there was a point when Silvio Berlusconi was in charge, there was no growth, but actually the real opposition wasn't political, it was the bond market that kicked him out. Right, and we had a technocratic government. We don't have that anymore.
We don't have that, but Draghi is leaving in January 2019. If we have a no vote in Italy and if we have Le Pen rising in France, the whatever it takes pledge is not going to work as well. So we could still see Italy's spread going above 200 against bonds and France spread going around 100 against bonds if there is a no vote at the referendum in Italy, which is possible, or if there is a chance of Le Pen higher than 30%, which is starting to become true. And this is the real issue. Inequality leading to populism. Monetary policy hasn't solved the problem.
Yeah, I want to sum this up with economics here, Alberto. I think this is just absolutely critical. Let's bring up the Francine Lacroix chart. This is nominal GDP in Francine's Italy, and it's not a pretty story. There is the presidential 4-year moving average of the animal spirit of Italy, and it ain't there. Do you see, with Davide Serra, do you see, Alberto Gallo, any indication of economic growth, or does Mr. Trump and Chancellor Merkel and others have to work within a no-growth analysis?
I think it's very different. I think in the U.S. we're going to see stronger growth because some of the fiscal policies will have an impact. In particular, if you do infrastructure spending, you spend $1, you increase GDP by around $1 or maybe even more. If you cut taxes to the 1%, then you don't have that same effect. But infrastructure spending is good. In the UK, you're probably going to see the same, although inflation is going to outpace GDP because the pound is weak and there's a lot of uncertainty. So, but in Europe, Schäuble, the German finance minister, yesterday said we're going to double the Juncker plan. The Juncker plan is only 0.1% of GDP, so you actually need to make it 10 times bigger to have an impact. So in Europe, there's a problem.
Yeah, that factor analysis is important. Let's finally look at the euro here, and I look at the markets, folks, with Alberto Gallo. Alberto, do you just assume a dash through parity once, twice, 3, 4 times? We've made the dash to parity. Is a weaker euro the solution for all these different issues?
I think it helps, but it's not the solution. It helps, and we are going to see another dash to parity. I agree with you, as you suggested. But I think the weak euro helps Germany, helps some countries, some businesses that export. But you really need inclusive growth policies. So you need some spending in infrastructure. You need some spending in the periphery countries that have done austerity, like Greece or Spain or Italy, because now the divide in growth between Germany, which benefits the most by the weak euro, versus the other countries, is too large. And if the other countries all vote for populist governments, then there's no more Europe.
Euro parity with the dollar, will it ever happen?
Yeah, I think euro parity is in the cards, especially if you see a no vote at the Italian referendum or if you see Le Pen rising in France. All these trends are going to weaken the euro, definitely, and increase spreads in peripheral bonds.
All right, there you go. Alberto Gallo saying euro parity, Tom, possibly in the cards, depending, of course, on the outcome of this referendum in Italy, December 4th. Now, coming up in the next hour of Bloomberg Surveillance, we speak with the former Prime Minister of Italy about the referendum. He's Mario Monti. That's at 6 a.m. in New York. That's 11 a.m. right here in London. We'll go through the referendum. We'll talk about reforms. We'll also talk about Brexit. This is Bloomberg.
morning, everyone. Francine Lacroix in London. I'm Tom Keene in New York. It is, as Francine mentioned, it is a really nuanced day today. We're going to haul in here right now Sri Kumar Global Economics and Strategies, to speak to us about his caution on GDP. We're going to do GDP later, but right now we've got to do the yield reset. And Francine, that 100%. Francine, 100% certainty.
100%.
That, well, they're going to do something in December as well.
Yeah.
Sri, wonderful to have you here. How did we get here? I thought Chair Yellen was evidence-based and was maybe even waiting for the December jobs report.
I think the changes were, one, you had the unexpected election of Donald Trump November 8th, confounding most pollsters. And secondly, you had a very dovish Fed. And it's important to note as well, one of the Fed governors, Tom, Lael Brainerd, was a contributor to the Hillary Clinton campaign. You have all of these issues. The changes mean that, again, since Trump has already said that he will not renominate Janet Yellen to the chairmanship, you're likely to have a change in early 2008. And you have the bond yields which have risen, which means they're going to drag the Fed behind with them. The Fed cannot resist hiking now.
Sri, you know what confounds me? What confounds me is that, so Donald Trump has been elected. We knew that he was going to do fiscal spending. Nothing radically has changed from his campaign. And yet, a week before the election, every single market participant we had on the show was saying, well, look, if Trump gets in, it means there's no chance of a rate hike in December because the Fed will be spooked. What's happened?
I had been saying the opposite, that if Trump was elected, and I didn't think he would be, but if he was elected, it looked like it was highly likely that the Fed would increase interest rates in December, Francine. And the reason is that, again, the political reason that the Fed has had for not hiking for a long time is now over. So if he comes in and the conventional expectations are turned on their head, Janet Yellen and her colleagues are free to hike in December.
Right.
And now I anticipate probably at least 2 more hikes next year.
Okay, so that's a big change for you, and we'll get to the GDP call later, and, you know, the theater of Sri Kumar saying Donald Trump's wrong. I like that as an angle here. But what is so important here is where we are from Stanley Fischer's ultra-accommodative. We're still ultra-accommodative, right? Even with the December hike.
Right. We are ultra-accommodative.
What are we waiting for 2017? Why is this a Fed pausing? Is it to see more evidence?
If the question is why doesn't the Fed hike by 50 or 75 basis points, 50 next month, they could, but I don't think they would, because I think they prefer increasing it in stages. The answer to your question is 25 is going to do enough damage to the global markets. China in particular, you're seeing rumblings in the Malaysian ringgit.
Absolutely, I brought that up yesterday.
Emerging market has been beat up pretty bad, and it is going to get terribly worse if you have a 50 basis point hike on December 14th.
I mean, Francine, let me bring up this chart. Bowden, go to this chart if you would. How cool is it, folks, on Bloomberg Surveillance with Francine Lacroix, we could instantly bring up a snapshot of Sri Kumar's Malaysian ringgit. In the middle, the crisis of 1998, up we go, weak ringgit. And Francine, we're back there right now.
Yeah. And I love that. And actually, Tom, let me bring you over to my chart. And this goes back to TPP. This is like the battle of the charts on surveillance. Tom, we never do this. Let's do it now. Sri, look, this is basically how much the U.S. has been exporting to the other 11 TPP countries, right? So we heard from Donald Trump yesterday that he would rip this agreement up. It hasn't come into force. But again, you can see that exports to these countries have been fallen. But if this falls even further, and if actually the reversal is true, they can't sell to the U.S., what does it mean for your Malaysia? What does it mean for a lot of these Asian economies, which will suffer? No doubt about it.
Yeah, I think the Asian economies are going to suffer if TPP is pulled, as the president-elect said in his video yesterday, Francine. But in addition to that, the U.S. is also going to be a loser because China is ready to step in and to start trade agreements with neighboring countries. So I think in terms of what's likely to happen, you have the Asian countries suffering in terms of their exports to the United States. And if you have the United States really close the door, so to say, on imports in terms of increasing tariffs or trade restrictions, you're going to see a retaliation on the part of some of the Asian countries the one country that's powerful enough to do that would be China.
Right, and that's exactly where I wanted to go, Sri. You know, for the moment, so Donald Trump's rhetoric or threats to punish China because of what he calls unfair trade practices have been largely ignored by China. Will they continue to ignore it? And if they stop ignoring it, what kind of retaliation can we see?
I think they would ignore those threats as long as there is nothing concrete that is being done. The first statement that could really upset the apple cart, so to say, Francine, is if, as president, Mr. Trump decides to name China as a currency manipulator, even though it has no immediate consequences in terms of materially changing things, it just hurts the Chinese image in terms of being able to call them that. Second, if he were to say that the Chinese are not appreciating their currency fast enough at a time at which the currency is weakening, it's going to weaken even more after being named as a currency manipulator, and that creates more problems for the new president.
Some of the emerging market tensions this morning with Sri Kumar. We'll come back on U.S. GDP and Sri's cautious view on America's economic growth. As well, in the next hour, David Wessel will join us in the Brookings Institution. You know him from years at the Wall Street Journal. David Wessel, I don't know, does he edit Ben Bernanke? David Wessel of the Brookings Institution on the Fed. Stay with us. This is Bloomberg.
This is Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keynes in New York. Tom, let's get our corporate fix. Let's get straight to some Bloomberg Business Flash with Taylor Reid. Taylor.
Francine, Tom, KKR has agreed to buy Japanese auto parts maker Calsonic Kansei. The price, $4.5 billion. That represents a 28% premium over Calsonic's last closing price. Nissan owns a 42% stake in Calsonic. It's been looking to spin off less important businesses so it can focus on electric vehicles and self-driving cars. A change at the top of Fidelity Investments, which manages more than $2 trillion. Abigail Johnson will take full control of the family-run firm early next month. She'll succeed her father, Ned Johnson, who will become chairman emeritus. Fidelity's been trying to increase client deposits after losing market share to low-cost providers such as Vanguard. And that's your Bloomberg Business Flash. I'm Taylor Riggs. Francine, Tom?
Yeah, Taylor, thanks so much. And congratulations to Fidelity. It's privately owned, 49% the Johnson family, 51% the employees. And that lead note there is Abby Johnson earned this. She is a legit equity analyst, and she did it the hard way. She came up and actually did real research and real work. Also doing real research and real work is our Tracy Alloway. She is in Abu Dhabi right now. Sri Kumar with us as well. Tracy, I'm looking at EM erosion, and if I just look at the Turkish lira versus the euro, just as one example, I mean, this is really, really for real. Is Donald Trump permanently moving EM currencies to new weakness?
Well, that's right, Tom. So the lira is now at a record low against the U.S. dollar in particular, which is quite a turnaround. I know you like narratives, so let me see if I can walk you through some of the narratives that are changing for emerging markets right now. You'll remember that in the aftermath of Trump's surprise win on November 8th and 9th, we saw emerging markets start to sell off, and the narrative then was that his policies, specifically his America First protectionist trade policies, were going to be bad for export-driven emerging market economies. However, since then, we've had a change in some of the stories that analysts are writing now. Now they attribute much of the emerging market sell-off to the sell-off we've had in bonds, rising yields, the higher U.S. dollar, all leading to a significant tightening of financial conditions, which historically is negative for risk assets such as emerging markets.
Let's bring up Euro Turkey right now. This is Euro Lira. It's a chart Tracy knows, and frankly, they all look the same. And what's interesting about this is the curve up. You've got a real new move up here in Turkish Lira weakness. When does President-elect Trump blink? There's going to be a catalyst, Tracy, where he's got to realize he's president for the globe. When does that happen?
That's a good question, Tom. But remember, we were having a similar debate when it came to the Federal Reserve.
Fair.
Is the Fed the global central bank or not? That debate is still going on. And in fact, if we get a rate rise, as Sri Kumar was pointing out earlier in your show, that will potentially be painful for EM. And I have to say, some of the sounds that are coming out of the analyst community when it comes to emerging markets right now aren't really optimistic. In fact, I was just looking at UBS's 2017 outlook, and they point out that even though emerging markets were the asset class star of 2016, mostly because we had lower interest rates around the world, even if we don't get a big spike in developed market interest rates going into 2017, even if we get stability from where we are now, that's still not good for EM. And it means that EM is going to be left without a positive catalyst for revaluation. So really quite a gloomy picture coming out of emerging markets right now.
Yeah, great point, Tracy. Thanks so much, Tracy Alloway there in Abu Dhabi. Now let's turn to Kamal Sri Kumar. He's president of Sri Kumar Global Strategies. He is in New York. Sri, the problem when you look at the emerging market outflows or the sell-off, and we go back to what Tracy was saying, how much does it have to do with fundamentals or actually just, financial conditions, and how much does it have to do with Donald Trump and trade?
I think the two major influences affecting the sell-off, Francine, is first, they have been worried about a Fed rate hike in December, and we remember what happened after the Fed rate hike last December. There was a massive outflow of capital from China in the second half of December last year and in the first half of January, and the first half of January was again a global equity market correction. So that was a worry in itself. The Chinese renminbi, for instance, has been steadily weakening. It is now weaker than it was during the financial crisis of 2008. And then again, Tracy spoke about the Turkish lira, and the Mexican peso has been very weak about it as well. On top of that, we threw the Trump election in November, and that means they have had a double whammy in terms of what it is. It is not going to go away very quickly, and especially with rate hikes, if they continue into 2017, I think the first half of 2017 will be a correction, but a good time to get in in terms of what is happening in the markets.
Shri, thank you so much. Kamal Shri Kumar there. Coming up in the next hour of Bloomberg Surveillance, we speak with former Prime Minister of Italy. He's Mario Monti. We'll be talking about the referendum. We'll be talking about growth. This is Bloomberg.
It is 100% certain the Fed will raise rates in December. Of course, it was 100% certain that Donald Trump would lose in this hour. David Wessel of the Brookings Institution. It is 100% certain stocks will go up. That's all they do. Dow futures touch 19,000. They go to cash crowd. They get crushed. And it is 100% certain the rules and discretion debate, it will never end in this hour. Kermit Schoenholtz of NYU. Good morning, everyone. This is Bloomberg Surveillance. We're live from our world headquarters in New York. I'm Tom Keene. Francine Lacroix in London. And Francine, it is 100% certain I missed my Walker's shortbread cookies from our London newspaper.
Yeah. 100% certain that we will send them in the post through you, Tom, but we need to look at currencies for that. We also need to look at latest tweets and that video for Donald Trump, what it means for foreign relationships and actually what it means really for global trade and therefore growth.
It's 100% certain it was a most bizarre political day. Let's catch up. Our first word news. Here's Taylor Riggs.
Tom, Francine, President-elect Donald Trump says no more business as usual in Washington. In a video outlining his agenda, Trump announced new rules involving lobbyists.
On ethics reform, as part of our plan to drain the swamp, we will impose a 5-year ban on executive officials becoming lobbyists after they leave the administration, and a lifetime ban on executive officials lobbying on behalf of a foreign government.
Trump's also taking aim at the Trans-Pacific Partnership. He says that on his first day in office, he'll start the process to take the U.S. out of the trade deal. In San Antonio, a suspect has been arrested in the killing of a police officer. The officer was shot while sitting in his car in front of police headquarters. He's the 20th to die in a targeted killing this year. That's the most since 1995. And Japan has withstood a potentially deadly earthquake with relatively little impact. The quake measured 7.4 and struck off the coast of Fukushima. That's the home of the nuclear power plant crippled in a quake and tsunami in 2011. This latest quake briefly knocked offline a cooling system at a separate Fukushima plant. It also caused a small 3-foot tsunami. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg. Francine, Tom?
Taylor, thanks so much. Through the data quickly. We want to get to Marty Schenker in Washington. Futures up 5. Dow futures right now up 50 points with a 19,000 futures print about an hour and a half ago. And you can see oil elevated as well. Yields advancing all in all through the night. The VIX 12.41. The VIX trading right now 12.41 comes in. There's the Dow below 19,000, and the dollar index, it takes a day off, a churn in the markets. Francine?
Yeah, it's really American shares, right, that have been buoyed as companies ending their 5-quarter profit slumped, and Donald Trump's election is fueling speculation that there will be more manufacturing and more infrastructure spending. As Kit Jukes of SocGen told me earlier, he says there's a clear rotation into equities away from bonds. Stocks rising around the world, spurred by the biggest 3-day rally in commodities. Remember, Tom, which is why I'm putting it there, OPEC is also meeting next week, and it's very likely, or at least that's what the markets are betting they will do, cutting output.
Even in politics, folks, there is the manufacture, the distribution, and the consumption of the political message. There is no question the distribution of the president-elect's message is original. Martin Schenker has decades of experience working at the Wall Street Journal with, among others, Norm Pearlstein, and runs all of our economics and government coverage worldwide. Kamal Srikumar with us from Srikumar Global Strategies as well. Marty, what a day yesterday was. I thought of you sitting in the room, if you had been in that room of media types. And I say this, Marty, with great respect for your decades of work. Should the media have lectured back to Mr. Trump?
Well, it depends on what he told them. I think that there is some kind of disconnect between what the role of media is and what Donald Trump thinks the role of media is, although he is a master at using the media for his own advantage. So I would be respectful, but I think I would be firm in what our job is.
I see our Charlie Rose there, Chuck Todd, who appears on Bloomberg Radio on Sunday with his Meet the Press, and others. Where is this relationship going as we stagger to January 20th? Will it be business as usual in communicating a presidential message, or would you suggest it's absolutely original?
No, it's absolutely original, and Donald Trump's YouTube video is a great example last night. He just bypassed the media completely and went directly to social media to deliver a message, albeit it was a message he had delivered in his campaign. There was really nothing new, but he went directly to the people as president-elect.
Marty, what do you make of the policies we heard yesterday? So this morning, I thought it was very interesting and telling that China is telling Trump that the ties with the U.S. are too big to fail. Does the president-elect realize this?
Oh, I think he does. It's very interesting that we have China lecturing the U.S. on free trade issues. But Donald Trump has said he is not going to participate in TPP, and in fact, Hillary Clinton also, and Bernie Sanders also said TPP was dead. So there's no real surprise there. What is going to be interesting is this bilateral approach to trade, which will be extensive throughout the world, not just Asia.
And then we have this, the last tweet, actually, so far by Donald Trump. The real Donald Trump is his Twitter handle. He actually has more followers than POTUS does, 15.7 million. He says many people would like to see Nigel Farage represent Great Britain as their ambassador to the United States. He would do a great job! Exclamation mark. I think I've rarely seen a spokesperson react so fast. Theresa May's spokesperson saying, actually, we don't have any vacancies at the moment. But this is how he's trying to influence also foreign policy.
Well, it's sort of really bizarre. I mean, his whole relationship with Nigel is quite strange.
As you know, he showed up during the campaign on behalf of Donald Trump. And, you know, I think Donald Trump just likes to stir the pot. So there you go.
Marty Schenker, thank you so much from Washington. Who knows what Tuesday will be like. With us now, Kamal Sri Kumar, and I want to get back to his important call on weaker GDP. My chart of the year, Kamal, you've seen it before, the presidential four-year moving average of real economic growth. Mr. Trump and Secretary Clinton making clear we've migrated from 4% real GDP 20 years ago down to the circle over on the right, 2% subpar GDP. Is there any hope that Mr. Trump can goose the permanent level of GDP to 3% or even to his rhetoric of 4%?
It is eventually going to be possible to put it to 3% plus in terms of growth rate, Tom. It's always been my contention that you can't do it just by monetary easing alone. And to the extent we are going to have fiscal reform, and we have structural changes in taxes, such as lower taxes to bring the money back for corporations, it is going to work.
Critically, and this is so important, this really works with your West Coast experience, do we need tax changes along with a policies prescription, investment or job credits to create jobs? Do we not only need the money to change, but we need the policy to change to incentivize job creation?
Absolutely. You do need the changes in terms of employment tax credit and other policies that go hand in hand with the reduction in the tax rate. Fiscal stimulus would be a positive, but it is the important point, Tom, is that you're not going to reach a 3% growth immediately, not even in 2017 or the first part of 2018. It might take a while to get there. And the question is, does the new president and his team have the patience to do it? And the people who supported him and elected him, in terms of those who are suffering from a low income, not getting wage increases, are they prepared to wait for it? And if in the middle there are trade restrictions, that is not a structural reform. It's actually a structural setback. And that is going to set back growth expectations. So there are a whole lot of different positives and negatives in the mix as we look at the new administration.
Right, but Sri, and actually going back to those trade deals, so let's say that there's Donald Trump and his team impose some kind of tariffs on China. I mean, China could retaliate either on doing something with the currencies, or they could actually say that they want to block foreign direct investment, and that must hurt directly U.S. growth.
Absolutely. I think they can impose tariffs on U.S. goods going into China. And U.S. is a big foreign direct investor in terms of our multinationals in the U.S. investing in China, Francine. And they, in turn, can be restricted in terms of what markets they are going to have, what they would be allowed to sell or to expand. And finally, you have China, which can execute its power on the political side as well. That is never to forget the issue about the South China Sea and the Chinese domination. Those issues have been dormant, and they can always restart those issues if they have problems on the economic or tariff side with President Trump. So China is a very powerful opponent to take on for the new president.
All right, Sri, thanks so much for now. Kamal Sri Kumar of Sri Kumar Global Strategies. Now, he'll also join Tom on radio. Thank you so much for your time. Coming up, we speak with the former Prime Minister of Italy, Mario Monti. We'll be asking him about the referendum. He believes the Italians should vote no. What comes next? Is it more political upheaval? That's what we'll be asking the senator. This is Bloomberg. Most interesting day, Tom, when you look at the rotation of bonds and also equities. Your three indices in the U.S. at a record high. Actually, they're partying like it was 1999. I'm Francine with Tom in New York and London. Let's get straight to the Bloomberg Business Flash. Here's Taylor Riggs. Taylor.
Francine, Tom, Credit Suisse is facing the U.S. tax investigation over undeclared accounts. That's according to people familiar with the matter. In 2014, Credit Suisse pleaded guilty to helping Americans cheat on their taxes. At the time, the bank promised to help the U.S. find suspicious accounts. Now investigators want to know why Credit Suisse didn't tell them about $200 million in assets owned by an American client. The bank isn't commenting. In Washington, an antitrust trial may determine whether the biggest merger in the American health insurance industry will go through. A government lawyer argued against the $48 billion merger of Anthem and Cigna. He said it would increase the company's dominance and cut consumer choice. An attorney for Anthem responded, saying the combined company will be able to lower rates to providers and pass on the savings. And that's your Bloomberg Business Flash. Francine, Tom?
Taylor, thanks so much. Okay, let's have some fun with Plug and Chug. It's a Plug and Chug moment with Kermit Schoenholtz of NYU. Let's go to the Bloomberg. We can do this, Kim. I don't know if you know we have this here. TAY. I don't usually do this, folks. This is a lot of noise. But I want to tell you that on the Bloomberg, you can bring up rules and discretion. And what I want you to focus on is this mess down here. Kim Schoenholtz is one of the experts in the world on all these plugins of the Taylor rule. Do you see this, Francine? It's there's the Okun factor. Thank you, Yale University and Penn. Here we are with the Taylor rule. Okay, let's get rid of that and come on over here to what we're going to talk about with Kim Schoenholtz this morning. Rules and discretion. It's really front and center with a new Fed chairman, isn't it?
Well, I think the Fed actually is very rule-like in its behavior. It thinks about rules all the time, but they're not slavish, and that's important because they realize that there are factors other than a simple rule that should govern monetary policy.
I'm going to pick on two economists. John B. Taylor, Stanford University, world-class economist, been a great supporter of the show. And let's take Rick Mishkin at Columbia University. Maybe a little bit different view than Kim Schoenholtz. The fact is, Taylor and Mishkin work within the markets and what the markets do. Bring up the 10-year yield here. This goes back to Eisenhower and the idea of making a rule given the great moderation and the changes we've seen. Life changes, doesn't it? Can a rule work?
Well, the rule's actually been very, very helpful. I mean, the fact that the Fed has been more rule-like for the last 30 years has helped lower inflation expectations, and it's brought bond yields down, as you see. And that's been a huge plus for the U.S. economy. It's given them more flexibility to respond to the kinds of shocks we've seen over the last decade.
All right, we're talking about hypotheses and theses and ideas, Kim, and that's great. But actually, I think, first of all, we need to address whether Donald Trump will replace Chair Yellen or not.
I can't say with any certainty, but he has criticized the chair. He's argued that the Fed has been a political agency. I think that's overstating it. I think the Fed always has to make decisions that have political implications, but they've been very technocratic in their approach, and that's been a benefit to the United States. And the Fed has been largely independent of political control for the last 30 years. And it's partly because presidents have shown great restraint in criticizing them, both Republican and Democratic presidents.
Right. I mean, you can criticize, but if you replace, do you go a step too far?
Well, no. The president has the authority and the privilege of appointing the people who run the Federal Reserve. It has been the case that in both Republican and Democratic administrations that we've seen the president reappoint the previous chair, but that's not always the case. So this is a privilege. The question is, once you appoint the people running the Fed, do you let them make the decisions?
Right, and that's a discretion that Chairman Greenspan speaks about. If we look at rules and if we look at a New Zealand model, most critics of John B. Taylor, such as Alan Greenspan, who wants more discretion and more flexibility, would say, come on, New Zealand is not a complex, massive global economy like the United States. Is that a valid criticism of rules?
I think it's fair. I think the better way to put it is, The Fed currently operates under a mandate, and Congress examines whether it's successful in meeting its mandate of keeping inflation low and stable and keeping output close to some normal level, or keeping unemployment close to some sustainable low level. And we can measure that, and we can criticize them when they fail to do that. But trying to change that to monitoring their operational decisions puts Congress much closer to actually being the monetary policymaker, and I don't think that's a good outcome.
Well, it may not be a good outcome, but Mr. Hensarling, I think, has maybe a different view. Some of the turmoil that we see here as the president-elect moves to January 20th. We're going to drive forward this dialogue with Kim Schoenholtz, and coming up as well, David Wessel of the Brookings Institution. What an advantage Mr. Wessel has working with Ben Bernanke at Brookings on some of these questions on how our monetary institutions fold in to the new presidential administration. This is Bloomberg. And here it is, a new tweet from the president. This is original Bloomberg reporting. I don't believe we've ever done this, waking up to a president-elect out tweeting. Here's Donald Trump. I canceled today's meeting with the failing New York Times. when the terms and conditions of the meeting were changed at the last moment. Not nice. I'm not going to editorialize here other than to say this is an original way to communicate, and we're seeing that a lot here over the last couple days. Kim Schoenholtz with us with New York University, and now we're thrilled to bring you David Wessel in Washington with the Brookings Institution. Mr. Wessel has done something relatively original, 2 Pulitzer Prizes, one with the Boston Globe and one with the Wall Street Journal as well. David, wonderful to have you here today. Your important research at Brookings on how our Federal Reserve communicates, to me, was just brilliant. And one of the summaries is Chair Yellen should speak more and the presidents would speak less. Discuss that. That's an important distinction.
Right. Well, I think that the markets, the public, the Congress are a little confused about what the Fed is doing. I agree with Kim that most of what they've done has been very well delivered to the American economy. But at this point, people aren't quite sure what they're doing. We did this survey of about 60 Fed watchers, some in academia and some in markets. And it was surprising that only about a third of them said they kind of understood what the Fed's reaction function is, how they would respond. And what they're hoping for, I think, if I can interpret their findings and looking at their comments, is to have a little more clarity if they had a more consistent message from the chair and less noise from the regional Fed bank presidents.
Yeah. David, we have a most unique moment on the Bloomberg. We see 100% certitude of a December rate hike, and yet I believe evidence is the word du jour. How can we have 100% certitude if the Fed is waiting for evidence like the December jobs report?
Well, I don't think they are waiting for the December jobs report. I think in part because of the criticism like the sort that we picked up in our survey, and because the Fed doesn't really want to surprise the markets at this early stage of liftoff, they have sent a pretty unambiguous message. I think the December job numbers would have to be really, really out of consensus, or there'd have to be some disruption to the world markets for them to hold off on this rate increase. But what people are going to want to know in December is what is the path of rate increases the Fed anticipates, given their current reading of the economy, and importantly, what they assume President Trump and Congress will do on fiscal policy, since the world has clearly changed there.
Right, David, are you expecting a 25 basis point hike, or is it a 50 basis point hike? And I guess that is the first thing that will then give us an idea of the trend of future rate increases in 2017.
I'm expecting a 25 basis point move because that's what the markets anticipate, and I think that Chair Yellen at this point would have said something to make them change their mind if that weren't the plan. I'm not sure that doing 25 basis points tells us much about the future. I think people are going to be looking at the words they use, and they're going to be looking at those darn dots where the members of the Federal Open Market Committee, voters and non-voters, give their projections going forward. In our survey, a lot of people are dissatisfied with the dots. About a third of the people said scrap them all together, and others want more information. They want to know whose dot is who, or how does the interest rate dot compare to the projections for the pace of economic growth and inflation.
David, within all your work, and of course your wonderful book on the central banks as well, we've got the asset buildup over to the Bloomberg, and here's the asset buildup of the Fed, of the Bank of Japan, and of course of Europe as well. David, very quickly here, do you look at that asset buildup in perpetuity? Is it ever going to come down?
I think it'll come down only very, very slowly. I think the Fed may never actually outright sell securities and may let them run off.
Well, David, thank you so much. David Wessel, the Brookings Institution, and congratulations for your work with former Chairman Ben Bernanke as well. We're going to come back, more discussion on economics, and of course, what we see from Mr. Trump. Mr. Trump tweeting out Mario Monti on Italy next. surveillance on economics, finance, investment, international relations, on President-elect tweets as well. Mr. Trump tweeting out moments ago to the New York Times. Somehow I think we're going to hear about that right now with our First Word News, Taylor Riggs.
Tom, Francine, Donald Trump has spelled out his policy priorities in a new video. On his first day in office, Trump will take aim at a controversial trade agreement.
On trade, I am going to issue our notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country. Instead, we will negotiate fair bilateral trade deals that bring jobs and industry back onto American shores.
Trump also wants to limit regulation. He says that for every new regulation, 2 old ones must be scrapped. In Chattanooga, Tennessee, police have arrested the driver of an elementary school bus that crashed, killing 6 people. 24 others were injured. The driver is accused of vehicular homicide and reckless driving. Japan has withstood a potentially deadly earthquake with relatively little impact. The quake measured 7.4 and struck off the coast of Fukushima. That's the home of the nuclear power plant crippled in a quake and tsunami in 2011. This latest quake briefly knocked offline a cooling system at a separate Fukushima plant. It also caused a small 3-foot tsunami. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg. Tom, Francine?
Taylor, thank you so much. So the Italian referendum is less than 2 weeks away, and just like Brexit, it could have widespread ramifications for the EU. So on December 4th, Italians will vote on constitutional changes. Also at stake is Prime Minister Renzi's future. If the referendum is struck down, he has said he resigned. He then backtracked, but we understand that he may still resign. Joining us now for an exclusive conversation is Mario Monti. He is the former Prime Minister of Italy. That is only one of many things. He's senator, a professor at Bocconi, and of course, he was for many times competition commissioner in Europe. Mr. Monti, thank you so much for joining us here on Surveillance. You're one of the most prominent figures that says we should vote no in this referendum December 4th. If there is a no vote, do you not see huge economic consequences because it would bring political upheaval and something possibly ugly, a group that may be wanting Europe to be out of the Eurozone?
No. I think it was a mistake by Prime Minister Renzi to denature so much the referendum on the Constitution, because this is a referendum on a partial modification of the Constitution. He has decided to overcharge the boat with so much of a dramatization, but that is, I think, something that he now himself believes was wrong. Now, for example, I vote no because I believe that the new constitution might make the legislative process more cumbersome, complicated and uncertain, not less, and also because I do not like the new Senate, which will bring to national prominence a political personnel, that of the regions, which has been highly corrupted on average. But I, for one, say the Prime Minister should continue.
Right, but do you think he will? And there was a realization when Brexit happened, right, that a vote against what has been proposed by the government means that it's very unlikely that the government will stay. Do you assume that actually Mr. Renzi will have to step down?
This is his own choice. I do not believe at all that he will have to step down. If he does, and if he gives today the impression that he might, in that event, step down, then if there are uncertainties or turbulences, that is his responsibility.
What comes after a Renzi government? So let's say there's a referendum, because he said in the past that it's very linked to his political future. What comes after him? Is it a technical government? Is it something? Is it snap elections? Is it, again, a lot more turmoil for Italy?
No. In case the no were to win, I would expect, first of all, Mr. Renzi to stay on after all. Secondly, if he at all costs wanted to leave, I would expect the President of the Republic to form a new government with a new Prime Minister, but very much from the same center-left political spectrum, which is now the Renzi majority.
there would be, in my view, no early elections. They will stay where they are supposed to stay in 2018, and there would be a continuation of current policies. And I should say, and I've been one of the most convinced supporters of Mr. Renzi as Prime Minister, especially initially, that the policies of Mr. Renzi in the last 2 years have been quite different from the initial ones. The initial ones included a labour market reform that, although has not given proof of brilliant results so far, I believe is in the right direction. But in the last 2 years, I must say that the pace of economic reforms has slowed down a lot, and also that the pace of fiscal consolidation has slowed down a lot. So the outcome of these 2 years is not really brilliant, considering that there was a mostly favorable situation concerning QE,
right,
the exchange rate, etc. So I believe that he will stay on, or there will be another similar government, no technocratic government at all.
Right.
But I do hope that the policies become more vigorous.
You're a liberal, reformist, kind of center ground. Are you not afraid of the base and the power that some of the movements that are more extreme, either to the right or to the left, right now I'm thinking of Cinque Stelle, of the advancement that they're having, and the fact that with any political turmoil or any chance of snap elections, they would get in power?
No. To get in power, they would need to have actual elections, and they would need to persuade Italian electors that they are good at governing, which is not a very persuasive statement so far, considering, for example, the experience in Rome. But the message I'm trying to convey is that there should be no turbulence in the financial markets, and that Renzi or not Renzi, Italy cannot go on like this. It must go down more concretely the path of reforms and fiscal consolidation.
And I understand that, and I respect that point of view, but the markets seem to assume that a no vote on the referendum December 4th would almost automatically mean that Italy would leave the Eurozone.
But that is completely and distorted imagination. That would take the five-star movement to go into the government, to call for a referendum, and to win that referendum, supposing they call the referendum. That, as far as I can see it, is out of reality. At any rate, I know that the financial markets are still impressed by the young, bold Mr. Renzi of the first hour, who did exactly the policies that the financial markets were called for.
Yeah.
And although that fascination goes on, the financial markets should also have a look at what the European Commission says of the Renzi economic policies, and also take into account that he has become a powerful factor of almost populism from the top, because the way he speaks about the European Union is not very dissimilar from the one that the five-star movement or the League used, except that, of course, he has more authority and more megaphone effect.
But Senator, is that not what the people want? And actually, if you see people in power now, or the politicians, what can they do to try and bridge this divide with voters that are angry? We saw it with Brexit, we saw it with Donald Trump, and so there needs to be a meeting of the minds, or a rhetoric which people understand and take on board.
Okay, then on this account, we legitimize post-truth politics. We legitimize storytelling overshadowing completely the facts. And I am definitely against that sort of politics and policies. You identified the root of the problem, but I do not believe that we should take the thirst for power of those in the political arena as fully legitimate, even if that brings them to betray their people, essentially.
Mario Monti, thank you so much. We could go on for hours, Tom, because this is a hugely complex situation, and you would argue that actually it's really at the forefront of what Europe, with elections in Germany, but also France coming up next year, is facing in the next 17 months.
Just extraordinary, and really carries forward, Francine, the divide we saw when I was in London between, say, David Folkers-Landau and Holger Schmieding of Berenberg Bank. Kim Schoenholtz with us from New York University. That was the biggest divide I saw in London, was on Italy, the immediacy of solution in Italy versus be more Germanic-like. Within this is populism, Kim Schoenholtz. How do central bankers adapt to the political reality of a new Western populism?
Well, in part, it's the leadership, and you will find that the new leaders of these countries appoint leaders of central banks, and that will have an impact on the way they behave. But central banks have a very specific mandate. At least in the United States, they're instructed to keep prices stable and keep output close to normal levels. That's a difficult job. They shouldn't be led astray from that.
Checks and balances is all in the air right now. Everybody worrying about this check, this balance, judicial, legislative, whatever. There's a check and balance in England, in Frankfurt, in Washington. The checks and balances to our monetary policy?
I think there are lots of them, and it depends on which institutional setup you talk about. But if you think about the Federal Reserve, they communicate regularly what they're doing through minutes, statements, press conferences, testimony, and they're called to account by the Congress. So I think they are held very much accountable for what they do.
Are you traveling this holiday?
No, thankfully.
Good. Schoenholtz, always sensible. Thanksgiving, that means travel. We'll come back with Kim Schoenholtz and talk economics. Coming up, though, Brian Kelly. I need to get to the Maldives for $186. No, I need to get to Buffalo. The points guy, next.
This is Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Tom, let's get some corporate news. Let's get straight to Bloomberg Business Flash. Here's Taylor Riggs. Taylor.
Francine, Tom, KKR has agreed to buy Japanese auto parts maker Calsonic Kansai. The price, $4.5 billion. That represents a 28% premium over Calsonic's last closing price. Nissan owns a 42% stake in Calsonic. It's been looking to spin off less important businesses so it can focus on electric vehicles and self-driving cars. A change at the top of Fidelity Investments, which manages more than $2 trillion. Abigail Johnson will take full control of the family-run firm early next month. She'll succeed her father, Ned Johnson, who will become chairman emeritus. Fidelity has been trying to increase client deposits after losing market share to low-cost providers such as Vanguard. And that's your Bloomberg Business Flash. Francine, Tom?
Taylor, thanks so much. He's usually in the Maldives for $186. We are honored to have on the set Brian Kelly. He is the points guy, which barely does justice to how he has single-handedly changed the travel business. Before we get to Thanksgiving, give me an update. Next year, do we get 200,000 miles if we get some stupid charge card?
You know what? The battle of the credit cards is raging more than ever. I've heard rumblings that American Express is going to come out swinging in 2017.
Yeah.
Of course, they have to, right? Because Chase has been all over.
Does Jamie Dimon hate you?
No, we text message. We're best friends. No, I'm kidding. No, the credit card companies like me because I educate consumers on their products.
Help me here with Thanksgiving. What's the new this year? Everybody but Kim Scholnholz are traveling. And what's the #1 tip you have for the panic of traveling Thanksgiving?
Well, I think the panic is overblown. I travel every year on Thanksgiving, and yes, we like to hype it up, but I would just say go to the airport prepared, right? Get your TSA pre-check. It's a little bit late now if you don't have it already, but no airlines. We know airlines charge fees for everything, right? So don't go to the airport confused when you have to check a bag, right? It's all about expectations and setting them appropriately.
How is Spirit? And Francine, Spirit is a low-cost airline in America, and I saw your detailed article on United Airlines the other day, where now they're going to charge me for baggage, this, that, and the other thing. Where's that trend go?
Well, the thing is, Spirit's a very successful airline. I mean, at the end of the day, passengers are cheap. That's why we've seen low-cost carriers in Europe really successful.
Ryanair and all that.
The same thing's happening here. Airline passengers don't want all the frills. Most people don't know how to use miles, right? So why pay extra for those miles? A lot of people, so that's what United is doing, saying if passengers will buy on price, they need to be able to compete in those online travel.
Are we heading towards a legroom that Francine knows in Europe where business class is like what, people...
No, that's the worst. I think that's one of the biggest scams in the travel industry. I'm 6'7". I flew British Airways Club Europe, which is actually, I think, 30 inches of pitch. It's worse than coach. I flew Ryanair exit row, was way more comfortable than British Airways business.
Francine, this is not fair. I mean, Brian Kelly's 6'7", I'm 6'5". It is an absolute scam. I can't even sleep on the airlines. That's why I take the surveillance Gulfstream.
Right. I would suggest, I'm so tired, I sleep even in a little box. Because you know what? I'm sleep deprived, Tom. This is what you need when you fly, especially transatlantic. Brian, how much do you... So I travel to the U.S. regularly. I used to live in the United States. I've traveled across many states. But actually, if you look at Trump and spending, would it automatically affect also airports and infrastructure getting us to and from these airports?
Yeah. I mean, his infrastructure plan has yet to be completely spelled out. But, I mean, he even said in the debates that, LaGuardia is a third world airport. We recently did a study on the U.S. airports, and LaGuardia is, in fact, the worst airport just in terms of timing. And the fact that you can't get to the city center, although I don't think, even with billions spent in infrastructure, I don't think it's going to fix LaGuardia's problems. But, arguably, Trump's infrastructure plan could vastly improve our airports. But, the details are yet to be seen.
Yeah, what's the best airport in the world? So we're looking at the holiday season. I've always heard, amongst the carriers, it's Etihad or one of the Middle East
I know my
carriers.
guess.
What about Tom? Maybe you want to jump in. What's your favorite?
I think in general, Singapore airport is beautiful. It's well thought out. It's close to the city center. Hong Kong's great. The Middle Eastern airports are really nice, but I give the edge to Singapore.
Okay, Brian Kelly, one more. Let's look at this chart, please. Here's the moonshot. Here's the reality. This is Alaska Air. I've picked a successful airline, and basically it's a moonshot. From where you sit, Brian Kelly, not as a securities analyst, can they sustain cash flows and lose the past bad behavior that's gotten the airlines in trouble before?
Alaska, I think the biggest question is what's going on with their Virgin America merger. And I actually think, Alaska's product, they said they're going to increase their premium product. They have a very dated first class. Passengers, high fare passengers, I don't think are going to go for their product in the future. But, it's a great run airline. People like it. I feel I would go long on Alaska.
I hate you. $186 to the Maldives?
Yeah, something like that. I'll be there over Christmas at the new St. Regis. Actually, the St. Regis, which was $2,000 a night, I got for free using my store.
Oh, go away, Francine. Get us out of this.
All right, Tom, if you move to London, you know, Mauritius is closer. There you go. Brian Kelly, thank you so much with great points. The points guy, that's why he makes great points, with Tom Keene. Boris Johnson speaking, answering questions from the Foreign Office. I think that's the pictures we're seeing right now. We will monitor for any headlines. If you want to watch that full Q&A, type live go on your Bloomberg terminal. I think he's been talking a little bit about Turkey and accession to the EU. We'll have plenty more on that. We'll look at world trade. This is Bloomberg.
The protection in the first safe country of arrival, the right of states to maintain their borders, and a clearer distinction.
Well, foreign exchange, it's there. Equities move. Of course, futures higher today. I'm going to go with yen, 110.75, and with the dollar index holding well above 100. And that's about it on foreign exchange today. Francine.
Thank you so much, Tom. Coming up shortly, it's Bloomberg Daybreak Americas with David Weston, Jonathan Ferro, and Alex Steele. David joins us now, and I know, David, you have a very packed show.
Yeah, we do have a lot going on. We're going to start off with Dr. Richard Haass. Of course, he's the president of the Council on Foreign Relations, talking to us about what Donald Trump said yesterday about TPP. First day in office, he's going to get out of TPP, what that means for the United States, what it means for China, what it means for the world. We're also going to talk about bonds. Bonds remain in the news, that rotation out of bonds. We have Jeffrey Rosenberg with us from BlackRock. He's going to talk about the short term, the medium term, what it means for investors, what they should do. And finally, of course, today is a big day in commodities. We have Bob Michael from JP Morgan. We're going to talk with him about that reflation trade around the world, what it means for commodities, how far they can go. And is it really a Trump phenomenon, or is it really more of a China and other phenomena going on around the world? And that's at least part of what we're going to talk about, Tom.
David, it is a new world. We've just had another Trump tweet. Let's go to the tweet. It's a surveillance exclusive, and they'll go into this on Daybreak. This is really cool. Great meetings will take place today at Trump. And down below, concerning the formation of the people, for the next 8 years. Is Julie Andrews said in Mary Poppins, cheeky for the next 8 years.
Well, Tom, So if you're going after, and this, we had one of our guests, which I thought was one of the smartest things, right? If you want if you want 2 terms, it may mean that the first, you really focus on growth and you're a little bit more tame in your thinking because you want to be reelected. Right. So you can't do that much damage even in terms of trade. So maybe this is something that the markets will applaud even further.
Final thoughts with Kim Schoenholz right now with NYU. I want to just, in the 18 things in my head, productivity and the lack thereof. I'm sorry, but that's Mr. Trump's economic conundrum, isn't it?
It's going to be a big challenge, and I think some of the things that he's proposed aren't going to be helpful. Anything that reduces our ability to trade with people abroad is not going to be good.
I think of the Harvard economist Robert Barro and the idea of the timeline, the time continuum of economics. Is a tax cut a one-off advantage, or can there be a permanence to tax reduction?
Well, it depends on the particular tax, and it depends on the debt path. If the U.S. debt path proves to be unsustainable, it won't be a permanent tax reduction.
All right, what is the one thing that Donald Trump needs to get right to reflate America?
Well, I think it's important to put a little bit more emphasis on fiscal policy than we've had before. You know, we've been relying on the central bank to promote economic growth. That's worked to some extent, but it's probably too much reliance. So I think it's reasonable to expect a bit more fiscal stimulus, and an infrastructure investment program makes some sense. But it's much broader than that. Trying to figure out how to get economic policy right is not a simple thing. It's going to take a lot of experimentation. We should be willing to experiment.
Dr. Schoenholz, thank you so much, particularly the discussion on rules and discretion. Kim Schoenholz will continue with us on Bloomberg Radio. Lots coming out today, including those Trump tweets driving our political economic conversation forward. Look for that on television and radio. Tomorrow, Rupert Harrison of BlackRock on his Brexit. From London, from New York, this is Bloomberg.
Good morning from New York City. A warm welcome to Bloomberg Daybreak on this Tuesday, November 22nd. I'm Jonathan Ferro alongside David Weston and Alex Steele. In the markets then, all-time highs. Will we break another one? Futures positive, up 52 points on the Dow, up 6 points on the S&P 500. If you get to the bond market, yields across the periphery, lower. In the United States, Treasury yields go lower too, down by 3 basis points at 229. Dollar yen back to 110.75, a marginally weaker dollar story on that cross.
And here's what you need to know at this hour. Party like it's 1999. All 4 major U.S. equity benchmarks rallied to all-time highs for the first time in 17 years as commodities surge. Death, taxes, and a rate hike. The market's certain the Federal Reserve will move next month as the implied probability hits 100%. And Donald Trump targeting trade.
I am going to issue a notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country.
The U.S. president-elect says he'll withdraw from the Trans-Pacific Partnership on his first day in office. And that's what you need to know.
All right, well, we're seeing sort of a big move in markets over the last 2 weeks and wanted to break it down for you. We're seeing the great rotation out of stocks, perhaps, and into bonds. Here are 3 charts that are going to tell that story for you. The first, we're partying like it's 1999. I was a sophomore in college, so yes, it was a big party year. But you have the Russell 2000, it's that red line there, and you have the S&P, which is the white line, the Dow Jones, the blue, and the NASDAQ in the purple. There's a normalized basis over the last year, and you can just see that huge jump ever since the election. On the flip side, though, you have a record rally, but you're not seeing any kind of big volatility. If you take a look at Treasury volatility versus stock volatility, we're right around a 3-year high. So this is the widest spread since September of 2013. And Bank of America says that in actuality, you could see the Treasury volatility move even higher. It's that white line there, and it has more room to run. It's still well below its historical average. So what does it wind up meaning when you pair the issues in the stocks and bonds? It means you're seeing the bonds sell off, you're seeing stocks rally. And this is a simple chart, but it really tells that story. That blue line is the Bloomberg Aggregate Bond Index. It takes into account sovereigns, corporates, all across the globe, and the white line is the S&P. Now, over the last few months, they were moving in tandem, and that had a lot of worries out in the market that if you had a sell-off in bonds, you'd see a sell-off in stocks. Guess what? That didn't happen. The sell-off in bonds steepened, and the rally in stocks continued, and that is the question. Can that divergence continue, John?
And how does the gap close? Let's bring in Jeff Rosenberg, shall we? BlackRock Chief Fixed Income Strategist. Jeff, that gap that you see on that chart at the moment, the S&P 500, the bond market rolling over, does it have to close or can it just continue going that way?
It doesn't have to close. The gap is kind of traditional economics meets markets 101. What's good for stock markets is reflecting growth expectations, right? We have the Trump election. It surprises people. It's all about growth. It's all about changing the trajectory on growth. So what's the reaction in financial markets? You get a positive reaction in equity markets to the growth side, and you get a negative reaction in the sense of higher interest rates, but the higher interest rates is really reflecting the expectations that we're going to have a stronger odds that we're not going to have 2% growth forever. That's what the market moves are talking about.
Historically, it makes absolute sense. It's not what we're used to recently, that's all. So in the middle of the summer, you had bond yields at all-time lows and equity markets at all-time highs. We've had distortions in the bond market for the last 6-7 years. So I asked the question really because can we go back to the old days?
Well, we're so used to this distortion in financial markets where bad news is treated as good news. This was my Halloween theme. I called it the paranormal markets. Bad news is treated as good news because it means more monetary policy accommodation. More monetary policy accommodation is good news for stock markets. It raises stock valuations, and it raises bond valuations because it means a more persistent period of zero rates, more persistent period of intervention. I think what you're seeing in that breakdown, in that far part of the chart, is maybe we can break out of that kind of market environment and get back to a bit of normal market environment. Normal market environment where bonds and stocks have more persistent negative correlation. Now, what you're seeing now is the good side of that, right? Bonds down, stocks up, but you can also see the other side as well.
Well, the question, though, it becomes, at what point, though, do you not want to buy stocks because the yield isn't as attractive? And if you take a look at the Bloomberg here, something very interesting has happened over the last few days, and that's that the generic 10-year yield has now risen above the S&P dividend yield, right? The case for owning stocks over the last few months is you're like, hey, the yield is so much better, I'm going to own that. Does this change that conversation?
So the conversation on the stock side has been, there's good news, but it's much more about rotation, about different sectors that are benefiting. Healthcare, different parts of healthcare as a result of what we anticipate, what it looks like for energy, what it means for consumption and consumer-related stocks because of trade policies. On the bond side, it's pretty much macroeconomic growth outlooks. And with the growth outlook, you see the higher interest rate picture.
So at what point do the macro effects really come back on the bond market in this sense? This is based, I think, largely on the anticipation of fiscal spending and tax cuts, which could easily lead to real deficit spending and a really growing leverage of the U.S. balance sheet. At what point does that begin to feed back into the bond market and have negative effects?
Well, it already has, in the sense that if we look at the movements in the bond markets, where have we seen the biggest movements? It's in the back end of the yield curve. Now, that can reflect a couple of different market expectations. One, it reflects an expectation that growth will be accompanied by inflation. It also reflects the idea that if we're moving away from that monetary policy world that we were talking about a minute ago, and monetary policy can do less and fiscal policy might do more, and that might mean more debt financing, that still remains to be seen, then the expectation is you push up the amount of issuance relative to the amount of purchases by the Fed, and that's a supply-demand shift that also steepens the curve at the time that the Fed is still expected to maintain very accommodative short-end interest rates.
Jeff, how much of this is real fundamentals and not just emotions? In politics, we talk about post-truth politics, where you shape public opinion not by objective facts, but by going towards people and trying to shape their personal beliefs, the way they feel emotionally. In markets, emotionally, bond strategists are always bearish and equity strategists are always bullish. So if you feed them anything that kind of stimulates that emotion, they're going to do these kind of things. And I just wonder how much this is really to do with hard facts, because think about it. What's changed in the last month? Yes, you've got a new president, but what's changed in terms of policy?
You know, what's changed is that if you asked any bond strategist, equity strategist, economist on your program, what is the probability of seeing a 4% growth rate, real GDP growth rate, over the course of the next 4 years? What would you have gotten as answers? You would have gotten zeros. So what you're seeing in the market is a change in the probability of that attainment, of that goal. Now, it's not facts. It's about what the odds are of changing the growth. Shift. Absolutely. So if you added a 10% probability, which had been zero on a 4% growth rate, and that growth rate fed through into nominal growth rate, then the expectation is that's worth about 40 basis points in interest rates. And that's how you can kind of do the math around the move that we saw in the bond market. And I think you see it in a lot of other markets as well. I think we'll talk about later. We'll talk about the metals and the commodity space.
We are going to talk about it later. Jeff Rosenberg, BlackRock Chief Fixed Income Strategy, is going to be staying with us to have exactly that discussion. Now, let's get an update on what's making headlines outside of the business world. For that, we go to Emma Chandra. She's here with First Word News. Emma.
Thank you, David. President-elect Donald Trump has spelled out his policy priorities in a new video. On his first day in office, Trump will take aim at a controversial trade agreement.
I am going to issue a notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country. Instead, we will negotiate fair bilateral trade deals that bring jobs and industry back onto American shores.
Mr. Trump also wants to limit regulation. He says that for every new regulation, 2 old ones must be scrapped. In Chattanooga, Tennessee, police have arrested the driver of an elementary school bus that crashed, killing 6 people. 24 others were injured. The driver is accused of vehicular homicide and reckless driving. Japan has withstood a potentially deadly earthquake with relatively little impact. The quake measured 7.4 and struck off the coast of Fukushima. That's the home of the nuclear power plant crippled by a quake and tsunami in 2011. This latest quake briefly knocked out a cooling system at a separate Fukushima plant. It also caused a small 3-foot tsunami. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg David.
Thanks so much, Emma. Coming up, death, taxes, and a rate hike. The market has no doubt the Federal Reserve will move next month as the implied probability hits 100%. And next, commodities are back in favor, set for their biggest three-day advance since May. We'll look at what's leading the rally and why Goldman is bullish for the first time in 4 years. This is Bloomberg.
This is Bloomberg Daybreak. I'm Jonathan Ferro, joining you from New York. Let's get a check of the markets for you. All-time highs on the four major benchmarks here in the United States for the first time since 1999. Will we set another record? The Dow futures up 51 points. S&P 500 futures positive 6. Another rally in the commodity complex. Get to the other board for me very quickly. Crude, WTI up to 48.35. Brent flirting with a 50 handle. We're up about 0.25%. And yields just rolling over on 10-year treasuries to 229. We're down 3 basis points, Alex.
We're looking at NYMEX crude over $48, and overall we're seeing the best three-day commodity rally since May. You got gains across the board. You got zinc, copper, tin. They're all rising. Look at tin's rally over the last year, 44%. So why is this happening? For more on the advance, we're joined by Will Kennedy, Bloomberg News Emerging Markets Managing Editor, and Jeff Rosenberg, BlackRock Chief Fixed Income Strategist, is still with us. So the monster rally we saw just in the last 2 weeks has really been blamed, accredited to Trump and perhaps an infrastructure plan. Is that the real reason behind the commodity rally?
It's part of the reason, Alex, but there was a good rally going on before the election. We hit a lot of pessimism about Chinese growth early in the year, and we really saw prices slumped, and that's turned around mostly on the back of a stronger than expected Chinese economy, and also in some of the metals like zinc, for example, actions taken by producers to manage supply. So you've had a demand better than expected and an interesting supply response in some commodities.
And that has been relatively unnoticed in the last few weeks leading up to the election. And Jeff, this really speaks to your world. Goldman Sachs yesterday upgrading its commodity outlook and saying buy commodities for the first time in 4 years, in part because of this reflation trade. PMIs are getting better. The growth is going to get better. What do you see from where you sit?
Yeah, as Will said, the rally was definitely in place ahead of time, but the big acceleration is the post-Trump election, because what we talked about in the earlier segment, what you're seeing in bond markets, in macro markets, of inflation expectations and growth expectations, you're also seeing in the commodity space, benefiting from the infrastructure expectations and overall from the growth expectations. You have the China aspect as well, but I think the big acceleration, you can clearly see it in the data, is the post-election acceleration across commodities.
Well, there is a China aspect in there, but it's certainly been marginal over the last month or so, and I just want to get your thoughts on that. We haven't really ever talked about a big rally in base metals without talking about China. How much can the United States move the dial on its own with that in mind?
Well, if you look at copper, half of global copper demand comes from China, so it's absolutely fundamental to that market. But in the Goldman Sachs note that we're talking about, where they said we're going to be overweight, people should be overweight commodities for the first time in 4 years, they point to strengthening PMI globally, in China, outside China, and in the US. And there's no doubt that the kind of infrastructure spending that we're talking about, that President-elect Trump's pointed to, would be very bullish for a range of natural resources.
Yeah, and same look at the output gap closing between U.S. and China. That's bullish for commodities. Okay, so you have this huge rally in commodities. What do you do on the inflation front? How do you go buy tips? Is this the call?
So we've had a positive view on tips going into the election. A lot of what the post-election events did for market pricing was to accelerate some trends that were already there. Trends in terms of expectations of stabilizing inflation, trends in terms of moving away from monetary policy support towards more fiscal policy. You just got a big acceleration in that. Tips had a big outperformance in that time period. They may have in the short run kind of run up pretty quickly, but over the longer run here, meaning 3 or 6 months, we still think that inflation protection relative to nominal Treasury exposure will be a better way of owning safe assets in your portfolio. Short term, though, we may have to get through some of this big increase in pricing because valuations have gotten a little stretched here in the short run.
Will, it's not just the metals that are up. Oil is up as well, even though we have a stronger dollar. How much of that is tied to this supposed OPEC deal, rumored OPEC deal, and where are we on that deal?
There's no doubt that since the weekend that people have become much more optimistic that OPEC will put together some kind of deal to be ratified at its ministerial meeting a week tomorrow. This morning, a member of the Nigerian delegation came out and said they expect a committee today to agree how the individual members within OPEC will divide up the burden of cuts, and that's been seen as a key stumbling block to getting this deal done. If that's true, it's incredibly bullish for the market. I would caution, however, that we need to hear from Iraq and Iran first, because they're the two countries who have resisted any curbs on their production within OPEC, and that together they account for more than 8 billion barrels a day. So once we hear from those two countries that they've agreed to something and the Saudis have backed it, then we can really be more optimistic about next week's OPEC meeting.
Jeff, these are important stories for the bond market. We're going to get a radical change in base effects as well if these numbers continue going in this direction. And I wonder how much of an inflation head fake we'll get for the bond market.
Yeah, the oil story is an interesting one. I don't know if it's possible to pull up this chart at all, but you know, oil and the dollar, obviously it was mentioned before. We've got the OPEC story, and that's dominating the short-run moves. We also have another story around the election and the growth picture, which is this strengthening in terms of the dollar, and so that's oftentimes been a headwinds for the oil outlook. So we need to sort of
now.
Yeah,
you got your chart
right here. It's just you just see the typical inverse relationship between the dollar and oil. You see the very far right-hand portion of that. You see oil prices going up, dollar going up, so there's been a breakdown, and clearly that's because of the OPEC news. You get past the OPEC news, we got to keep an eye on the dollar. Remember a year ago it was all about currencies and China and commodities, and a strong dollar tightens financial conditions. And to the extent that that flows back into oil and the concerns around inflation, then your base effects start to not work out the way that you were expecting. Depending on, you can sort of see what year over year levels in terms of oil, as we're down right at those low points around 45, you get to that point where you no longer get the base effect benefit. Obviously, in the short run here, we bounced off, so you're back to that story of base effects. But we got to watch the dollar picture here on the oil.
Jeff, as I listen to all this discussion, I really wonder whether the markets are picking and choosing the news that they want to pay attention to. We want to talk about fiscal stimulus. We don't want to talk about deficits. We want to talk about what's going on. We don't want to talk about trade. What does that do potentially for for example, to commodities? Are we really just picking the good news?
Well, we're selective in the stories that we're telling out of the news, right? We have this growth story that's very strong. We've talked about it all morning. It's in commodity prices, it's in interest rates, in the equity markets. But then we have the anti-trade concerns in some of the emerging markets. And so that's one of the kind of cautionary tales around the consensus move towards this is growth friendly, this is inflationary in a good sense, that we just have to be a bit careful that some of the other signals there in terms of the negative impacts that might occur because of the trade policies are being reflected in some of the emerging markets.
Great stuff, guys. Thank you so much. Will Kennedy, Bloomberg News managing editor for Europe, Middle East, and Africa, and Jeff Rosenberg, BlackRock chief fixed income strategist, sticking with us. An interesting point that Jeff made, guys, because Goldman Sachs yesterday in that note said that they do think the dollar and oil can continue to rally. They don't think it's going to hurt financial conditions this time because emerging markets are going to spend what they make off of this rally. They're not going to save it, and that changes the whole game. Okay, anyway, coming up, I can talk oil all day. Hiking in December. The market implied odds of Fed action next month climbs to 100% as traders wager on increased spending and growth under President-elect Trump. We're going to break deeper into that reflation trade next. This is Bloomberg.
This is Bloomberg. I'm David Weston. It seems three things are certain now: death, taxes, and a Fed rate hike. The FOMC may not have voted, but the market has, declaring there's a 100% chance that the Fed will raise rates next month. Jeff Rosenberg, he's BlackRock chief fixed income strategist, still with us. So, Jeff, okay, it's 100% for December. Let's just get that out of the way. Next year, though, it's not that steep. Rise. If you look at the WIRP, it's not that steep. It's pretty cautious. Are we getting to a point where Janet Yellen's getting her wish for, was it a high-pressure economy she talked about?
Yeah, you know, if we weren't talking about the election result, we would have been talking a lot more about what Janet Yellen said back in October in a speech where she introduced some ideas around running the economy a lot hotter, running a high-pressure economy. And that is a much more accommodative policy with the goal of running the economy hot to repair some of the damage done to labor markets, to try to get more people back into the labor markets. The 100% probability for December, yes, that's in the market, means that December should be be a non-event, except that it's about what they forecast in terms of the future pace of future increases. And back in December last year, remember, they gave us 4. This year, they'll give us 2. That's the market expectations, and market expectations relative to the Fed. Jonathan, I see you brought it. You're about to bring up something.
We can put that up for you, Jeff. We can
pull it up.
Dots go on the Bloomberg, the summary of economic projections from the Fed. The story over the last couple of years has been as follows, and you know it well, Jeff.
Oh, yeah.
The market, a lot more dovish than the Federal Reserve.
Yes.
How does that change in the next couple of months? And I just wonder whether the market becomes a little bit more hawkish than the Federal Reserve, and it's the market that's been right.
Well, the market has been right, and what you see is that the market and the dots have gotten closer. With this big increase in the post-election result, now the dots in the market are less off, at least in those front contracts you see here for 2017, and that's good news. For a long time, we had this issue about the dots versus the market, and the market was right, and the Fed brought the dots down, and now the market's come up. So there's less uncertainty about that impact of the pace of at least the near-term increases from the Fed. The longer-term issues, however, are a bigger story, right? Because of Trump, the election, changes to the Federal Reserve. We have many more board seats and governors that are going to be coming up for renomination or new seats to be held. And that's going to change the tenor of the Fed. But that's a little bit longer.
And, Jeff, how hot is too hot? Or is it too soon to ask that question?
So, you know, too hot is not yet the case because inflation is still running below 2%, right? So we're running 1.7. We think we'll get about to 1.8 in terms of the Fed's preferred measure, core PCE. Their target is 2%. So too hot is going to be a conversation we begin to have only once you get inflation above the 2% level. Then that debate about are we running it too hot? Is the Fed behind the curve? All that will come back in, but we're still trying to get those inflation figures back up. The base effects notwithstanding, it's really about the core levels of inflation. And if we can get core levels of inflation up to 2%, then maybe we'll start to have that conversation.
And my real question is what happens to the neutral rate? If you take a look at the Bloomberg here, you can see the neutral rate has picked up a little bit. We're in positive territory. But the idea is if it moves up far enough, it means that the Fed actually has more room to hike. The lower it is, the less they can actually hike. What happens here?
Okay, so when we talk about this idea of the long-run equilibrium rate or the neutral rate, it's really just another code word for growth. And what is the kind of growth that we can deliver? If we can only deliver low levels of growth, 2% type levels of growth, then what comes out of that equation is these low levels of interest rates. If we fundamentally, through structural reform, fiscal policy, productivity changes, lest I say immigration reform or demographic things that you can change that outlook on growth and raise it, then the neutral rate isn't as low as what we once thought, and it can be higher.
You're not asking for much. Jeff Rosenberg, thank you very much for joining us. BlackRock's, of course, chief fixed income strategist. Coming up on this program, pushing policy. The U.S. president-elect says he'll ditch the Trans-Pacific Partnership Agreement on his first day in office. Richard Haass, president of the Council on Foreign Relations, joins us next. From New York, this is Bloomberg.
This is Bloomberg Daybreak. I'm Alex Steele at 7:30 a.m. on Wall Street, 12:30 p.m. in London. Here's what you need to know at this hour. Party like it's 1999. All four major U.S. equity benchmarks rallied all-time highs for the first time in 17 years as commodities surged. Death, taxes, and a rate hike. The market's certain of the Federal Reserve moving next month as the implied probability hits 100%. And Donald Trump targets trade. The U.S. president-elect says he'll withdraw from the Trans-Pacific Partnership on his first day in office. And that is what you need to know. John?
Big session for the markets yesterday then for the equity bulls, that is. Futures, will we get another record high? We're up 51 points on the Dow, positive 5 points on the S&P 500. Big rally in the commodity complex. Get to the other board. Crude up by over 5 full percentage points so far this week. We tread water now at 48.27. In the G10 space, it's a mixed session for the dollar, but the outperformance coming against the pound with the cable rate dropping to 124.49, down by about 1/3 of 1%, David.
Okay, Jonathan, big news out of the Trump transition team last night, and that came when the president-elect released a video statement on his priorities for the first day he takes office. Right up at the top of the list is withdrawing from that Asia trade deal negotiated by his predecessor, and that gives us our morning must-watch.
On trade, I am going to issue our notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country. Instead, we will negotiate fair bilateral trade deals that bring jobs and industry back onto American shores.
Joining us now is Dr. Richard Haass. He's president of the Council of Foreign Relations and a former senior official in President George W. Bush's State Department. Welcome to the program. Good to have you.
Good morning.
So, Richard, how big a deal is this really? I mean, it's interesting that he chose this point of trade to be the first thing he talked about.
Well, it's a big deal economically. It's an even bigger deal strategically because it knits together a dozen or so countries. It's an important source in general trade of calming down the world. The only good news from where I sit, because I actually believe in trade, David, is that he talked about bilateral trade agreements. It's the first time we've actually heard something. Now, it's second best or third best, don't get me wrong, but the fact that at least he, in principle, showed some openness to trade, to me, it wasn't, that at least was slightly new.
But, Richard, how realistic is that? I mean, since World War II, since GATT, we've done this multilaterally because it's just really hard to negotiate with 200-some countries around the world.
It's beyond inefficient. It will take years. It's not as good. There's certain issues you simply can't deal with bilaterally, subsidies and things like that. On the other, don't get me wrong, TPP is a far preferable approach. Now, we do, though, have bilateral trade agreements, for example, with South Korea. So there are examples. We have trilateral with NAFTA, which, by the way, he also said he wants to reopen and renegotiate. So this is, again, it's second or third best. You know, what else can I say?
Let's talk about this region specifically to begin with. The vacuum that this will lead, and whether the happiest person right now is a certain president over in China.
Xi Jinping, whatever you pop the corks of in China, I would think Xi Jinping is feeling very good.
Yeah.
And already some traditional allies like Australia and others are essentially saying, okay, the new center of gravity. It's also interesting to take one step back. The big idea of Mr. Obama's foreign policy was the rebalance or pivot to Asia. It had a military, a diplomatic, and an economic component. This is the economic component. It's like a three-legged stool without the third leg. So, again, this to me is it's an unfortunate way to begin. Life's tough enough. Mr. Trump is inheriting an unbelievably full, difficult inbox. What he's now done is taken that already piled high inbox and added something else to it. Now he's basically got to deal with the trade issue, which was essentially settled. I think it was, though, simply too much of a symbol for him and Hillary Clinton and Bernie Sanders. The only thing, if I'm wrong, I might be wrong, but the only thing all three candidates agreed with was that TPP was bad, which is unfortunate because it turns out that TPP is actually quite good for the United States.
So can you walk me forward, say, 6 to 9 months, as he gets into office and he tries to make sort of bilateral deals happen and he says, hey, wait, this is really hard, I can't do it. How does that wind up playing out?
Well, it either means you don't have any new trade agreements for several years. You could, in principle, two other options. One is to try to renegotiate TPP. It's just extraordinarily difficult given that you've got a dozen fingers involved. The other thing which I've been favoring, and I hope it's not too late, is he gets to the point and he goes, wow, this is not working. What you could do is have a side agreement. You could keep TPP, and then he could negotiate a deal with the Congress, and they could find all the understandings and side agreements they want to, quote-unquote, improve remove TPP, deal with currency manipulation, deal with workers who have lost jobs, have retraining accounts, portability of this or that safety nets, which is the approach that I favor. So it's not inconceivable, but I think it's extraordinarily difficult simply because TPP has taken on a symbolism for economic nationalists. So my hunch is it's probably dead.
Richard, is it as important what Mr. Trump did not say yesterday as what he did? As someone who's admitted that he's in favor of trade, he did not say we're going to declare them a currency manipulator in China on day one. He did not say we're canceling NAFTA on day one, which he has talked about on the campaign trail. Is that somewhat encouraging?
Yeah, I think we're all in that position, David, kind of looking for glimmers. The answer to those, yes. To talk about reopening NAFTA, well, Canada and Mexico will have their issues too. So in principle, it kind of depends. And NAFTA is an old agreement, so there are things that could and should be done to improve it. This doesn't look like a trade war with China, and that would be a truly Pyrrhic war. Both sides would lose enormously. I think the hit to our growth, the hit to our GDP would be significant. China would also be a big loser, given how important the U.S. export market is. So the fact that we may not be going down that path again, potentially okay.
This all plays into a story that's played out in markets quite clearly for a lot of people, which is the guy on a campaign trail is going to be very different to the president. And I just wonder whether pulling out and saying, you know what, TPP's dead is just an easy compromise for this guy to appease the electorate, the people that voted for him, but actually not do so much damage, given that we don't have TPP anyway.
I feel like I'm on a set of optimists this morning. You may be right. And there's always a question between campaigning and governing, and there's never a one-to-one linkage or correspondence. And we're seeing that on Obamacare. We're seeing it on other things. What I don't know yet is what's the substitute here. Okay, bilateral trade deals. Do they basically try to do in a dozen or so deals what TPP effectively tried to do, or is it something fundamentally different on the details? If it is fundamentally different, he won't succeed. This is actually a good deal for the United States. As you know, our tariffs are already low. Everybody has access to us. What this would have done is moved a long ways towards leveling the playing field that would have helped American exporters. So the question is, can you get that through bilateral slices rather than doing something that's the loaf approach?
So Richard, as Jonathan suggested, it's a little hard to know really what Donald Trump's policies will be, and that's why we're so focused on the team that he's assembling around him. We really only own one member really right now for this area, and that's National Security Advisor, General Flynn, right? What should he be looking for? What sort of team would help him best accomplish what's best for the United States?
Well, your emphasis on the word team is right. We've been looking at everything in isolation. Secretary of State, Secretary of Defense. You've got to look at it as a team. What's the balance? General Flynn is not your traditional choice for National Security Advisor. He's brings with it, shall we say, some baggage, given some of his published positions, his views on things like Russia, on Turkey. So this to me would increase the desirability of having somebody like a Mitt Romney at state, a more moderate, more balanced, quote-unquote, sort of a more reassuring figure for the world, somebody like General Mattis for defense. But again, it's one of the reasons it was odd to announce General Flynn in isolation rather than looking at the totality of it, because you really do need a balance of strengths, expertise, temperament.
Does the appointment of General Flynn indicate anything about the way he will handle his national security advisor? Because we have very different models. You have a Henry Kissinger, who's really a substantial policy person. You have other people, maybe a Condi Rice, who's more of a convener. Do we have any indication of what Flynn will be like?
The job has two hats. One hat is the honest broker, the person who makes process work. The other hat is a counselor. The danger and the difficulty is making sure the counselor hat, the advisor hat, doesn't get in the way of the person who ensures due process. And that's a big question, quite honestly, about General Flynn, whether he can get that balance right. It's not easy. Brent Scowcroft, President Bush the father's national security advisor, who I work for, got it better than anybody else, but it is awfully difficult. I think what it also shows, though, because we don't know the answer to that question, is the White House centrality. That's been a real shift in American foreign policy over the last couple of decades. I'll give you one number. The size of the NSC staff is somewhere between 5 and 10 times as large now under Susan Rice as it was under Brent Scowcroft.
Wow.
I don't think it's 5 or 10 times better. And so what it shows, though, to me, is that you really have a White House-centric operation. And if you look at this White House, you've got the president, you've got Mr. Bannon, you've got the chief of staff, you've got General Flynn, you've got family members. It suggests to me, again, a certain White House centrality to the entire national security process.
But then looking ahead to Secretary of State, let's look at some of the names, right? You said Romney, we already spoke about, Rudy Giuliani, Senator Bob Corker, also Governor Nikki Haley and John Bolton, right? If you were to kind of outline like one adjective of the foreign policy based on who might get that slot, what would it be?
Well, I don't see a consistency in those names. So if you're Donald Trump, you basically, what do you run on? You ran on a policy of quote-unquote America first. Let's not have any more foreign policy than we need, which I think is essentially Mr. Trump's approach. So that to me would suggest the more combative people, particularly given that you've already got General Flynn, who's plenty combative, might not be what you need. So that would argue to me either towards Senator Corker or somebody like Governor Romney. Those seems to me to be the people who have a more traditional, if you pardon the expression, diplomatic approach to the world. Last I checked, that's one of the job descriptions of the Secretary of State.
Kind of a pun at 7:40, maybe, from Richard Haass. Thank you so much. All right, Dr. Richard Haass, President of the Council on Foreign Relations, is sticking with us. So coming up, bonding over Brexit. President-elect Donald Trump touts Nigel Farage, leader of the UK Independence Party, for ambassador to the U.S. We'll discuss that next. This is Bloomberg.
This is Bloomberg Daybreak. I'm Emma Chandra here in the Hewlett-Packard Enterprise Green Room. Coming up on Daybreak, PIMCO CIO of Global Credit, Mark Kiesel, joins us.
U.S. futures continuing that record rally that they saw yesterday. In fact, if the Dow and the S&P opened right now, it would be yet another record and intraday high. But digging deeper into what's moving the rally, it's really all about the commodity stocks. And over in Europe, you can really see it. Glencore up almost 5%, BHP as well, and ArcelorMittal up over 5%. In addition, iron ore sees the first gain in 6 days. It's up 20% in just a month. Goldman says go long commodities as the first time in 4 years. The commodity you name it, it is higher, along with copper, tin, zinc, metal, whatever you name, it's higher. That's helping these metals as well. All right, individual names looking out for as well is Palo Alto, a cybersecurity firm falling over $20 a share, down 10%. Revenue missed, but really its outlook disappointed. It now sees 2017 growth outlook at the high end of 31%. And Boeing slightly higher in pre-market, up by 0.6%. It's named Kevin McAllister to run its commercial aircraft division. He was a 27-year vet of GE Airline division. Also, I should point out the new CEO, Dennis Muilenburg, will replace the chief airline salesman last month. So a little bit of a shake-up there in the C-suite over at Boeing. John?
Alex, thank you very much. So it is probably the most talked about account on Twitter. It is at Real Donald Trump with 15.7 million followers. And curiously, this came out. Many people would like to see Nigel Farage represent Great Britain as their ambassador to the United States. He would do a, quote, great job. Now, the UK's government has turned around and says, well, there is no vacancy. So they haven't completely ruled out the prospect of this happening. Back with us is Dr. Richard Haass, President of the Council on Foreign Relations. We were talking about Diplomacy 101 in the commercial break. This quite strange and probably not in that book.
If it was, I must have missed that page or that class. I was probably cutting school that day.
What do you think of this kind of approach, though, to relations with the United Kingdom and relations with Europe, full stop, to elevate a certain Nigel Farage to the position he's been put in by the President-elect?
Well, one thing we know is that Nigel Farage will never be ambassador to the United States. That's one thing. Two, it's hard to see how this keeps the special relationship, shall we say, special. It probably does, though, anoint rather than appoint Mr. Farage as some kind of a special go-between. He's already seen President-elect Trump. Mr. Trump came out in favor of Brexit during the campaign. He obviously sees himself somewhat in the same mold of economic nationalism and populism. And I think it's just it's a freebie. It's one that you could give a shout out on Twitter. In the meantime, Britain is actually extraordinarily well served by Sir Kim Darroch, who used to be the national security advisor essentially to the former prime minister, is a real professional. And over the years, I would say Britain has been better served by its ambassadors and, in general, by its diplomatic corps than any other country. One of the reasons this relationship has been, quote-unquote, special, and this country is punched above its weight, is it attracts extraordinary talent into its diplomatic corps, and they tend to send us their best.
So broadening this out, you mentioned the inbox that Mr. Trump faces. What does this tell us about the inbox he has with respect to Europe? There's a lot going on in Europe right now, not just Brexit, but the elections in France, Angela Merkel redeclaring, the referendum in Italy. There's a lot going on there, not to speak of Vladimir Putin.
There's all of that. There's refugees. There's still a Greek economy. That's trouble. I think the first test is the one you mentioned, December 4th in Italy. If Mr. Renzi loses that vote, and he may well, I think it could go either way, that could possibly trigger as early as December 5th a real economic crisis in Europe, a banking, real pressure on banks. But more broadly, Europe, in a couple of years, David, has gone from the most stable, almost predictable, boring part of the world to now anything but. It's unfortunate because the last time Europe was interesting, it was an unhappy story, shall we say, for the entire world. But we're seeing populism, we're seeing nationalism, we're seeing Russian aggression. The entire European project, which has been one of the great accomplishments of modern history, to make war unthinkable in Europe, that's beginning to fray at the edges or even unravel. So, yeah, suddenly Mr. Trump, part of Mr. Trump's inbox, we knew it was going to be the Middle East. We knew about Asia and North Korea and China. But suddenly, in the last couple of years, Europe has gone from stability and almost predictable boredom to now something that is incredibly dynamic and incredibly dangerous.
America promoted that stability in a very, very big way historically. And I think what's interesting about sewing a couple of these stories together, we're talking about the United States leaving a vacuum potentially in one region of the global economy, stepping away from TPP. But at the same time, he is influencing in some way what's happening in Europe. He is trying to do that. That tweet for us is a joke. We sit here and we laugh. Maybe it is funny. But there is some significance there, Richard, that he is trying to shape relations with the UK via Farage. And you just wonder how he tries to do that through the rest of Europe.
Yeah, we have to be careful here. We take for granted European stability, but it's actually one of the real assets. It's one of the real positives in the world. It's meant that we didn't have to worry about it. It also meant that Europe was more often than not a potential partner of the United States in dealing with other troubles around the world. You know, it's almost like oxygen. You don't notice it until you're missing it. Well, European stability tends to be a kind of geopolitical oxygen, and we have to be very, very careful not to do anything that upsets it. And we've raised questions about our commitment to allies. And I just think that there's some repair work the United States needs to be doing with Europe to reassure, because right now there's more on the circuits of Europe than Europe can effectively handle. Positive result potentially in France the other day. That's a piece of good news. But again, we've got to worry about Italy, and more broadly, there's just still the sheer number of difficult challenges facing Europe. And we haven't even mentioned the other, which is low economic growth. Europe can't get out of its own way.
But a lot of those issues you list are internal to Europe. Right. They're not something the U.S. can directly affect. So let's help Mr. Trump on his inbox when it comes to Europe. What could he do affirmatively to help Europe? or at least not get in the way.
Fair enough. I think it's a good point. And lots of the EU, intra-EU issues, Brexit, I don't think we're a major player there. Where we could help Europe is geopolitically. We could continue to strengthen NATO. That began under the current administration and needs to go ahead. I would have some outreach to Russia, and if you'll forgive the phrase, I actually would have a reset. I would try to work things with Putin, show Putin some respect, send them a high-level envoy, and try to stabilize that relationship. Essentially, try to calm the geopolitical side of Europe and buy Europe some time and space to deal with the intra-EU issues, Brexit, whatever happens in Italy.
Let's wrap it up with a little bit of optimism then, shall we? Is that one of the positives that might come out of the
Thanksgiving's about to come.
Is that one of the positives that might come out of it, the relationship with Russia, showing that, as you said, maybe we should show a little bit more respect? Maybe the United States should do that with President Putin. Is that what we will see?
Look, I think you'll see that from the administration, whether it translates. And that, the two immediate places to look are Ukraine, whether we see any change in Russian policy, not in Crimea, I don't expect that, unfortunately, but in eastern Ukraine, that we don't see further Russian mischief-making in other parts of Europe, particularly NATO Europe. And then the biggest and most immediate question is Syria. Will we see some Russian restraint in terms of what they do, in terms of the kind of support they lend Mr. Assad? Alas, we're not seeing it, but that ought to be toward the top of the agenda.
Richard Haass, a real privilege to have you on the programme to get your insight. Of course, the President of the Council of Foreign Relations and a former senior official in President George W. Bush's State Department. That gets you up to speed on some of the action geopolitically and, of course, in the world of President-elect Donald Trump. Let's get your headlines outside of the world of business and more with Emma Chandra.
Thank you, John. KKR has agreed to buy Japanese auto parts maker Calsonic Kansei. The price, $4.5 billion. That represents a 28% premium over Calsonic's last closing price. Nissan owns a 42% stake in Calsonic. It's been looking to spin off less important businesses so it can focus on electric vehicles and self-driving cars. Volkswagen is launching an offensive in North America. It will expand its line of SUVs and sedans and start making electric cars in North America in 2021. VW is trying to rebuild its tarnished image following that diesel engine emissions scandal. Swiss drug maker Novartis may sell some of its best-known drugs while it concentrates on generics and other products. According to people familiar with the matter, Novartis may sell ADHD treatment Ritalin, schizophrenia drug Clozaril, and Alzheimer's treatment Exelon. They could fetch more than $300 million. And that's your Bloomberg Business Flash. I'm Emma Chandra. This is Bloomberg. Alex.
Thank you so much, Emma. Well, coming up, Nigeria says that OPEC is on course to finalize the details to their production cuts. I have the three charts that show you why Goldman Sachs is more optimistic on a deal. That's next and Off the Charts. This is Bloomberg. oil relatively flat, but nonetheless, there is a lot of optimism in the market that an OPEC deal can get done. Goldman Sachs out yesterday saying the stronger OPEC cut rationale, they're raising their short-term price target to $55 a barrel in the first half of 2017. Here are the charts that explain why. This comes to us from Goldman Sachs. The blue line is the market imbalance as of the end of September if there is a cut from OPEC. The orange bar is if there's no cut from OPEC and there's no oil freeze. Now, they point out that even if OPEC continues pumping at this level, you will still see a deficit in the third quarter of 2017. Now, if there is a cut, you'll see that that deficit start to occur in the second quarter of 2017. So their rationale is OPEC, why not? OPEC can actually opt for a shorter-term production cut and help balance the markets faster than if they didn't. And that's a huge rationale for Goldman of why they see OPEC agreeing to the deal. The other part is that we've seen a lot of production rollover, especially in high-cost areas like China, Mexico, Venezuela, U.S. conventional, as well as Colombia. And this chart tells that story. Crude production in those areas is now down under 12 million barrels of oil a day. So if demand picks up, demand holds up, you're really going to feel that squeeze sooner rather than later. So the real question then becomes, what does a successful OPEC cut wind up looking like in the market? And Goldman had a really interesting take here. They said it wasn't about the absolute level of oil. It was instead about the curve. Now, this chart is the 1 month to 5 year forward curve of Brent. So this is prices out in 5 years. It's currently in contango because it's negative. That means that prices are much cheaper today than they'll be in 5 years. What that does, if you're a U.S. producer, for example, you can go in and you can hedge and you can sell production forward because prices are much juicier at the back end of the curve. Now, what Goldman says is if we're able to see a deficit in an OPEC cut, you could actually see backwardation. That's when prices are much more expensive today than they'll be in 5 years. And that hurts the hedgers, it hurts the U.S. producers, and that would be the perfect cut, lowering the curve to squeeze the market. John?
Alex, thank you very much. It's a great chart. It's been a big story in this market. Coming up in the next hour of Daybreak, JP Morgan Asset Management Chief Investment Officer and Head of Global Fixed Income, it's Bob Michael. In the markets, equities sitting pretty at all-time highs. Dow Futures suggesting we'll get another pop at the open. We're up 53 points there, positive 5 on the S&P. From New York, this is Bloomberg. Good morning and welcome to Bloomberg Daybreak on this Tuesday, November 22nd. I'm Jonathan Ferro alongside David Weston and Alex Steele. In the markets then, some records to talk about, potentially some more. Futures up 54 on the Dow, positive 5 points on the S&P 500. In the bond market, some stabilisation for treasuries with yields lower through much of the morning. 10-year treasuries down by 2 basis points at 229. And a mixed session for the dollar. Some dollar strength on the margin. Dollar yen back to 110.96, David.
And Jonathan, here's what you need to know at this hour. Party like it's 1999. All 4 major U.S. equity benchmarks rally to all-time highs for the first time in 17 years as commodities surge. Death, taxes, and a rate hike. The market's certain now of a Federal Reserve moving next month as the implied probability hits 100%. Donald Trump targeting trade. The U.S. president-elect says he'll withdraw from the Trans-Pacific Partnership on his first day in office.
I am going to issue a notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country.
And that's what you need to know. And now it's over to Alex.
All right, well, digging deeper into what you were talking about in terms of all major equity indices rallying, this is what we've seen just in the last 2 weeks. This red line here is the Russell 2000. The purple is the NASDAQ. The blue is Dow Jones. And the white is the S&P. And ever since the election, you can see all of them rallying to record highs. The first time they all closed at record highs since 1999. Now, of course, that comes at the expense of bonds. And this shows the Bloomberg aggregate Barclays index that takes into account sovereigns as well as corporates. It's that blue line, and the white line, of course, is the S&P. And what we've seen over the past few months, really, has been that bonds and stocks have rallied together. That was a lot of worry for many investors. You have risk parity funds that own 60% stocks, 40% bonds. If you get a bond sell-off, are they forced to then sell stocks? The answer, so far, is no. The S&P continuing on their rally while bonds continuing to sell off. Does that wind up closing, or does this inverse correlation that we've been used to over the last few years continue? But what we do know is that we've seen a lot more volatility within bonds than we have in stocks. This white line here is the MOVE index. That's volatility for treasuries. And this blue line here is the VIX, volatility for stocks. That spread is now the highest that we've seen since 2013. Now, Bank of America says that the MOVE index is well below its average for its volatility, which means volatility could continue in treasuries while stocks continue lower. John?
Alex, great work. Let's talk about this, particularly that chart that shows the divergence between what's happened with the bond market over the last couple of weeks and what's happening with the equity market. I want to bring in Bob Michael, JP Morgan Asset Management Chief Investment Officer and Head of Global Fixed Income for FX and Commodities. Bob, historically, it's a story that makes sense. One asset class, maybe it's bonds, maybe it's equities, underperforms whilst the other one outperforms. Historically, yes, but recently, no. And a lot of people are asking the question whether that divergence can continue. What's your view on that?
Well, it's been a 35-year bull market in bonds. Maybe it's time for somebody else to do the work. I think the divergence continues. And I think what we have to get our mind around is that we lived in an era of distortion driven by monetary policy since 2009. And as it's clear that's going to begin to fade. Certainly in the U.S., you're left to market dynamics again. And in a reflating economy, bonds look too expensive and equities look pretty good value.
The idea that central banks are stepping out of the way, and we lived, past tense, in a distorted market. We live in a distorted market, and we're likely to live in a distorted market for a long time to come. Are we talking about a marginal shift as opposed to really free markets, price discovery making a comeback without a central bank involved?
I think the Fed is about to lead a seismic shift. And I don't even know if they're aware of that, because when you listen to the rhetoric coming out of the Fed, it's too sanguine, in my opinion. They're talking as though the Fed funds target rate is close to zero on a real basis. For God's sakes, we're at a quarter to a half. It's hugely negative. It was going to be a difficult next couple months anyway for central banks and the bond markets because U.S. corporate profits had picked up, so the earnings recession was over. You were looking at commodity prices picking up, and the year-over-year headline inflation data was going to be much higher because energy had stabilized around $45 a barrel, and you had talk of the ECB tapering. You put behind that some enormous, yet I get it, unknown policy stimulus, but it's coming on all fronts. It's coming on the fiscal spend side. It's coming in tax cuts. It may come in deregulation. Those are enormously powerful tailwinds.
So what's the pace of reallocation for that? Because during the taper tantrum, we basically saw the rotation, about $400 billion of annual flows out of bonds and into stocks. What kind of pace can you expect this time?
So a lot of that is going to come from what the central banks actually do and what the normalization process looks. If I were on the Fed, I'd advocate raising rates in December and going every other meeting in 2017. And I know that seems aggressive from where we were, say, 3 weeks ago, but this time last year, that's what we were talking about for 2016. And if that's the case, I think you could take that 30-year down channel in bonds and create the mirror image of that, and that's what bond yields will look like for, say, the next 4 to 8 years.
Bob, that's a monster call. So let's talk about some of the structural forces that go against that. A savings glut, an aging population, a demographic shift that's unlikely to turn anytime soon. They're structural forces that should keep a lid on any potential bear market in bonds. What do you say back to that?
So the secular stagnation argument is real because there has been a preference for savings over investment over the last 8 years. But how much of that has been driven by regulatory reform? How much of that has been driven by our tax structure? How much of that has been driven by just recovering from the financial crisis? Are we getting to a point in time where if you put in place something like Trumponomics and you have this blend of fiscal stimulus and structural reform, that actually begins to create the incentive to spend, consume, and invest rather than save? And I think that's an enormously powerful tailwind. I step back and I look at it and I say, 3 weeks ago, there was a 5% probability that Trump would win the presidency and that the Senate would go Republican. The House, everyone had on their books as going Republican. That 5% probability is now everyone's central case. You're telling me in 2 weeks' time the markets have completely shifted from 8 years of that 5% probability to now what seems to be the central scenario? I don't buy it.
Bob, you must have some sympathy, though, for Janet Yellen. She said she wants to run the economy under higher pressure, really get it going faster. The Fed has had month after month after month of predicting we're going to be here, and it hasn't happened. The markets have always said, no, you're not going to raise. So it makes sense that they're going to be cautious right now, because we don't know what really will get done with fiscal stimulus. We don't really know what's going to get done with reform, with corporate tax reform and things like that. And we also have the trade issue overhanging us. So isn't it sensible for the Fed to be a little cautious?
Oh, well, I think so. And again, this is why I don't think yields go in a straight line higher, and why perhaps this week they look a bit oversold and you'll get a rally. But I think we're shifting into a period where instead of buying backups, you're supposed to sell rallies, because there is a form of policy stimulus coming. And yes, we don't know what it looks like, but I think it would be naive to assume that it's not coming and the only game left in town is monetary policy. That story is done. That was the last 8 years.
Just quickly, Bob, to wrap this particular segment up, a change in expectations, is it enough? 1936, I believe, a very important book in economics was written by a guy named Keynes, and he talked about animal spirits. Just talk to me about how important that is, the shift in expectations, and whether we've stirred that kind of thing up, and whether it can be fundamental, whether it can be real.
So a lot of it is going to be led by companies and their willingness to get out and invest and hire, because either they're incented for a number of reasons or they're starting to see consumption pick up. I would argue that pre-election, we were already starting to see sales pick up and revenue pick up and the top line pick up. And we had seen a lot of stabilization come out of China in particular. So there was some spending growth that was occurring anyway. I think you're going to see a lot more coming in behind it. I think it's more than animal spirits. I get it. It's an unknown, but we can't talk as though the Fed has the Fed funds rate at a zero real yield at about 2%. They're a quarter to a half, and 2.3% 10-year Treasury yields don't make sense in an environment where you're going to get forms of policy stimulus.
Bob Michael of JP Morgan Asset Management is going to be staying with us. But now we want to get an update on what's making headlines from outside of the business world. Emma Chandra is here with First Word News. Emma.
Thank you, David. There's a report that the Trump administration will not pursue investigations against Hillary Clinton. That report comes from MSNBC, citing a source it didn't name. The report has not been confirmed. During the campaign, Donald Trump vowed that if elected, he would launch an investigation into Clinton's use of a private email server while Secretary of State. In San Antonio, a suspect has been arrested in the killing of a police officer. The officer was shot while sitting in his car in front of police headquarters. He's the 20th police officer to die in a targeted killing this year. That's the most since 1995. The UK Chancellor Philip Hammond will pledge to spend $1.2 billion to improve the country's broadband infrastructure. Hammond's proposal will be included in tomorrow's autumn statement. The plan would give 2 million more households in the UK access to full fibre broadband. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg. Alex.
Thank you so much, Emma. U.S. equity futures extending that record rally from yesterday, although off their highs of the session. Here are some individual movers we wanted to focus on. One is Medtronic, down by 6% in pre-market. This is the world's largest medical technology company. Revenue fell in the second quarter, and it cut its full-year earnings estimates. Also taking a look at Signet Jewelers. So that stock is slightly much up by 8%, boosting its full year after third quarter earnings did top estimates. It still expects its full-year comp sales, though, to fall by 1 to 2.5%, but nevertheless, that upgrade boosting that stock. And Palo Alto and FireEye, so we're doing a twofer when it comes to cybersecurity. Both of those stocks lower in pre-market. Palo Alto earnings did beat estimates, but its revenue did miss. It did also lower its 2017 revenue growth. Now at the high end sees just about 31% growth. And FireEye getting hit also by 4%, getting a downgrade from neutral to sell over at Goldman. David?
Alex, coming up, trading Trumpflation. Commodities continue to heat up as Goldman turns positive. Have Donald Trump's spending plans put a floor under commodities? And later, what do the president-elect's plans for trade mean for the global economy and for the markets? That's all ahead. This is Bloomberg.
From New York City, this is Bloomberg Daybreak. I'm Jonathan Ferro. Let's get a quick check of the markets for you. It's been 17 years. That was the last time the 4 major benchmarks in the United States closed at all-time highs. We did that yesterday. Futures up another 45 points on a Dow. We're up 4 points on the S&P 500. Big rally in the commodity complex that Alex and I and David will be talking about very shortly. This is how we trade right now. Up by 0.75%, down by 0.75% rather on WTI. We roll over at 47.87, retracing some of the moves earlier on in the session.
Right, so a little bit of lightness here when it comes to crude, but overall, commodities have had a monster rally just in the past few weeks, except for their biggest 3-day advance since May. And some of the stats are staggering, guys. Copper is up 21% in the past month. Zinc is up 15%. Nickel up 14%. Also with us is Bob Michael, JP Morgan Asset Management CIO and head of global fixed income, FX, and commodities. I keep asking this same question. We say it was all about Trump and his infrastructure plan, but the rally in base metals started before the election. What's happening?
Yeah, I think that's a very good point. We can't give Trump credit for everything. He hasn't taken office yet. I think you have to look at the commodity complex having seen a lot of production cuts. We know about it in oil. We saw rig counts come down. We know that a lot of shale production was shuttered. We actually saw that in mining. We saw a lot of mines had been shuttered as well as China was ratcheting down growth. But what we started to see in the middle of this year was China had stabilized again. They had started another infrastructure spend. So they were net consuming, and they were consuming a lot of commodities, and they were consuming copper before copper took off in the last couple of weeks. I think Trump has added fuel to the fire because now everyone's looking at a bigger unknown infrastructure spend coming in the U.S. on top of already limited production, and that's pushed prices up a lot.
So it's the same question we ask in other contexts. How much of this is real and how much of this is animal spirits, as Jonathan referred to? I mean, specifically with China. We keep hearing China, is back on a growth pattern, but it's transforming from a manufacturing economy and a construction-based economy into one that's really services and goods and consumer. So how much copper are they consuming? How much are they actually using of zinc, of tin, things like that? And similarly in the United States, I mean, I don't know how big this wall is going to be, but how much copper are they going to put in that wall? I mean,
well, I think China's using a lot of copper right now. And for us, the issue is looking at continued consumption and continued imports into China, and that keeps growing and accelerating. So there is a lot that's going on the consumption side. I think there are other parts of the global economy that are also looking at spending. You have Japan also talking about increased spending. So it's not just the U.S. It wasn't just China. There are other parts of the economy that are spending.
And John, Goldman Sachs, when they went long commodities yesterday for the first time in 4 years, talked about this. They're like, look, it's not the absolute level of growth. If you have more demand than there is supply, that's all that matters. It doesn't matter if China's not growing at 10%.
For you, for the bond market, to put the commodity market together for me, we're going to have these favourable base effects. And I just find it amazing how the pendulum has swung from deflation, go long bonds, to inflation, go short bonds, in a space of about 6 months. The base effects are going to be favourable, great. I asked this question to BlackRock a little bit earlier. I'm going to ask it to JP Morgan right now. Are we going to see a little bit of an inflation head fake, given the favourable base effects we're likely to see in the coming months?
I think we would have seen an inflation head fake. I think we would have seen the year-over-year headline data flattered because of the bounce in oil from somewhere of a low around 30 to, maybe if it held 45 to 50. And for those reasons, ourselves and some of our competitors had been buying tips, looking for them to have moved from 1.5% break-evens on the 10-year to over 2%. I think you have to revisit all of those expectations and say, that's going to take us through the first quarter. Then after that, you are going to get some policy initiative, and you are going to see what the infrastructure spend looks like. So from my perspective, I want to own 10-year tips here. They're not at 2%. They're just slightly below. I think they're going back to a place that they traded for a long time, 2.5% with a bias towards 2.75% on a break-even basis.
For all that, we got to get through OPEC in 5 days. All right, Bob, good to see you. Thank you very much, Bob Michael, JP Morgan Asset Management CIO and head of global fixed income, FX, and commodities. Well, coming up, as the president-elect transitions to the White House, many are wondering how his promises on regulation will impact small businesses. Well, we'll discuss this next with the U.S. head of Small Business Administration. This is Bloomberg.
This is Bloomberg. I'm David Weston. After Black Friday this week, we have Small Business Saturday. This is a shopping holiday created in 2010 by American Express and then Mayor Tom Menino of Boston. Last year, small businesses sold over $16 billion in merchandise, and that was a 14% increase over the year before. Joining us now to talk about the important role of small business in our economy overall is Maria Contreras-Sweet. She's head of the Small Business Administration. Welcome to the program. Good to have you.
Thank you. Always good to see you.
So tell us about this Small Business Saturday. I actually have heard it from my kids who say, let's go out into small businesses and buy things on Saturday. But maybe they just want to buy things.
Well, that may be true, and I hope that's the case. But the really important thing to note is that small businesses are creating 2 out of 3 net new jobs. They employ over half of the private workforce. We've experienced I think we're up to 72 months of consecutive job growth. The small businesses are driving our economic recovery, and yet I don't think that we give them their due recognition. So it's so important to acknowledge this day. As you just said, right before Cyber Monday, we have Small Business Saturday, and it's important to go out, shop, and reestablish the main streets.
Now, I have heard that 2/3 number before. Throughout this period of job growth, has that number remained pretty much a constant?
Yeah, we track it pretty carefully. SBA is now at record lending, record investments, and record contracting. The important thing that we're working on now is that small businesses don't see themselves as local, even though they're locally, independently owned. They want to engage in a global marketplace. And so I know that you know that that's why the president's been pushing for trade agreements. If we don't engage and we wait for the perfect, then China will set the rules. And so we need to raise labor standards, environmental standards, to make sure our small businesses have a level playing field.
Yes, as you know, we heard from the president-elect last night. It sounds like that TPP trade agreement's not going to go anywhere anytime soon with the new administration. But take us back now at the end of your administration. What has been the track record of the Obama administration, and what have they done specifically that has resulted in the growth of small business? Not just the growth of the business, but creation of new small businesses.
Right. First, you remember that we passed the Jobs Act, the Jobs Recovery Act, and that allowed banks to raise the lending limit for small businesses. We used to have a small business lending cap of $2 million. We've raised it now to $5 million. We have set stronger standards to make sure that small businesses are getting their fair share of the federal supply chain. And what small businesses really want is they want less regulation. We've taken out scores and scores and scores of regulation and initiated what we call Startup in a Day across the country, encouraging mayors to get into the game and allow small businesses to start up through online solutions their business in a day.
I'm glad you raised regulation because that's such an important element. And as you know, a lot of small businesses have complained about this through the years. There have been studies done that have indicated there's a huge burden that's disproportionately felt by small businesses because of regulation. Is it fair to accuse the Obama administration of not dealing with regulation? Because that is the perception, that in fact regulation has grown rather than reduced.
Quite the contrary. Quite the contrary. First, if you look at what we've done at SBA, we have taken out so many underwriting rules for banks that just weren't sufficient. I'm a community banker. I've started 3 different businesses, and so I knew what the pain was. And coming in, I can tell you that we've taken out scores of regulations. And now with the technology coalition that we've put up, we're able to help small businesses start up in short order.
I moderated a panel for Goldman Sachs in their Small Business Forum a couple weeks ago, and overwhelmingly the biggest issue for everybody was the workforce and how to get the right workforce. What would be your #1 advice to the incoming administration on how to help the workforce gap?
One of the things that the Obama administration has been working on, SBA in collaboration with the Department of Labor, is how to upskill. We need to upskill our employees for the jobs of the future, and I think that's really important. What we've done at the SBA, for example, is the Small Business Technology Coalition that I just described. Small businesses can now find their employees in much more efficient manner. For example, if you're looking for your employees, you don't have an HR department, you can use ZipRecruiter. If you don't have a team to help you sell, you can use Salesforce technologies. So we really urge those small businesses to take advantage of the advent of technology and deploy every tool available to them to optimize their business.
Maria Contreras-Sweet, head of the Small Business Administration. Great to have you with us today. We'll look forward to that Saturday. So, Alex, it really is something we underreport, is this importance of small business for our economy.
Yeah, and part of that panel I mentioned that I was working at is it's also about public-private partnerships can wind up being really important when it comes to growth and it comes to promoting your workforce as well. So that's sort of setting up for the next administration.
Indeed. Okay, coming up, Donald Trump's cabinet search continues, and according to one of his top advisors, there's no rush to fill his top positions. We'll look into Trump's transition process next. This is Bloomberg.
This is Bloomberg Daybreak. I'm Alex Steele. It's 8:30 a.m. on Wall Street, 1:30 p.m. in London. Here's what you need to know at this hour. Party like it's 1999. All four major U.S. equity benchmarks rallied to all-time highs for the first time in 17 years as commodities surge and death taxes and a rate hike. The market's certain of the Federal Reserve moving next month as the implied probability hits 100%. And Donald Trump targeting trade. The U.S. president-elect says he'll withdraw from the Trans-Pacific Partnership on his first day in office.
I am going to issue a notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country.
And that's what you need to know. John?
Alex, thank you very much. Let's get to the market action, shall we? A quick look at things. Futures positive across the board. Could set another record. We're up 44 points on the Dow, up by 4 or 5 points on the S&P 500. In the bond market, some marginal curve flattening with the front end selling off and the long end rallying. Yields dropping on 10 years Treasuries. We're down by 2 basis points to 230 on a US 10-year. And a really whippy session for crude. It was higher. It rolls over. We're down by 0.5% to 47.97, David.
Jonathan, as you know, the country and the world remain focused on the Trump transition. Who will be on his team and when will we learn about them? According to a spokesperson, they're right on schedule.
It could come this week. It could come today. But we're not in a rush to publish names just because everybody is looking for the next story respectfully. Got to get it right. We know that we're ahead of schedule from previous, when you compare to previous administrations in formation, previous presidents-elect.
We are now joined by someone who has been at the center of more than one presidential transition. He is Ambassador C. Boyden Gray, former U.S. Ambassador to the EU and former senior advisor to both President Ronald Reagan and to George H.W. Bush. And I should say a former colleague of mine all these many years ago at Wilmer Cutler in Pickering. Boyden, welcome to the program. Good to have you here.
Nice to see you again.
So from your point of view, having seen this, are they on track? Are they on a path and a tempo that will get them in place to take over come January 20?
At the highest levels, it appears so. I think they are certainly at a level of prior administrations and ahead of some. And so that's pretty impressive. What you don't know is whether they are building up a backlog of the sub-cabinet, which are who are critical to implementing the President's program. Are those backup, are those sub-cabinet officers being properly vetted? Are their names going through the FBI so that when the clearances are done, they'll be ready to be nominated shortly after the inauguration? The top level people have already had some form of vetting, either through security clearances or otherwise. You run into less of that the lower down you go, and the more time it takes for the FBI to do the clearances. So it's really imperative to start now with the FBI.
Well, you make an important point, Boyden, that we tend to focus on the cabinet secretaries and ignore the assistant secretaries and the level just below the top level, and that's where a lot of the work actually gets done. Take us into that process. Who does that work? Who actually does that vetting? And do they have their team put together to actually facilitate that now?
Well, it can be divided between domestic positions and national security positions. But for most positions, the vetting is done by the FBI, and it depends on a form that has to be filled out. It's called Form 86. It's quite lengthy. It's quite tedious to fill out. It takes some time. Of course, the less you've moved and and the younger you are, the easier it is. The older you are and the more you've moved, the harder it is. But that's where it starts, and then if you have assets, even modest assets, personal assets, you've got to go through a financial clearance, and that can take a lot of time and cause some discomfort. So it's a process that should begin soon. I don't think they've named the White House counsel. I think they may be close, but as soon as that person's named, I think it'll go faster.
Well, that's what I was going to ask about. We have not heard about the White House counsel yet. We've heard about the National Security Advisor. We've heard the Chief of Staff, Senior Counselor. You were counsel both to George H.W. Bush when he was Vice President, also White House counsel when you went over to the White House. How central is that, and can that be a roadblock to really moving forward with these appointments?
It can be a roadblock if they don't get that person nominated. Now, it may be, and I don't know, that the current counsel to the transition, who was Dan McGahn, who was counsel to the campaign, he may be moving names through the FBI, but I have not heard that. And the protocol has normally called for the White House counsel to do that. I was at a conference just last week sitting next to Senator Grassley, who is chairman of the Senate Judiciary Committee, important for judges and for Department of Justice confirmations, and he was lobbying me, of all people. Not lobbying him, he was lobbying me as if I could do something about it to get a White House counsel in, because he says we have 6 or 7 judges ready to go, but we can't do it without a White House counsel. So that job is important and should be filled as soon as possible.
So, Boyden, you point to an interesting phenomenon, which is they have a Republican House, they have a Republican Senate, and now a Republican White House. Does that actually increase the time pressure on them? Because they don't have an excuse not to move forward, whether it's an appointment for a Supreme Court justice, we have an opening up there, or also on some of the legislation. We're talking about tax reform. We're talking about perhaps redoing Obamacare. How much pressure is there on them to really get their act together, get their people in place so they can move right away?
Well, there is pressure to do it because the rule of thumb in Washington is you only have a 6-month window, really, to launch policies, because then the bureaucracy closes around you and Washington closes around you. So there is a premium on getting a fast start, because you only have so much time to start to initiate the initiatives that you want to do. It'll then take quite some time to implement them, but to get them started requires having at least a minimum of key people in the sub-cabinet positions.
So, Boyden, I want to turn to Europe, because you were our ambassador to the European Union. And I was going to ask you generally about our relations, but the president-elect has sort of preempted me by tweeting overnight, suggesting who the next ambassador should be from the UK to the U.S., saying it should be Nigel Farage. We've got it up here. Many people would like to see Nigel Farage represent Great Britain as their ambassador to the United States. He would do a great job. Do you have any reaction to that as a matter of diplomacy, sort of asking Theresa May to send him over?
I mean, for us asking her?
Yes. This is Donald Trump tweeting, saying, please send Nigel Farage over.
Well, that's a little unusual, I think. So I don't know how that works out. But at the end of the day, and I don't mean to diminish anybody who serves to or from London, but the relationship is so close that often key issues are discussed just straight by the NSC staff with the British NSC staff. It's only, a 5-hour flight over there. And so London, the embassy and the ambassador probably is less important from a strictly technical point of view than, say, Russia would be, or China, or some far-off country where you don't have the same kind of affinity that we have with a special affinity that we have with Great Britain.
So, Boyden, more broadly, because you understand Europe well, what would you be advising Donald Trump, the president-elect, about what he needs to do with respect to the inbox he has on Europe right now? There are a lot of things going on in Europe, as you know, political developments all over the place, from Brexit to the French vote to the Italian referendum. We have Vladimir Putin making various sounds. What would you advise him about what he needs to do with respect to our foreign relations with Europe?
Well, I think there's been some questions about him in Europe. So I think he needs to go over there, and I think he would solve all the problems of questions about his position if he went over there and talked to the leaders. He really needs to meet them face to face. Telephone is nice, but face to face is better. And so a trip to Europe would I think be one of his first priorities. It's our largest trading partner, our strongest allies, and we have a trade relationship that means our economies are intertwined, and if we want to grow at the rate he wants to grow here, he's got to help Europe get up to the rate that we're growing, and that's a very, very important piece of the puzzle.
Boyden, thanks so much for being with us. That's Ambassador C. Boyden Gray. He's former U.S. ambassador to the EU and former senior advisor to Presidents Ronald Reagan and George H.W. Bush. Alex.
All right, thanks so much, David. Well, coming up, hedge funds looking for an edge, and some are betting on small startups. Point72 Ventures CIO reveals what's behind their investment strategy and lists the companies he's keeping an eye on. Next, this is Bloomberg.
This is Bloomberg Daybreak. I'm Emma Chandra here in the Hewlett-Packard Enterprise Green Room. Coming up in the next hour, Mark Kiesel, CIO of Global Credit for PIMCO.
From New York City, this is Bloomberg. I'm Jonathan Ferro. Let's get you up to speed on the markets very quickly. All-time highs across the board. You know the story. Futures pushing higher as well. At 48 points on a Dow, positive 5 on the S&P 500. In Europe, outperformance on a Stoxx 600, driven by what's happening with basic resources stocks. Get to the other board. Big rally in base metals. There was a decent rally in crude. There was a bid under there on WTI. Then we rolled over. We're down by about a third of 1% at $48.11. Treasuries yields lower by a basis point to 231. Alex, and a little bit of dollar strength emerging in the last couple of hours. Dollar yen back with a 111 handle.
All right, thanks so much, John. So how to make money if you're a hedge fund? Hedge funds have been underperforming since 2014. Average returns over the past 3 years were just 2%. So every hedge fund is really looking for an edge. And Steve Cohen's Point 72 is turning in part to technology. The company has recently dropped big money into financial tech companies such as Cloud9, which is a cloud services company, Acorns, a millennial consumer financial services company, and Quantopian, an algo writing company. And with us now is Matthew Grenade, Point 72 Ventures Chief Market Intelligence Officer. Point 72 invests at the seed level through Series C rounds with an initial investment of $500,000 to $2 million. Matthew, great to see you. Thanks for being here.
Thanks, Alex. Good to be here.
So what made Point 72 decide to take on fintech?
Well, a couple of things. I mean, one is, if you really want to know what's going on in the cutting edge of technology and where innovation is really happening, it's really important to know about startups. And so that's really what we're trying to do at Point 72 Ventures is get to know those companies in the space that are relevant to Point 72 Asset Management, which is really a diversified asset management firm. And so, we're really excited to then work with those companies to both sort of be a client to them and an investor to them.
Exact client and investor. So do you sort of drop the money and say bye-bye, see you later? Or do you also wind up using their services and help sort of like a joint venture partnership at the end of the day?
Yeah, one of the really important criterions in our investment is can we help them? Because if we feel like we can't help them, there's a lot of places to get money. And so every investment, all the ones you named, we're helping them day to day with sort of their most important strategic priorities. Whether it be introductions to large banks or introductions to customers or how to trade or, as a customer of their technology product. It's really critical to our investment thesis because on the one hand, it's how you really know that you're making a smart investment, that you can be an informed customer. And number two, it's how you're really a great VC to these companies because you're able to help them.
So what's the relationship with the ideas and Steve Cohen? Are you independent or you go to him and say, hey, Steve, I got something cool, you got to look at it?
Steve's, well, first of all, Steve's really engaged in the startup landscape, and he just loves the energy around startups. So, he is very involved, and he's on the investment committee and so every decision basically ends up with me and Pete, our other partner, and Steve having to talk about it and, kind of getting his view and having his opinion kind of in that process. And so it's great to do that with him because he's a liquid markets investor for 30 years now, and one of the really interesting things is the lens he then brings on things because he wants to talk about multiples, he wants to talk about growth rates, he wants to talk about how much are we paying for this, and those traditionally aren't things you hear in a VC process, and so it's kind of bringing a new lens and a discipline to our process. It's very exciting for me.
Well, that's actually a great point because I want to talk about valuations. How do you value these companies, and are they overvalued? Like, how do you deal with that?
Yeah. Well, I mean, look, you mainly value them on revenue if they have revenue, and there are sort of multiples in the market. And if you've sort of been doing VC for a while, you sort of understand what those multiples are. Certainly over the last year, they have come down in most spaces. Probably the exception being machine learning and artificial intelligence, where the prices are still, in my opinion at least, very, very high. And then with very, very early stage deals, where there's not revenue, there's kind of just accepted norms about kind of what you pay kind of given a team and things like that. But startup investing is a bit of an act of faith, like you're betting on something big happening down the road.
Is a Steve Cohen an active faith guy though? How hard do you have to work?
We have to work very hard. I mean, he often ends up meeting with the entrepreneurs themselves because if we're really betting on the team, he wants to understand kind of what they've got. And then I think it's as I said, very energizing for him. And then it also helps with his public market investing because the fact is that these companies are the ones that are disrupting, the big public companies. And if you trade automotive stocks these days, you've got to understand what's happening with artificial intelligence and self-driving cars and these sorts of things. And so, for us as a firm, it really sort of has a lot of different advantages.
And your exit strategy? Is it IPO? Cash out?
Well, there's a lot less IPOs these days. I mean, normally, these companies will get bought by someone along the way. I mean, it's obviously very, very exciting if a company goes all the way to an IPO, but I would say nowadays you sort of have to count on that less and less.
Matthew, great to talk to you. Thank you so much. Matthew Grenade, Point72 Ventures Chief Market Intelligence Officer. Great to get your perspective. All right, time now for other stories making headlines at this hour. Here's Emma Chandra with your Bloomberg Business Flash. Emma?
Thank you, Alex. A pilot strike is threatening to ground flights for Amazon and DHL during the holiday shopping season. The 250 pilots work for a subsidiary of Air Transport Services Group, which operates 80 flights a day for Amazon and DHL. They say they're overworked because the carrier doesn't employ enough pilots. No comment from the airline. Volkswagen is going on offense in North America. It will expand its line of SUVs and sedans and start making electric cars here in 2021. VW is trying to rebuild its tarnished image following that diesel engine emissions scandal. And Swiss drug maker Novartis may sell some of its best-known drugs while it concentrates on developing generics and other products. According to people familiar with the matter, Novartis may sell ADHD treatment Ritalin, schizophrenia drug Clozaril, and Alzheimer's treatment Exelon. They could fetch more than $300 million. And that's your Bloomberg Business Flash. I'm Emma Chandra. This is Bloomberg. John.
Emma, thank you very much. Let's get to Bloomberg Trends, shall we? A look at the top stories terminal users are reading on the Bloomberg, and you can find these, of course, on Read Go. If you're in the market for a new job and you want an unlimited balance sheet, I'm sure there's a lot of fund managers out there licking their lips. Take a deep breath and get set for what the pay looks like. So this amazes me. If I was to say to you, what would you get paid more for, running the Fed, running the ECB, or running the Belgian Central Bank? I imagine you wouldn't say the third one. Benchmark of Bloomberg Benchmark, who put together some economic analysis, have basically broken down what you can earn by running each and individual central bank. The Belgian Central Bank governor taking home $409,400. That's Draghi's pay. The Belgian Central Bank governor takes €480,000 versus Draghi's €386,000. This makes no sense to many people. And if you want to work out what Draghi makes, say, versus Yellen, you've got Draghi at $409 in dollars and Yellen south of $200,000.
Really?
But topping the lot over in Zurich, Thomas Jordan, 876,500 Swiss francs, and he gets an annual train pass as well.
It's important to have that rail pass.
There you go.
Those are really expensive, though, aren't they? No, legit. That's like a bonus.
Instead of a car and driver, you get it.
So under 200,000 or under 300,000 for Yellen?
So Yellen under 200K.
Wow, I would not have guessed that.
Well, that's the most fun trend, so I'm not even going to compete with that. This is a little bit more serious, but this is Brexit may save European growth after all. There's a new book out by an economic historian, well-known, Joel Mocher, who actually says in history, Europe has benefited economically enormously because it was divided, not because it was united. That, in fact, it caused competition, a little bit like we have a federalist system here in the United States, competition among the various countries for the best talent. And if they were all unified, there would have been one rule, and that's why, for example, China and the Middle East got left behind.
So this book appears that the negotiations...
Yeah, exactly. Brexit may be good for you economically.
Okay.
That's the thesis, basically.
Remains to be seen, right? Well,
right.
so far, so good. So far, not terrible, I guess, is the takeaway there.
Right.
All right.
Okay, coming up, what the spike in bond yields could do to home sales in the United States. That's next in Battle of the Charts. This is Bloomberg.
From New York City, this is Bloomberg. I'm Jonathan Ferro. Let's get you up to speed on the markets very quickly. The equity market front and centre setting records yesterday for the first time in 17 years. The Dow, the S&P, the Nasdaq and the Russell 2000 simultaneously rallying to an all-time high. Will we extend those gains? We're up 45 points on the Dow, positive 4 or 5 points on the S&P 500. In Europe, if you break down the equity market into the individual 19 industry groups, you see basic resources outperforming off the back of a big rally in base metals. Crude was higher as well in the commodity complex. We roll over just a touch. We're down by 0.6% at $47.93. In the Treasury market, some marginal curve flattening, the front end selling off, the long end rallying, 10-year yields coming down by 1 basis point to 231, and some marginal dollar strength in there as well. We reclaimed a 111 handle a little bit earlier today on dollar yen. 124.17 is how we trade on a cable rate. Coming up a little bit later, these are the dates, the times, the things to put in your diary. 10 a.m. October US existing home sales, then 1 p.m. Eastern time, the US to see $34 billion in 5-year notes coming to markets. The US Treasury will be selling that. Yesterday, 2-year notes came to market, issuing the highest yield on that particular security since 2009. Incidentally, the implied probability right now of a rate hike in December, 100%. David, I'm told nothing in life is certain, but apparently the implied probability suggests that December we should all go home because the Fed is raising interest rates.
Well, we've been saying today it's death, taxes, and a Fed rate hike in December. So there you have it. So it's time now for Battle of the Charts. Bloomberg Gadfly's Lisa Abramowicz is taking on Alex. And Lisa, if I'm not mistaken, I think your chart is related to that U.S. existing home sales coming out later today.
Yes.
Beautifully done. I like that.
Thank you. Thank
really classy.
you.
It's up to the judges, man. That's what's happening here.
You know, I wanted to take a look at how big of an effect the rise in benchmark borrowing costs in the U.S. could have on the U.S. economy, more specifically through what we've seen in new home sales and existing home sales. You can see that in the past week, we've seen the biggest one-week rise in mortgage rates for 30-year mortgages since 2013 amid the taper tantrum. Is this the beginning of a rapid rise in mortgage costs? You can see that the low cost of borrowing mortgages has really underpinned this real rise, this real recovery in new home sales and existing home sales that we've seen to date. You've seen that new home sales have actually risen to the highest level since 2007. Will this stop that? Will this take this back? This is one of the biggest questions that a lot of people have in certainly debt markets today.
Actually, I like this, and I want to make a quick comment, because looking back here, if you look at 2013, too, and you did see that big rise in mortgage, apps, you did wind up seeing a fall in new home sales and existing home sales, and mortgage applications have actually been falling a bit. So that, I agree with you. I think this is like one of the most important things to talk about.
It lagged a little bit. It wasn't
right. That's right. We're not going to see it for a little bit, so we're not going to necessarily see it in today's home sales.
No, I'm voting for my chart. No, I stand behind my chart. Okay, I'm looking at the small cap risk premium. So we've seen that monster rise in small cap equities. So does that wind up continuing? So this yellow line here is the average for the risk premium, right? The idea is as you wind up having a stronger rise in risk premium, it winds up meaning that perhaps they're undervalued. So if you wind up reverting to the long-term average for the risk premium, how much of a rally are we going to have to see in small cap stocks? So Barclays said that the Russell 2000 could hit 1,400. You wind up having not a lot of exposure to international sales, so that's obviously the bonus, but also deregulation. I mean, financials make up about 20%, where's the number? 19% weight for the Russell 2000. So that's also an added bonus that we don't talk about as much.
So, Alex, I love your chart. This would have won yesterday because we spent a lot of time on small caps yesterday, but today is today. We're on existing home sales, so I'm going to vote with Lisa. Lisa, you win. Jonathan, back to you.
Great work, guys. Thank you very much, David. Coming up in the next hour of Bloomberg Daybreak, Mark Kiesel, an important conversation with PIMCO CIO of Global Credit. From New York City, as we count you down to the cash open, with stocks sitting at all-time highs on the 4 major benchmarks here in the US, this is Bloomberg. Good morning and welcome to Bloomberg Daybreak on this Tuesday, November 22nd. I'm Jonathan Ferro alongside David Westin and Alex Steele. 30 minutes to the opening bell. We are counting you down from New York City, the heart of a record-breaking equity market. Futures positive, up 48 on the Dow, positive 5 points on the S&P 500. Outperformance from basic resources stocks in Europe, driven by a big rally in base metals. Crude treading water. It was much higher, then it rolled over. Treasuries yields lower by a basis point to 230, David, and a marginally stronger dollar in the FX market.
And here is what you need to know at this hour. All four major U.S. equity benchmarks rallied to all-time highs for the first time in 17 years as commodities surge. Death, taxes, and a rate hike. The market is certain that the Federal Reserve will move next month as the implied probability now hits 100%. Donald Trump targets trade. The U.S. president-elect says he'll withdraw from the Trans-Pacific Partnership on his first day in office.
I am going to issue our notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country.
And that is what you need to know. And now it's over to Alex.
Well, David, you were just talking about how we're seeing some follow-through buying in U.S. equity futures after that monster rally yesterday. Although I should point out we're off the highs of the session. S&P futures just up by about 5 points. I should point out that yesterday the only sector to make all-time highs within the S&P was the industrial sector. And you can read that two ways. One, the rally is not broad-based. Or two, there's a lot more sectors that need to start making record highs. So more momentum for the index. In fact, 5 of 11 sectors are under all-time highs by double percentage digits. Something to look at as we go through the session. So we're 48 hours away from Turkey, so we want to take a look at some food stocks for you as earnings sort of trickled out. Hormel up by about 5%. It wound up raising its full-year earnings came in at a record. Campbell also higher, topping estimates as their margins rose. And Cracker Barrel up by almost 5%. They raised their full-year earnings. The top end now $8.25. On the downside, though, you got Jack in the Box. That's company cutting its full-year outlook. John?
Alex, thank you very much. I want to talk to the broader market now. From 30,000 feet, we've seen a big aggressive rotation out of bonds, with bond markets underperforming, into equities, with equity markets sitting at all-time highs. I'm very pleased to say we can bring in Mark Kiesel, PIMCO's CIO for Global Credit, and he joins us now from Newport Beach, California. Mark, great to have you with us on the program. You know what the chart looks like. Bonds rolling over, equity surging. That's not a chart we've seen. Earlier in the year, it was two asset classes moving in tandem almost. That breakaway, that disconnect, can that continue? Is that the view at PIMCO?
Well, Jonathan, I think it can continue for a little bit longer, and the reason is that investors basically were owning a lot of bonds and hedging for deflation. And we had already seen prior to Trump that inflation risk in the U.S. was picking up with wages in the tighter labor market. Now under Trump, we've got the potential for tax cuts. We've got the potential for a big infrastructure program. And so those bond premiums, which were so compressed, are now starting to reprice with higher inflation risks, causing rates to go up and also the yield curve to steepen. And what's happening, if you think about the markets, is there's a big rotation now into reflationary hedges. So it's not just that investors are going into equities, which were underowned, but you're seeing a big outperformance in the bond market for TIPS, Treasury inflation-protected securities. And so that's actually a sector that we've been overweight, and we think TIPS will continue to perform in the bond market.
Mark, you've been out front on the TIPS call. The normalization of the term premium is a consensus view at the moment. Where you aren't so consensus is your view on inflation and how inflation will creep higher in the coming years. You aren't out there saying we're going to get this big boom. You think it will be tempered by several forces. Just walk us through that.
Yeah, so basically, I think the pickup in inflation is going to be relatively moderate, and that's going to allow the Fed to raise rates, but do it in a very gradual fashion. So we think the Fed will go in December, and we think next year the Fed will go 1 or 2 times. Inflation should pick up because the labor market is tightening, and we're also going to see modest growth pick up. But we do have headwinds, and those headwinds are simply that China overall is slowing, and that will impact the global economy. And most importantly, the dollar. The dollar has been strengthening significantly. It's mainly due to rising interest rate differentials. That is also going to create a headwind on inflation. And so while we see inflation picking up, it should be rather gradual.
Well, Mark, I want to pick up on that really because a number of people are saying because we are, if not at full employment, we're close to full employment. And then if you inject a substantial fiscal stimulus on top of that, which is at least a real possibility now with President-elect Trump, you really could have substantial inflation. Where do you think that thesis goes wrong?
Well, I think the thesis is possible, and that's why we own TIPS. We actually own TIPS because we are hedging for that right tail event where inflation does pick up. But the reality is that these tax packages, the infrastructure spending, they're going to take time. And so, and likely once they get implemented, it could actually take 9 months, 12 months for the actual program to be implemented. And having offset that is obviously the negatives, which are the trade, the dollar headwinds, and the immigration. And so the market's romancing this big positive surprise under Trump. And what we're arguing is that there's still a lot of uncertainty in regards to protectionism, immigration, and trade. And that should dampen some of these high animal spirits you're seeing in the marketplace.
So I hear you on the TIPS call, and you might have been first and front and center with that call, but now everyone else is jumping on the TIPS bandwagon here, and we've seen a monster rally in those inflation-protected securities. At what point do they become too expensive and you got to look for alternatives to protect against inflation?
Sure. So we actually think TIPS have further to run. And the reason is that if you look at the break-even inflation rates on 10-year TIPS, you're still under 2%. And if you look at a long 10, 20-year history, you know, those break-even inflation rates, fair value should be more closer to 2.3, 2.4. So you've got probably another 30, 40 basis points of upside on TIPS. And most importantly, I think what we're seeing in the marketplace, and this is true of equities, is reflationary assets are underowned by the marketplace. Trump was a big surprise. No one was thinking about the possibility of a right tail, higher growth, higher inflation outlook. That's why you see this huge rotation now into equities, out of bonds, and that's why TIPS can run much further.
Hey, Mark, I get that you were out front on it. We've talked about it a million times. It was buy TIPS, buy TIPS. So the election decision, the result, played into your central theme. Fine. What I want to understand, the surprise over at PIMCO, what have you been selling off the back of the presidential result in the last couple of weeks? What have you been doing in credit more specifically, and what have you been rotating out of?
Sure. So in general, we were running durations underweight, particularly at the front end of the curve, because we did feel the risk was of higher rates. That was mainly because of the tightness of the labor market, not so much Trump. Within credit under Trump, we do want to own more cash. We do want to upgrade quality. I think Trump creates both right tail and left tail risks. So basically, I think the tails are going to be fatter under Trump. You're going to have more volatility, more uncertainty. In credit, that means you want to upgrade quality. So we have been de-risking. We have been holding more cash. We have reduced some of our high yields, specifically the energy sector, which has rallied significantly in the CCC sector. We also are more concerned about hospitals. And where the opportunity really lies in the credit market is to take advantage of this volatility and to scale into positions which are fundamentally strong, which may have been oversold under Trump. And there I would highlight emerging markets, specifically Brazil. That's an area where we're still quite constructive on.
Well, how do you make the case, though, when you have a stronger dollar, emerging market FX selling off, and you want to de-risk? How do you make the case for Brazil?
Well, Brazil is basically a very idiosyncratic story. So if you look at Mexico, 33% of exports go to the United States. If you look at Brazil, it's 1.3%. So Brazil is very much domestically controlled. You go back to 2010, 50% of their equity market was linked to commodities. Now it's only a quarter. So Brazil has turned more domestic, less trade-oriented. That economy, by the way, went through the worst recession in 50 years. I was recently there on the ground meeting with the central bank and meeting with all the biggest companies. Over half the biggest companies in Brazil have new CEO and CFOs now under the new president. The key with Brazil is inflation is coming down. Unlike the United States, where you've got this inflationary potential to go higher, with Brazil, you've got a huge recession and inflation's coming down. That's going to allow the central bank to lower rates. We actually think they'll lower rates much more than what's priced into the marketplace. So Brazil is really, within emerging markets, I think one country where the economic fundamentals are turning in a major way. Lower inflation and also positive potential surprises on earnings. That's one emerging markets which really, I think, has upside.
Mark, thanks so much for being with us. That's Mark Kiesel. He's PIMCO CIO for Global Credit. Now for an update on news outside the business world, we go to Emma Chandra with Bloomberg's First Word News. Emma.
Thank you, David. President-elect Donald Trump says no more business as usual in Washington. In a video outlining his agenda, Trump announced new rules involving lobbyists.
On ethics reform, as part of our plan to drain the swamp, we will impose a 5-year ban on executive officials becoming lobbyists after they leave the administration, and a lifetime ban on executive officials lobbying on behalf of a foreign government.
Trump is also taking aim at the Trans-Pacific Partnership. He says that on his first day in office, he'll begin the process of taking the U.S. out of the trade deal. Meanwhile, one of Trump's advisors is suggesting the incoming commander-in-chief won't follow through on his pledge to investigate Hillary Clinton over her emails. Kellyanne Conway didn't dispute an MSNBC report that Trump won't pursue probes into Clinton's email or private foundation. Conway says it's perhaps a good thing if Trump can help Clinton heal. And Japan has withstood a potentially deadly earthquake with relatively little impact. The quake measured 7.4 and struck off the coast of Fukushima. That's the home of the nuclear power plant crippled by a quake and tsunami in 2011. The latest quake briefly knocked out a cooling system at a separate Fukushima plant. It also caused a small 3-foot-high tsunami. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg. David.
Thanks, Emma. Coming up, Goldman changing its tune. Commodities are rallying, and the bank is recommending the asset class for the first time in more than 4 years. Details next. And later this hour, the reality show that is Trump's transition. We take a look at how the president-elect is using the media to his advantage. This is Bloomberg.
Crude oil relatively flat today, but copper eking out a gain of 0.4%. But overall, the Bloomberg Commodity Index is set for its biggest 3-day advance since May. It's been a monster rally since President-elect Trump was elected into office 2 weeks ago. So leading the charge, you got oil, industrial metals, Goldman Sachs upping its call on commodities, recommending an overweight position for the first time in 4 years. Well, joining us for more is Krishna Mamani, CIO of Oppenheimer Funds. Okay, so I've been asking this question pretty much every hour. So we get this monster rally since Trump was elected, but that rally in base metals started before. What part of this is real growth, real fundamentals, real reflation?
So there are two things I think helping commodities. One, the growth prospects in China are actually quite good. They have enough momentum, at least for the first half of 2017, for growth rate to be pretty good. And the fact that Trump comes in and is talking about reflating the U.S., that's another thing supporting the markets. And if we get OPEC an agreement, that'll be even better. So I think it's all coming together.
If we don't, because Bank of America sees sub 40 on oil, if we don't get an OPEC deal, how much of the reflation in break-evens, for example, is due to oil? So what's the downside for this inflation trade that we're seeing if we don't get a deal?
I think the reflation is with or without commodities. I think it is really not dependent on commodities. It's really dependent on deficit spending in the U.S. at a massive level. So if commodities come along, it'll be sustained longer, but the commodities don't have to be the primary driver of reflation.
The offset and more fiscal, though, is less monetary policy stimulus.
Yes.
That all means a stronger dollar, essentially.
Yes.
Then that's the offset to the whole story, and it's like a cycle. How does the stronger dollar factor into the commodity story with that in mind?
Well, so I think strong dollar without growth in the U.S. and without growth of debt in the U.S. is unsustainable. But if we have large deficits, the exports from emerging markets, commodities coming into the U.S., finished goods coming into the U.S., the flip side of that can be absorbed in the U.S., and that is sustainable. So a deficit financing U.S. government and strong dollar are very consistent.
So, Christian, that sounds really good. We're having a good party here right now in the markets. We're having a good time.
Yes.
But that also sounds a lot like China to me, which is basically borrowing for growth. What you're talking about is big deficit spending here in order to get growth going in the United States. Sooner or later, that catches up with you.
To some extent, yes. But the problem with China is overinvestment in an economy that is already overinvested. That is not the case in the U.S. So U.S. can deal with deficit finance, infrastructure rebuild, something to stimulate growth and credit growth. That's not the case in China. China is already far down that path.
David took us there, so let's go there. He mentioned China. I'm going to go to Japan. Why don't we end up with Japan in this situation? Why do we have to have this sort of rose-tinted view of infrastructure spending? Japan defining the bridge to nowhere. Why don't we end up with Japan?
Well, again, the risks are quite substantial that this secular stagnation, something that Japan has been dealing with for quite some time, is a real risk for the U.S., 10, 20 years down the road. Having said that, U.S. economy relative to Japan from a structural standpoint is at a much better level. Our debt levels are lower, at least at the federal government. Productivity levels are lower. Our demographics are better. And we can use the investment in infrastructure and other things to jumpstart our productivity. So I think we are not Japan. Can we become Japan in 10, 20 years? Maybe.
But he can still have trades in 10, 20 years. And the question is, what does it mean for emerging markets? Because you get a rally in commodities. The idea is you get all this money now sloshing around emerging markets that wind up exporting commodities. Do they save it or do they spend it? And what's kind of the offset of that?
So I think emerging market growth in a U.S. growth environment ends up being quite good. The challenge with emerging markets is really more on the asset price side for a dollar investor. So we still believe in that environment. Emerging market growth will be okay, but you're better off buying U.S. equities than emerging market equities, perhaps small cap U.S. equities rather than emerging market equities.
All right, Krishna, good stuff. You're going to be sticking with us. Krishna Mamani, CIO of Oppenheimer Funds, is staying with us. Because coming up, forget the turkey, because this weekend is all about the sales. I'll be hitting the shops on Black Friday. The holiday shopping season kicking off this Thanksgiving weekend makes up nearly a third of retailers' annual sales. More on what retailers are doing to grab that market share. This is Bloomberg.
This is Bloomberg. I'm David Weston. Thursday is Thanksgiving here in the United States, and that can mean only one thing, and that's that everyone is going to be resting up so they can get ready for Black Friday, when we all rush out to start our holiday shopping in earnest. The big question is what the holiday season will hold for retailers. And to help us sort that out is Simeon Gutman. He's a retail analyst at Morgan Stanley. He covers retail hardlines and discount spaces, including stores like Walmart, Best Buy, and Target. Welcome to the program, Simeon. So answer my question. What are we looking forward to? What are we expecting from U.S. retailers this holiday season?
It could be an okay season.
Okay.
Okay. I mean, the consumer spending is healthy. There's a little bit of fluidity in the world. We have the election. Consumers have been spending okay up until it feels like we got a little pop post the election, and now in a little bit of a cool down until we get to Black Friday. There's some mixed signals. I mean, you have a lot of weather. Weather's always important. Cold weather helps the malls, helps some of the apparel-related stores. So we think it's okay, but overall maybe a little worse than last year.
Well, as I recall, last year the weather was pretty mild. So does that help you on your year-over-year comparisons as a practical matter?
Right. So the group in general has easy comparisons, but those are for the weather affected. So I would say the mall retailers, in my space, you have Dick's Sporting Goods, some of the outdoor-based companies like a Tractor Supply, and even the auto parts retailers, not a conventional holiday type of name, but the auto parts stores because the weather was pretty mild.
I know. I'm buying my wife some auto parts for
She's
Christmas.
gonna
What
love
are you
it.
doing, Alex?
You just put it in a stocking, wrap it up in a bow. She'll have such a good time. But the question really becomes then, what are you going to do about margins? Because you obviously have to discount a lot to get people in your store in particular. What stores can handle that margin pressure and which ones can't?
Ooh, margins, I mean, that's a tricky story in general because you have the shift to online, and that's probably one of the most pervasive themes right now in retail. If your online business is accelerating, our rule of thumb is for every point of online share increase, your margins are going to get hurt by about 50 basis points. In terms of who can handle it, Best Buy, which we're not recommending at this point, but Best Buy has done a great job transforming their business, moving it to online, competing versus some of the e-tail players over the last many years.
For the last 20 minutes, we've been discussing with Christian Mamani of Oppenheimer what this means for Wall Street, the political fallout. And for Wall Street, it means a lot of buying. For Main Street, I want to try and understand what this means for the consumer. We've been discussing animal spirits. Are they going to go out and spend? Are they going to be as enthusiastic about the next 4 years as Wall Street currently is?
Hard to say. And like I said, I think it's very fluid. We're getting some signals post-election that some high-ticket spending has come back, but it's been mixed. We just had mega-cap earnings last week for most of my space with a pretty good breadth of companies, and it's a very mixed picture. Unfortunately, I think the weather is going to be, we're going to be beholden to the weather given how important it is for the next 6 weeks.
And also tomorrow we get a U-Michigan report, and you get lots of good data in that. And one part of that is inflation expectations. If household inflation expectations have been picking up like market-based inflation expectations, what do you do as a consumer? How does that affect you?
Well, you could cut back on certain things. I mean, it depends on what categories. I mean, in general, and some of this is not my area, but, you know, your food spending could be curtailed. I mean, that's one area, but that's been deflating. If you see some high price increases in some big ticket items, you could curtail as well. We're not expecting a whole lot in that. I think the U-Michigan sentiment is a bigger idea, and I think in particular we're looking at the lower end versus the higher end sentiment as we go through holiday season.
Krishna, consumers aren't looking at tips and break-evens, are they?
No, they're not. They're not. It's too esoteric. But I have a question for Simeon. What's the risk that because discounting is lower, because all of a sudden people get very enthused and retailers hadn't really planned for this enthusiasm and margins end up being significantly better than what we are expecting?
Optimist.
Great upside risk. Look, inventories are in great shape, right? All year we've had to prepare for this time. Very easy compares. The operating leverage in these businesses is enormous. And so if we have a low discounting season, you could see big profit surprises. I think Wall Street is mixed on that at this point. I think some people may be taking that bet, but I think it's a little early to make that call.
Well, to be optimistic for a second, who's best positioned to cash in on that?
Well, in my world, I mean, you know, you have a lot of operating leverage built up in like a Best Buy, for example. Last quarter was a great example. They comped, their same-store sales were up 2%. Their EBIT, their operating profits were up 30%. And that's because of the multiple years of cost cuts as well as the gross margin improvement that they've seen.
From an optionality standpoint, it's like before the election. We weren't expecting Trump to win, so that was the option to buy. Same thing here. We are not expecting margins to expand for retailers, so maybe there's a play there somewhere.
Low expectations. That's the right way to set into the holiday, and hopefully we're surprised to the positive.
Gents, great to have you with us. Simeon Gutman, retail analyst at Morgan Stanley, and Krishna Mamani of Oppenheimer Funds. More with Krishna. That's coming up next. We're counting you down to the opening bell right here on Bloomberg Daybreak. A record-setting equity market here in the United States, and potentially more to come. Futures up 63 on the Dow, positive 6 points on the S&P 500. In the FX market, a marginal stronger dollar story emerging. Dollar-yen to 110.92. The cable rate dropping to 124.27. Yields lower by a basis point at 2.30, and crude was much higher. A really whippy session for the commodity market. Base metals rallying, but WTI rolls over again by about 0.1% to $48.18. Up next, party like it's 1999 apparently. All 4 equity benchmarks at all-time highs for the first time in 17 years. The opening bell is next. From New York, a record-setting equity market. This is Bloomberg Daybreak. I'm Jonathan Ferro, just moments away from the opening bell. Equities, futures, up across the board, up 69 on the Dow, positive 7 points on the S&P 500. We're up on the Nasdaq as well, ahead of the open with all 3 benchmarks sitting at all-time highs. As you hear the opening bell ring in New York City, allow me to whip through the other asset classes for you. Brent crude and WTI were much higher, then we rolled over. WTI pretty much unchanged now, so climbing higher into the equity open. We're at 48.25 on WTI. Bonds bid, treasuries, yields down 1 basis point to 230 on a US 10-year, and some dollar strength in the G10 mix as well. With 124.19, your cable rate, we are down 0.6%. Tuesday, let's get this market open and cross over to Alex Steele.
How about some Tuesdays? Record intraday highs, record closing highs. If we were to close right now, you're seeing the Dow up 37 points, S&P up 5, the Nasdaq up 15, all making new intraday record highs right now at the opening bell. Interesting to pay attention to, though, is that S&P industrial sector was the only sector that actually made new all-time highs yesterday. So how does that play out? Is this a short-based rally, not very broad-based, or is there more room to run? Also, watch oil. It started to roll over a little bit as it did the S&P came off its highs of the session when it comes to futures trading. So watch oil when it comes to trading into the close. Individual names we want to focus on. It's retail. We are 72 hours away from Black Friday. Burlington up a whopping 13%. That company wound up raising its full year outlook by about 7%. Signet Jewelers also up 12%. They actually raised their full-year outlook as well after its third quarter topped some estimates. And Dollar Tree up on better comp sales. It also raised its four-quarter earnings guidance. Kate Spade, though, the outlier when it comes to retail, though still just off by 0.8%, getting a downgrade over at Cowen, saying they're worried about outlet sales as well as some tourism pressure, and really feels like its estimates for handbag sales are a little bit too high. But the story in the broader market has been this rotation that we've seen out of bonds into stocks, and this tells a very interesting story. This white line here is the S&P earnings yield, and then the blue line is the 10-year yield. Now, the story for the last year had really been, look, you're going to make more on a yield basis if you invest in stocks versus if you invest in bonds. That story has now shifted. Now the 10-year yield is yielding more than the S&P at over 2%. And so the issue is, John, are we going to see a rotation back into the bond market because you get better yield, or is there so much more juice left into that rotation into stocks?
It's a big question. We're certainly seeing a rotation into equities continue. The Dow goes through 19K for the first time ever, an all-time high. Then we pull back just a touch. But the Dow topping 19,000 in today's session for the first time ever. The big question for this equity market then is to think about the bond market in the mix as well. Over the last year, you've seen a relationship. We can pull up my Bloomberg very quickly. Equities and bonds moving almost in tandem throughout much of 2016. Bonds outperform, so do equities. Then the last couple of weeks happened. Bonds roll over, yields spike higher, and equities keep pushing higher, even though that happened. Still with us is Krishna Mamani, CIO of Oppenheimer Funds. Typically, Krishna, this makes sense. Bonds underperform, equities outperform. But given the distortions of central bank stimulus we've seen over the last couple of years, that hasn't been the story. It's been a long everything, short everything kind of story. The disconnect there, that gap, how does it reconcile, if at all?
So I think this is hope driving the equity market. Hopefully we get the reflation story that we have been waiting for a long time. But I think the point you are making is the risks have risen materially as well. If rates continue to climb, one of the biggest drivers of up equity trade was the fact that earnings yield was quite substantially higher than rates, and that goes away. If the dollar is higher, earnings from overseas assets for U.S. companies go down. So I think right now we are expecting growth to pick up, and therefore we continue to rally. But if and when those legislations come in and they are not to the level we would like them to be, and dollar remains strong and rates are 50 basis points higher, there is a chance for a day of reckoning on that front.
Well, here we are, Krishna, talking about levels. 19K on a Dow, 2,200 on the S&P 500, records across the board. Talk to me about the levels in treasuries, in the dollar, that you'd be thinking about as a line in the sand to say, you know what, if we get there in a significantly short period of time, I would say that's going to eat into this risk rally.
I would say if we get to, let's say, 2 3/4 or 3% in a hurry before Trump takes over, I think we have significant risk. That would be almost a 150 basis point move from the lows for the market to digest with no significant improvement in growth, all on vapor. And I think there's substantial risk at that level.
Krishna, I want to talk about the price-earnings ratio. Not just the earnings, but the price-earnings ratio. Sure. Because the earnings, we're sort of betting on the come, as it were. We're expecting it to come, not here yet, might come. Mm-hmm. But we also have a wider range of possibilities with Donald Trump as president than we did before, to the good and the bad. bad. Typically, when you increase the risk that way, the price-earnings ratio actually gets driven down. And so it doesn't have a natural effect on the equity markets to actually drive prices down to some extent because of the risk.
Absolutely. So if we don't get the denominator, the earnings moving and moving relatively quickly, then we are going to have a problem in the market. As I said, the difference between bonds and the earnings yield, the reverse of price-earnings ratio, has definitely shrunk. And if it continues to shrink, one of the biggest anchors for equities to do well falls apart. So to compensate for that, earnings have to improve, and they have to improve relatively quickly. We shall see.
Harken back to the 2013 taper tantrum when we also saw this great rotation start, right? How fast did it happen, and how fast will it be this time?
Well, so I think the difference between taper tantrum in 2013 and I guess Trump tantrum in 2016 is the fact that the reflation story really wasn't in place. So growth was going to be mediocre, no significant change in the trend line, and the Fed tightening. This time around is different. And again, we will see if it comes out that way. That is, growth outlook, inflation outlook becomes or has become significantly better, and rates can rise in that environment without killing the equity market. I think that's the situation we are dealing with.
Let's break it down sector by sector. At this point, you've got financials outperforming on the back of a hope that you might get a softer regulation story, on the reality that you've got a steeper yield curve. The healthcare discount that was applied on the prospect that you would get a President Clinton, that comes out of the market. For industrials, my producer came over to me at 5:05 this morning and said, guess what's sitting at a record high? The only industry group coming into today's open. He said industrials. And I sat there scratching my head thinking, why are we here? What's the real fundamental driving force taking industrials to an all-time high?
Well, it's really about, the safe trades in the markets fading and real growth trades in the market fading. So we don't want to buy utilities anymore. We don't want to buy REITs anymore because interest rates are rising. And at the same time, the premium that we were willing to pay for technology, for example, kind of diminishes because other sectors can grow as fast. So it's really a rotation out of growth into value. It's a rotation out and focusing on companies that have prospects of significantly changing the trend line for their earnings.
Okay, Krishna, thanks so much for being here. That's Krishna Manani. He is Oppenheimer Funds. What are you?
I'm the Chief Investment Officer.
Thank you, Chief Investment Officer. Thanks for being with us, Krishna. Coming up, bankers rejoicing that the president-elect says he'll be cutting back on regulation. But is the president-elect all good news for Wall Street? We'll try to answer that question next. This is Bloomberg.
This is Bloomberg Daybreak. I'm Emma Chandra here in the Hewlett-Packard Enterprise Green Room. Later on Bloomberg, Steve Koonin, CEO of the NBA's Atlanta Hawks. That's at 2 p.m. Eastern.
If you are an equity bull and you like round numbers, you'll like this market. Across the board, record highs. We have 19K on the Dow, 2,200 on the S&P 500. We have, on the NASDAQ, up a third of 1%. All-time highs across the board once again for the major benchmarks here in the United States. Let's dig a little deeper and get some stock movers for you. Let's get across to Bloomberg's Abigail Doolittle. Good morning, Abigail.
Good morning, Jonathan. And lots of movers in the cybersecurity space, not helping the record highs, though. First up, Palo Alto Networks absolutely plunging on a mixed fiscal first quarter. They missed on revenues. Very worrying was the fact that billings decelerated. Plus, they also guided the second quarter below what the street was looking for. Now, despite this, we do have lots of analysts who are defending the shares, including UBS, Oppenheimer, and Piper Jaffray, perhaps looking ahead to what the management talked about for the second half, or an acceleration in growth. Now, those results are also taking a toll on these cybersecurity firms, including FireEye and Fortinet. Plus, on FireEye, we have a downgrade over at Goldman to sell, with the analyst there, Gabriela Borges, saying that the fundamentals are to remain under pressure. Now, to get an idea of this pressure, we go into the Bloomberg and we take a look at hashtag BTV 3281. This is a year-to-date chart. In white, we have the NASDAQ. In blue, we have Palo Alto Networks. And in orange, we have FireEye. And we can see that the NASDAQ is absolutely outperforming, up about 8% at this point year-to-date, whereas the other two stocks are sharply lower. Bloomberg Intelligence analyst Mandeep Singh is saying this is basically a reset of multiples, Alex.
All right, thanks so much, Abigail Doolittle. The big story, Donald Trump and his businesses. So the Wall Street Journal has called on the president-elect to liquidate his holdings in his family business in order to avoid any conflict of interest with his policy creation. Trump responded to this scrutiny, tweeting, "Prior to the election, it was well known that I have interest in properties all over the world. Only the crooked media makes this a big deal." Well, Bloomberg's Mark Halperin and John Heilman spoke with Trump transition senior advisor Kellyanne Conway on his future as both president and businessman.
His adult children, Ivanka, Don Jr., and Eric, will be managing the family business. Obviously, these are not entry-level positions. They're already respected executives and mentees of his within the business, in charge of building things, acquiring things, taking meetings. You've seen their handiwork. I think the old post office building in D.C. is a great example of under budget, on time work that these adult children do, and they'll do that. I mean, he's made that clear. He's got a team of advisors and lawyers and accountants who will make sure he complies with the law.
President Obama suggested complying with the law is not necessarily good enough standard. Is he just going to comply with the law? Is he going to worry about appearances as well when there's an intersection between public actions and his business interests? Just the law or appearances as well?
That's a typical response of a politician who's not been a successful businessman and job creator. Apart from that, I think he has to comply with the law, and that should be the appearance. In other words, people will know that he's got a full-time job as President of the United States and Commander-in-Chief. He's committed to that. He's already said he won't take a salary. I guess he'll donate that to charity. But there's no reason, other than those who still think the campaign is in full force, to believe that this man is lying or won't do what he's supposed to do upon taking office.
So, Kellyanne, I just want to stay on that because the Wall Street Journal editorial board, which we were just talking about, wrote a very strong editorial on this, or a strongly worded editorial about this. They are not professional politicians, and they have been, as you know, both friendly to conservatives and certainly friendly to capitalism. The argument that they made in their op-ed, or in their editorial was that the political damage to the administration if Mr. Trump doesn't liquidate his business holdings could be extensive. He's going to be constantly scrutinized for having pecuniary motives for any action that he takes on a wide variety of different policies that affect a wide variety of different countries and a wide variety of issues. So is the Wall Street Journal, when it is arguing from the perspective of wanting him to succeed, not being critical of him, do you think that there's no merit to that argument, that it would be the safest thing just to liquidate the assets and move forward with a clean slate?
Well, two things. First, we already know what his policy positions are. He made them very clear. He has a 100-day plan. So if you're talking about the fact that he wants to create 25 million jobs over 10 years and unleash coal and shale and natural gas and other energy sources, or have big infrastructure projects that even Democrats are excited about, John, then if you're assigning then a possible pecuniary motive to that, with his business holdings, we already know what he stands for. It's not like he's going to invent policy based on things that would benefit a business that he's no longer is involved in or temporarily not involved in. But secondly, and I think more importantly, is that as President of the United States, he will have no authority whatsoever over what is happening in his business, what the acquisitions are.
That was Kellyanne Conway. She, of course, is Trump transition senior advisor, speaking with all due respect. And Jonathan, this is a harder problem than I think they make it out to say. That she's going to liquidate his assets. This is real estate.
It's real
estate.
estate.
This is not like selling a security over an open market.
Yeah, there was a big conversation with Jamie Dimon in the mix at one point, becoming Treasury Secretary. If he did become Treasury Secretary, what would he do? Well, he'd have stock, and he could sell it if he wanted to. With this, I think it's also not cut and dry what it means when the likes of Ivanka Trump is sitting on a meeting with Prime Minister Shinzo Abe, if she's the one that's going to be essentially running the company. So I think there's a lot of conflicts here that maybe the law and the legal issues don't deal with directly, and really that was John and Mark's point, whether you need more than just to go by the law, whether there's some kind of moral input here you need to be thinking about as well.
And, you know, I said to Alex yesterday, the one trade to make the one sure trade is to go long lawyers right now, because the lawyers are going to be fully occupied for some time to come. Yes. But another business, speaking of Jamie Dimon, that's really been affected by Donald Trump is banking. Many bankers were dreading the possibility of a Trump presidency before the election, but it's surprising how quickly many of them turned once they began to focus on what the president-elect apparently had in mind for their financial industry. Bloomberg's Max Abelson has written a piece on the Bloomberg with his colleague Dakin Campbell, taking us through the conversion of the bankers to the faith in Donald Trump. So tell us about this. This is a pretty quick turnaround.
Yeah, that's right. I mean, conversion makes it sound like it was a process. What Dakin and I found when we spoke to Wall Street bankers is, as one guy said, he was like, I spent 20 minutes very, very upset. I was devastated that Clinton lost. This was a Clinton fan. And then I moved on. And what this guy says is that he thinks, you know, a Trump presidency is going to be good for him. And he's talking about his own wallet. He thinks that, you know, he's going to have tax cuts. He thinks Wall Street's going to be deregulated. And he's not alone. There's so much excitement among bankers who just a few months ago were vilified by Donald Trump on the trail.
I was going to say, there was an ad like vilifying Lloyd Blankfein of Goldman Sachs. So there is a distinction between what Donald Trump's going to do in terms of the big banks versus the regional banks. I mean, his policies are more geared towards the community banks, not to Goldman Sachs or JP Morgan.
Well, listen, first of all, you're so right to bring up that ad. Do you remember Trump was showing Lloyd Blankfein's face on that final closing out of the campaign, while his sort of voiceover and tones, you know, there's a global cabal that's trying to steal your money. But, you know, by the Friday after the election, Trump's transition team included 3 Goldman Sachs veterans. There's Bannon worked for Goldman Sachs, Steven Mnuchin, who Zach Miter and I wrote a profile of for Business Week only a couple weeks ago, and then Scaramucci worked for Goldman too. So I think that the way these people are looking at it is, you know, that they've got their friends in high places now, and I think they think this is going to be a really good era, not just for small banks, but for the big banks as well.
And Max, the conversation we've had on this program over the last 2 weeks is whether the market moves have really shaped the expectations of people on Wall Street, whether they saw the market kick back higher and said, you know what, maybe it's good, and they bought into it. So my question to you would be is, how fragile is that sentiment shift that you've experienced in those conversations? They were depressed for 20 minutes, then they were happy. What would it take for them to get depressed again?
Well, listen, you're definitely right. I mean, I think that if it were only because Goldman Sachs stock popped, what was it? It was like 15%, I think, in the few days afterwards. I think JP Morgan was above 10%. Wells Fargo was, I think, maybe even more than that. If it was only stock prices popping, these guys would be in trouble, because stocks go up and then the stocks go down. But look, I think there's a lot more going on than that. My colleague Jesse Hamilton has a really nice piece out this morning. I hope everyone reads Dakin and my story that's in Business Week. But Jesse Hamilton has a story that's worth reading as well, and it's also one of the most read stories on the terminal. And what he talks about is like, you know, you can take your eyes off for a second from just like obsessing over Treasury Secretary. There are other jobs that Wall Street has their eye on, and I think that if you have someone like Dan Tarullo, who's been really, I think, a good word, he's probably been annoying big banks, because don't forget, the Fed, obviously, besides the policy that says, is also a regulator. And Dan Tarullo has sort of had this unofficial role at the Fed of watching over the big banks and regulating them, I think, with a kind of thoroughness that bankers dislike. And what Jesse wrote about is that if Trump puts in a guy who comes straight from Wall Street or is sympathetic to the big banks into that role in the Fed, bankers are going to be rejoicing.
And Dodd-Frank created that position so they could fill it, Jonathan.
And there's 2 opening seats on the board already, so maybe they can just put an extra one in there and do whatever they want. Max Abelson, I've got to say, it's great to have you with us. Max Abelson, of course, of Bloomberg, on the latest talk over the markets and the speculation around the Trump administration as well. Coming up at the top of the next hour, it's Bloomberg Markets, stocks all-time highs. Mark Barton's going to flip through it all for you. What's coming up, Mark?
John, Jim Bianco joins us at the top from Bianco Research. He doesn't think the reflation is coming, but if he's wrong, he admits the bond market is in deep trouble. Looking forward to speaking to Jim. David Conrad, Macquarie analyst. He says banks are entering a new world order. It's time, he says, to shift exposure as the outlook looks much different in the post-Trump world. And we're finishing off with 7 Investment Management's Ben Kumar. And he answers this question, John. Why are equities moving higher in a rising rate and an uncertain environment? That's it. We're at the top of the hour. We'll see you in a sec.
Looking forward to the programme. Mark Barton coming up then. Coming up on this programme, we get back to the equity market. All-time highs on the major benchmarks here in the United States. The Dow up by 40 points. The S&P 500 up by 4. We kissed 19K. We retrace that. We stay at 2,200 on the S&P 500. We'll break down the markets for you next. From New York, this is Bloomberg. From New York City, I'm Jonathan Ferro. This is Bloomberg. Stocks extending their gains, hitting another record high. The Dow touching 19K for the first time ever. The small caps continuing an epic rally that goes above 12 consecutive days. It's the longest winning streak in 13 years. And the S&P 500 now north of 2,200. Let's bring in Bloomberg stocks reporter Danny Berger. Danny, there's people out there that will look at this and say, these are just round numbers. I don't really care. They don't matter. But we've had a big rally over the last couple of weeks. What are people saying?
Absolutely. I mean, a lot of people out there are looking forward to next year, which is a little bit of a scary prospect. But people are really saying, you know, policy is going to be in stocks' favor. You know, you have consumer discretionary who has to pay, you know, a very effectively high tax rate. They think that's going to come down. And a lot of that is fueling the rally. We even had Bank of America just moments ago release its 2017 year-end forecast. They see it at 2,300. They say policymakers, they're going to help sustain this growth. So people are kind of trying to get ahead of that, really positioning themselves for what they see as a favorable environment next year.
Talk about sectors, because only industrials and consumer discretionary are at record highs. That's it, out of the 11 S&P sectors. So is this a small-based rally, or does that mean that there's more catch-up to come?
No, that's a really good point. And along those points, we do see a lot of dispersion in stocks now that we hadn't seen before. So stock picking is in the favor right now. But to your point, I mean, we had NASDAQ, do fairly well yesterday, reached to close to new highs, but it's definitely lagging. Some of that has been the dollar. Of course, it fell today, but, with it rising post-election, people were really looking towards domestic companies, small cap companies. So it is not exactly everything coming up, but there is some lagging, and some new sectors are reaching new highs.
We've been talking about whether this is capitulation or conviction. What are people saying about that? Are they capitulating on trades that have almost become pain trades because they went so far, or are they having the conviction to say that this has got legs, this is going to go the distance?
You know what? I think people are as divided on this as they were for the election. Some people, I've talked to some investors today who said, I don't trust this. I think that this is majority short selling. I'm going to fade the rally. Other people are really positive. They have a really great outlook. For example, financials, they've done pretty well. And that's a sector that had been shunned by the most part. So some of it does seem like conviction. But again, you'll get 100 different answers for talking to 100 different people.
Danny Berger, I've got to say, it's great to have you with us, Bloomberg News stocks reporter. That does it for Bloomberg Daybreak. Up next is Bloomberg Markets. We're almost 26 minutes into the session. Allow me to get you up to speed and whip through the boards for you. Equities, all-time highs then. We kissed 19K on the Dow. We hold 2,200 on the S&P 500. And the rally continues in Europe as well. Get to the other board very quickly. I'll whip through the other asset classes for you. Crude, holding steady at 48.29. Treasuries were bid. Yields now unchanged at 232. And some marginal dollar strength in there as well. Dollar yen getting back to a 111 handle. The cable rate rolling over to 124.31. That's your market wrap from New York, a record-setting equity market. This is Bloomberg.
It's 10 a.m. in New York, 3 p.m. in London, and 11 p.m. in Hong Kong. From New York, I'm Bonnie Quinn.
And live from London, I'm Mark Barton. Welcome to Bloomberg Markets.
We're going to take you from Chicago to Dubai and cover stories out of the UK, Wall Street and Washington in the next hour. Here's what we're watching. Actually, what we're going to do first, even though markets have topped 19,000 for the Dow, is go straight to Julie Hyman, who's here, looking at the markets, but also looking at some economic data.
Yes, we've got existing home sales just coming out at an annual pace of 5.6 million homes. This is existing home sales. 5.44 million was the estimate from economists. So this means a month-over-month gain of 2%. That is also better than the drop that was estimated. And this in line with some other recent housing data that we've gotten. We also got the Richmond Fed Manufacturing Index coming in with a reading of 4. That's a rebound from -4 the prior month. So all of this supporting the notion here that the economy is strong enough, certainly for the Fed to raise rates in December. That's now being priced in as a certainty into the Fed funds futures, as all three major averages are indeed topping intraday highs once again, with the Dow right now at the very round number of 19,000 as we watch that tick by tick go into record territory. We've been watching, of course, not only the Dow, but the S&P and the NASDAQ also at records. This is not something that happens very often, folks, and the Russell 2000 is there, too. Take a look at the Bloomberg #BTV 3302. We're calling it Party Like It's 1999 because this is the first time since that year that all of these major averages have made records simultaneously on the same day, and that trend is continuing from yesterday into today. What's also remarkable about the movement is how rapidly it's happened from the lows of the year. At one point, the S&P 500 was registering an 11% drop for 2016, and now we're looking at a gain of more than 7% on the year. So it really has been a very rapid turnaround, and of course a very rapid turnaround even just since the election. Now, as we saw yesterday, it is commodities that are helping to power stocks higher as producers of commodities are rising. Copper, iron ore, we've got tin and lead all on the list of the various metals that are rallying. Iron ore in particular was limit up over in Chinese trading. A number of different things powering it here. Goldman Sachs yesterday overweighting commodities for the first time in more than 4 years. Among those calls, it did raise its iron ore price forecast. Copper trading at the highest since about July of 2015. Zinc is near a 6-year high. So we've got this optimism about demand for infrastructure on a supposed infrastructure spending plan coming under a Trump administration. The Bloomberg Commodity Index is having its biggest 3-day rally since June because of all of these metals rising, and of course also because oil is rising. Oil prices are up once again today, not seeing as large a gain by any means, and really bouncing around quite a bit, flirting with losses even, but still hanging on to a gain of 0.3%. That's on continued optimism that OPEC will be able to come to some sort of agreement on a production freeze. And this is after we had representatives from Libya and Nigeria in Vienna at the sort of preliminary talks there for OPEC, expressing optimism that a deal is going to get done. Mark?
And Julie, that OPEC optimism is boosting oil and gas stocks here as well. The best performing industry group, Basic Resources, highest level since June 2015. The Basic Resource Index, quite a run since Trump was elected. The best performing industry group on the Stock 600 today and since Trump was elected. The gauge itself, the Stock 600, up by 0.5%. That's the highest in almost a month. And guess what? You know, I've been telling you every day for the last 10 days how on an intraday basis we've had gains and losses. Yesterday, the stretch ran to 10. That was the longest stretch since May 2013. The stretch has come to an end. Well, we've got 90 minutes left of today's session, so there'll be no more of that statistic. Let's get to Enel, the Italian utility. It's buying back shares, it's selling assets, it's cutting costs. It unveiled a big strategic plan today focused on network digitization, and it's boosting its retail business. Europe's biggest utility plans planning to make about 3 billion euros of disposals in the next 3 years. It's preparing a share buyback option for as much as 2 billion euros. It's planning to boost its dividend in 2017 to 65% from 60% of net income. Shares are up by 3.2% today. Let's get back to oil. Thought I'd show you a chart of Brent crude. Brent rising for a third day, as Julie was telling us. Big optimism that OPEC is closing in on a deal. Various meetings taking place yesterday and today in Vienna. We're getting progress, according to a delegate from Nigeria. Love this chart because it shows the price of Brent crude, but it also shows the 50-day moving average. Brent yesterday closing above the 50-day moving average for the first time since October the 28th. If we're talking on the upside, it's the first time that prices have been moving higher and have risen through the 50-day moving average since the end of September. That's 2 months. Really quickly, let's stick with commodities, because gold hasn't been the best of months in November. The biggest ETF backed by gold, this is what this chart is, through Friday, investors pulling more than $1 billion from the Spider Gold Shares Index. That's since the end of October, on course for the biggest monthly withdrawal since November last year. We know why. A, strong dollar. B, Vonnie, the expectation the Fed is going to raise rates next month.
And as Julie said, Mark, as much of a certainty as there can be at 100% odds in the market. All right, let's check in now on the Bloomberg First Word News. Elisa Parenti has more from our newsroom.
Thank you, Vonnie. President-elect Donald Trump has spelled out his policy priorities in a new video. On his first day in office, Trump will take aim at a controversial trade agreement.
On trade, I am going to issue our notification of intent to withdraw from the Trans-Pacific Partnership, a potential disaster for our country. Instead, we will negotiate fair bilateral trade deals that bring jobs and industry back onto American shores.
Trump also wants to limit regulation. He says that for every new regulation, 2 old ones must be scrapped. And we're also just getting word now that former CFTC Commissioner Sharon Brown-Hruska will lead the CFTC landing team. Meantime, one of Donald Trump's advisors suggests he won't follow through on his pledge to investigate Hillary Clinton over her emails. Kellyanne Conway did not dispute an MSNBC report that Trump wouldn't pursue probes into Clinton's email or private foundation. Conway said that it is perhaps a good thing if Trump can help Clinton heal. Japan has withstood a potentially deadly earthquake with relatively little impact. The quake measured 7.4 and struck off the coast of Fukushima. That is the home of the nuclear power plant crippled in a quake and tsunami in 2011. This latest quake briefly knocked offline a cooling system at a separate Fukushima plant. It also caused a small 3-foot tsunami. And British Chancellor of the Exchequer Philip Hammond will spend $1.2 billion to improve the country's broadband infrastructure. Hammond's proposal will be included in tomorrow's autumn statement. The plan would give 2 million more households access to full fiber broadband. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. Vonnie?
Elisa, thanks. Well, like we've been saying, traders have left absolutely no room for doubt that the Federal Reserve will move next month. Take a look at my Bloomberg. The market implied odds of a Fed hike in December, 100% now. Earlier on Bloomberg Daybreak Americas, Jeffrey Rosenberg, chief fixed income strategist at BlackRock, said it's time to look past market expectations for a December hike.
The 100% probability for December, yes, that's in the market, means that December should be a non-event, except that it's about what they forecast in terms of the future pace of future increases. And back in December last year, remember, they gave us 4. This year, they'll give us 2. That's the market expectations, and market expectations relative to the Fed.
Joining us now from Chicago is Jim Bianco, founder and president of Bianco Research. He's been producing fixed income commentaries since 1990, and so well received they are. Jim, talk to us about December. We've had such a huge move in the bond market already since the election. Do we get any kind of a move when, assuming the Fed hikes, it hikes?
No, I don't think so. You know, you're right. It's 100% odds. The market is fully into a reflation trade. The stock market's up, interest rates are up. The dollar's up, commodities are up, and the Fed fund futures are saying 100%. So that's what's completely priced in. The market should basically be unchanged if the Fed does that. Now, if there's any deviation from that, and maybe the Fed talks about 50, or maybe the Fed talks about not going, then you'll have a reaction in the market. But I think this is fully baked in right now.
So what Jeffrey Rosenberg said was what we'll be looking for is what the Fed signals about the future pace of interest rate increases. What will we get from the Fed, and what would you hope to see?
That's right. I think that we are looking past the December meeting. If you look at the market, they're pretty much thinking that the Fed's going to raise rates, and it's going to be like last year. It'll be a year before they raise rates again another time. So we'll have to see if the Fed gives us any signals that they're going to do anything other than what the market wants. And to be honest, it's going to be hard for them. The Fed spent all of 2016 trying to beg the market into letting them raise rates through March, June, and September, and the market wouldn't. And you'll notice the way I said it is I do think that the market has a veto over Fed policy. When the Fed decides that it wants to do something, if the market doesn't price it in, they don't do it. That's what happened in March, June, and September. So they'll give us signals, but if the market doesn't buy into those signals, it isn't going to happen.
Jim, you're not convinced reflation's coming. What happens if you're wrong?
Yeah, I think the market is convinced reflation is coming. If it doesn't, we're in a couple of markets are mispriced. The stock market right now, by most metrics, is overvalued if you look backwards. If reflation is coming and there's a big earnings boost, maybe it's not overvalued. So the stock market would be in trouble. Interest rates are way too high if the reflation trade does not come. The dollar is too high, and industrial commodities have gotten ahead of themselves. So the market is priced in that the next set of economic data is going to be a lot better than the previous set. If you look at the economic data through today, even with today's housing starts beating, it's not been that great. It's been so-so to a little below average. The market is betting that from here forward, it's going to be much better. And if it isn't, you're going to have a big adjustment in the other direction in all these markets.
Jim, I've got a chart here which shows the amount of negative yielding bonds worldwide. And, we've come down from the highs in June when the amount was over $12 trillion. Now we're down to a mere $7 trillion, Jim. Do you think we're ever going to get back to those June levels, or is that now a thing of the past?
It's unclear if it's a thing of the past. I personally don't think that the reflation trade is going to unfold like everybody thinks, so you're probably going to see some kind of a backing off and a falling of rates. But I think the bigger issue to understand about that negative rate thing is that my favorite watchword is all central bank stimulus is fungible. It doesn't matter who does stimulus, whether it's the Bank of Japan, the Fed, the ECB, the Bank of England. And right now, you've got a lot of stimulus pumping through the system through the Bank of Japan, the ECB, and the Bank of England. If the reflation trade comes and those central banks back off of their stimulus, that negative interest rate number is going to come way down. But if it doesn't and they keep pumping out money, they keep buying bonds with printed money, you'll see it go right back up. My bet is that the reflation trade's not going to be as big as everybody thinks. But this is a high volatility trade. It's either going to work big one way or big the other way. There's going to be no real middle ground, I think, as we move forward over the next several months.
And just to illustrate your point, Jim, I'm showing 154, the chart in the Bloomberg Library number, is the central bank's balance sheet as a percentage of GDP. The red line is Japan, the white line is the US, and the blue line there is the ECB. But nevertheless, still a major portion for the US, even though it's much, much lower than Japan. But I do want to ask you, is the US economy in danger if we start getting fiscal stimulus at a time when even the Fed chair says it might be a little bit too late for that now?
Danger, I don't know. But if by that you mean if we were to get some fiscal stimulus and get some tax cuts and get the big burst of growth that the market is hoping for, do we get real inflation in the market? That's possible if that all unfolds. And even though the Fed says they want to run a high-pressured economy, the problem is if we do continue to get this burst of inflation expectations, bond yields are going to soar. And if they soar, that might force the Fed into acting. They can't sit on their hands and say, well, this is good. We finally got some inflation if the bond market is getting crushed. Right now, the sell-off that we've seen in the bond market is one of the 4 or 5 biggest of the last 25 years on a total return basis, meaning investors in bonds have been taking tremendous pain since the election. And if that continues, I think you're going to start to see that feed into the way that Fed policy is working and the way that people view the bond market.
Interesting times ahead. Okay, Jim Bianco, founder and president of Bianco Research. Thanks for joining us there from Chicago.
Vonnie, coming up, the Dow topping 19,000 for the first time ever. We're going to look at some of the biggest movers in the early U.S. session. This is Bloomberg. Live from London and New York, I'm Mark Barton.
And I'm Vonnie Quinn. This is Bloomberg Markets. It is time now for the latest Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. KKR has agreed to buy Japanese auto parts maker Calsonic Kansei. The price? $4.5 billion, which represents a 28% premium over Calsonic's last closing price. Nissan owns a 42% stake in Calsonic. It's been looking to spin off less important businesses so it can focus on electric vehicles and self-driving cars. U.S. auto safety regulators are allowing General Motors to delay a large recall of potentially defective airbags. That's to give the company time to prove the devices are safe and to avoid a huge financial hit. The move gives the company hired by GM more time to do long-term tests of Takata airbag inflators in older trucks and in SUVs. And in a bid to attract health-focused consumers, Dr. Pepper Snapple Group is acquiring Bai brands for nearly $2 billion. The soft drink maker says the deal will decrease earnings next year but add to profits in 2018. Bai markets its drinks as having 5 calories, antioxidants, and no artificial sweeteners. And that is your latest Bloomberg Business Flash. Let's head now to Bloomberg's Julie Hyman, who's been looking at some Dow movers, bringing it, in fact, above 19,000, Julie.
Yeah, above 19,000 and at a record. So what's powering it there? In today's session, we've got some individual movers, many of which don't have any fundamental news today, specifically that's a catalyst, except for Boeing, really, which is revamping its commercial jet unit, bringing in an outsider to run that unit and the continuing sort of restructuring of some of the management of the company. But then we have Intel, Walmart, and Chevron. No particular headlines on these. Of course, the gains that we've been seeing in oil prices have been helping Chevron in particular. If you look at the year-to-date performance of the Dow and some of the best performers there, we've got Caterpillar, which especially recently has been rising on optimism about infrastructure spending under a Trump administration. United Health Group, again here, gaining in part on optimism over changes perhaps to the ACA under the new administration. Chevron, again, on oil. And and JP Morgan also rising with this latest increase in rates and also presumed getting rid of some of the regulations that are out there of the banking industry. And then if you look at the best performers in the Dow since 18,000, you're going to see some of the same suspects here. United Health again on the list with about a 47% gain. JP Morgan on the list with about a 25% gain. Also McDonald's, which has been undergoing this big turnaround at the company as its sales have improved. And Microsoft also on the list as it broke out of its trading range under Satya Nadella. So the different stages here of the Dow's latest legs up, Mark.
Julie, thanks very much indeed. Right, still to come here on Bloomberg Markets. Oil gaining, holding on to those gains on optimism that OPEC will cut output. Is everyone really on board? We'll discuss the latest next. This is Bloomberg.
Bloomberg Markets. I'm Bonnie Quinn in New York.
And from London, I'm Mark Barton. Right, let's talk about oil. We're keeping a close watch on crude today. Analysts, traders growing more confident this week that OPEC will reach a deal to curb global oversupply. For the very latest, let's get over to Bloomberg News energy reporter Sam Wilkin, who's been all over this developing deal. He joins us from our bureau in Dubai. Sam, thanks for joining us. If you listen to OPEC delegates, we're a whisker away from the deal. Is it true?
Good afternoon, Mark. Well, everyone's been on board with this deal in theory since it was first raised. That, again, is what the Nigerian delegate said today. He said we are all on board with this deal. However, it really is going to come down to the wire to see if every country in OPEC is actually going to go through with this in reality, if when it comes to actually cutting their production by however much is required, if they're all willing to do that. So, as I say, it'll go down to the wire, to the OPEC meeting on the 30th.
Sam, let's talk about, the minutiae, and I've got a chart here which shows, the level of crude, which is the white line, the level of WTI. The blue line is where they want to cut production to, between 32.5 to 33 million barrels a day. And the blue line, which goes up, is current production, 34 million. Where are the falls going to land? Who's going to be carrying out the bulk of the production cuts?
Well, that's the real question, and that's where we get to the disagreements perhaps within OPEC over who has an exemption, who has special measures, and who has to carry out the bulk of those cuts. Iraq and Iran are the two countries to watch. Together they account for about a quarter of OPEC, and they've both asked for exemptions. Now, Iran has been granted special measures to allow it to get to its pre-sanctions output level, but it's basically already there. So are they now going to be asked to be asked to cut as well? And Iraq has also asked for an exemption, and Iraq is producing at a record high. So if those two countries don't get on board, then it's going to be a huge burden of cuts on Saudi Arabia and all the other producers, and they may then not go for it. So again, it's whether Iran and Iraq will get on board, and to what extent, and will other countries be able to fill the gaps if they don't.
As an illustration, Sam, I'm just going to point people to the terminal, and OPCA on the Bloomberg is a beautiful function that will show you exactly just how much each country does put out. Now, is anybody talking about the President-elect Donald Trump and what might happen if sanctions were to be reimposed upon Iraq, let's say, or Iran, and what that might do to negotiation tactics?
People have been discussing that. The question of whether President Trump would reimpose sanctions on Iran has been discussed widely in the region and beyond, and it would certainly have a big impact on Iran's oil production again. However, it's far from certain that he'll do this. He's given mixed messages. The Iran deal last year, let's not forget, wasn't just between the United States and Iran. It was also with several European countries and Russia and China as well. So as with many things with Donald Trump, we don't quite know what's going to happen, and it's one of those great unknowns, along with many other great unknowns that there are in the oil market at any given time.
And I know Iraq has been contesting the numbers that are being used, right? Iraq isn't fully trusting of countries' estimates. So how does that get solved? At the end of the day, down to the wire, do they just decide, OK, these are the numbers that are being produced?
That's right, Vonnie. This is another one of those discrepancies and another one of those points of disagreement involving Iraq. Iraq says it's producing about 200,000 barrels a day more than OPEC says Iraq is producing. So clearly any cuts or any production freezes have to, the number that Iraq starts from has to be agreed upon first.
Sam, great job. See you soon. Sam Wilkin, energy reporter for Bloomberg News in our Dubai bureau. You are watching Bloomberg. This is Bloomberg. Stay with us.
Live from Bloomberg World Headquarters in New York and London, I'm Bonnie Quinn.
And I'm Mark Barton. This is Bloomberg Markets on Bloomberg Television. Let's check in on Bloomberg First Word News. Elisa Parenti has more from our newsroom in New York.
Thank you, Mark. Most Americans say President-elect Donald Trump will ultimately do a good job as president. That's according to a new CNN ORC poll. More than 50% say Trump will do a very or fairly good job as president. 66% say Trump will bring change to the country, but only 43% say it will be change for the better. A new report concludes that Islamic State terrorists have used chemical weapons at least 52 times since 2014 in Iraq and Syria. Mosul was targeted 19 times with chemical weapons. IHS Markit released that report today. The group says that chlorine and mustard agents are most likely to be chemicals used in Mosul against civilians or military forces. In Turkey, the Nationalist Opposition Party is about to endorse President Erdogan's bid for more power. The MHP is signaling that it's close to agreement with the ruling AKP party on a new constitution. Erdogan wants to formally change the political system from a ceremonial presidency to an executive one. European Union policymakers have stepped up their criticism of the UK's plans to leave the bloc. They say that Prime Minister Theresa May's government appears clueless about the implications of Brexit. European lawmaker Manfred Weber is demanding that the British produce clear proposals as it prepares to begin Brexit negotiations. And a new report warns that British National Health Service is facing potentially crippling problems because of its biggest deficit ever. The health services deficit more than tripled to $2.3 billion in the most recent fiscal year. The British government spending watchdog warned that money needed to improve buildings and software will have to be reallocated, and that may impact care. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. Vani?
Elisa, thank you. Well, following President-elect Donald Trump's victory, bank stocks have been rallying on raised speculation of fewer financial regulations and more fiscal spending. The KBW Bank Index has rallied more than 13% since the election 2 weeks ago. And individual names like Citigroup are up 11%. Goldman up 16%, Morgan Stanley almost 19%, and Bank of America up nearly 20%. They're also all in the top 10 stocks in terms of points added to the S&P 500, according to data compiled by Bloomberg. So is it time to add more levered financials to your portfolio? Macquarie analyst David Conrad says it's worth looking at this new world order at least. He joins us now. You are upgrading some and downgrading others, though, David. This isn't a universal call to take a good look at financials and dip your toe in.
I think that's right. I think what we're looking to do is shift around exposures rather than growing exposures. I think when you look at the financial space right now, there are some positive dynamics. As you mentioned, a steepening yield curve, perhaps less, if not a stop to new regulation is a positive. And we also expect further payouts and dividend growth from the space. So what we're seeing right now is maybe an unloved space, now a catch-up trade as people were underweight, moving to market weight. And I also think that consensus has finally, I think, reached a trough level. I mean, we've been cutting estimates for 8 years now. And so as estimates start to come up, naturally PEs expand beyond that. But having said that, with this sharp of a rally, it's hard not to think that we haven't stolen or pulled forward a lot of gains over the next couple of years. You know, the universal banks have moved to 75% of the S&P versus 70 historical, and the large regional banks have moved to around 80 from 75. So valuations are full here, and that's why we're trying to shift around exposures to still be active, still be engaged for this rally, but not go too far with the space.
And I'm curious as to what you think about the tailwinds that are coming. So, yeah, we're getting an interest rate increase most likely in December, and perhaps fewer regulations under President-elect Donald Trump when that finally happens. So there are a few things that should look good for the banks, but are they continuing good things, or are they sort of a one-time benefit that then fades?
I think they're a continuing benefit. The issue is also you have to be careful on what will actually, get done and be implemented. So that's a concern. But I think, our view is the steepening yield curve and just hopefully the stimulus, not just for the banks, but improves economic activity. I think that's the bigger lever to banks, as well as just looking at net interest margins. And that was really the key behind our upgrade of Goldman Sachs, is that if we have increased economic activity, there's going to be better capital markets and capital raises, which will have a much bigger lever to a company like Goldman.
Yes, so David,
happen, but there are mixed signals coming out of the President-elect, Mr. Trump.
We've seen a big outperformance, David, in Morgan Stanley shares relative to the S&P 500 since February. But, you say you still like the stock. How's that?
Well, yeah, we've upgraded this stock several times. We upgraded recently when it hit its low around $25.